I know this is hard for everyone. It's certainly hard.
What human nature does to what human nature does to both other people and to you.
To our colleagues in Bloomberg News. Pandora also in focus. We were going to talk to the CEO, upgrading revenue, and it seems analysts, Guy, think that positive is going to offset the negatives around silver prices and FX.
And what's happening with the consumer? We'll come to that subject a little bit later on. Okay, time for the opening trade this Tuesday morning. Let's talk about what we are seeing on the screen. We're anticipating that we are going to see a positive response for European equities this morning. But as Chris says, maybe a little on autopilot. There's not a lot of real guidance here in terms of the data telling us where we should be going, or the corporate news telling us where we should be going. Futures yesterday picked up in the United States, as a result of which we see a pickup here in Europe as well. I say the session went higher yesterday in the United States. We're up by a little bit. FTSE 100's up by 0.3%. This is not exciting stuff. You've got the 600 up by 0.2%, 0.3%. I get that one a little bit wrong. So we're up, let's call it 0.3%. Let's call it 0.5%, maybe, if I'm feeling really optimistic here right now. But there doesn't seem to be a sort of key driver here in terms of taking these markets forward. Is there a sector rotation story? Let's find out. Critty, what does the deeper dive look like?
Man, you were really selling today's market session. Very exciting stuff here. A lot of it led by the commodity space, actually. I think this is really interesting that you are seeing your biggest index contributors, your Shells. You're seeing a little bit of BP in there as well in terms of index contribution, both in the FTSE 100 and the Stock 600 as well. But there's also plenty of red on screen, and a lot of that coming up in the biotech space as well. It looks like from a sector point of view, though, Anna, travel and leisure seems to be the underperformer.
Yeah, that's had a couple of days of gains, actually, and it was the leisure side rather than the travel side that was doing well. But today, looking at that, looking at the weakness coming through there. In fact, it's a reversal of what we'd previously seen. So it's the likes of Flutter Entertainment on the gaming side that seem to be weaker, although some of the airlines also down a little. Perhaps that has to do with some of the strength we'd seen of late in oil prices. But as we know, that oil price down around 0.5% this morning. In terms of the individual movers, we'll keep an eye on all of the stocks that we had in focus. But to complete the sectors picture, financial services actually the best performing sector. Most sectors are in positive territory this morning. UBS, I noticed, going higher this morning, just ahead of its earnings.
Yeah, we'll get that interview tomorrow. We'll have Sergio Amotti on the show. We're looking forward to that conversation. In terms of where the points are coming through, Astra's up, ASML is up, SAP is up. So technology stocks are doing broadly okay this morning in terms of the weight they're adding. Luxury's coming back a little bit. You basically got ASML, few luxury names in there. UBS, as Anna says, is up a little bit. HSBC is also tracking a little bit higher as well. But to your point, actually, I think the downside is more interesting this morning. So Flutter is softer this morning, so you're definitely seeing some money coming out of that space. The bets are off. I'm not sure if there's a kind of betting joke somewhere.
You made one.
Somewhere.
Excellent.
Very bad one.
Well, you know, attempted. Let us think about where we are on the broader market story. Yesterday, we had a really interesting conversation with Sebastian Redler, who joined us on set from Bank of America Merrill Lynch, head of European equity strategy. And he sees more downside for European stocks, essentially. He says there's further to go down, and he ties this to what we're seeing in credit markets. He says that because of spread widening, that's going to have a negative impact on stocks. Let's have a listen.
The best gauge is the US high yield credit spread. These are global risk premia. When everything is fantastic, you're at 300 basis points. If you go from 300 to 500, with our base case, it's 10%. If you go from 300 to 700, it's 20%. If you go to the 1,000 that you have gone to every single hard landing, then it's 35%. So this is the best way to
European equities or US equities?
European equities highly correlated to the US high yield credit spread.
That was Sebastian Redler, as I say, from Bank of America Global Research. Joining us now, Julius Bendikas, European Head of Macro and Dynamic Asset Allocation at Mercer. Julius, really nice to see you on set with us this morning. So let's start with your overall view on European stocks then. We were hearing there from the view of Sebastian is that stocks have further to fall in Europe, and he says because credit spreads are going to widen out. What do you see happening?
I would probably take the more optimistic side of the arguments. Our central case is that soft landing is happening around the world, starting with the US, with Europe, and that is actually a pretty good time for equity prices. In a world where economy is slowing but remains resilient, in a world where inflation is a problem broadly resolved, and in a world where central banks are beginning to ease policy, or have started to ease policy, that's not a terrible time for equities. And while I accept there's downside risks to that, our central case remains that of, I would say, cautious optimism.
Okay, cautious optimism. And so what did you make of last week and the aftermath? Some guests describing it as a bit of a head fake. I was just looking at where we are over the last 2 weeks to kind of try and capture where different stock markets have reached in the wake of what we saw from the BOJ and concerns around US growth. What I find interesting is actually, the last time I was looking at this data, I think we're going to pull it up, the European stocks lost more, and that wasn't even the area of key concern, but Asia has done a better job of recouping some of those losses. There you go. I mean, it's not by much, but Europe is still down by 2.5% over the last couple of weeks. I mean, what does that speak to?
Well, the one thing that I'm slightly worried about Europe is the manufacturing sector. And looking at the latest data, particularly in Germany, and actually there's a survey coming up in an hour or so that'll give us a bit of a glimpse as to what's next. But German manufacturing is something that still worries me. And European manufacturing sector as a whole is looking a bit shaky. But the services is looking really good. So I think there's a balance there. And on net, European economy should do just fine. But I suspect that softness in manufacturing sector that is getting pressures from all around the world is something that has led to a modest pullback in European stocks versus the others.
If you believe equities are okay, does that mean that you think bond markets are wrong? Because bond markets are signaling a fairly dismal outlook here, and significant rate cuts are going to be required to deal with that. Especially by the Fed. I think the Fed is overpriced to cut. I don't think the sort of emergency rate cuts or 50 basis point rate cuts are fair at this stage. In a world of soft landing, of gradual cooling in growth and inflation, I think central bank policy should gradually normalize too. There's no need to press on the brakes. So how much price do you think we are?
Right now we're priced 100 basis points for this year by the Fed, and another 150 basis points.
What would be a more realistic number?
I would say a more realistic is three rate cuts where we were before the technical flash crash. Indeed. So 25, I think they'd be more sensible. But again, data can change. But as it stands right now, I think soft landing is playing out, and that should be enough for 3 modest rate cuts, not 50 and 25.
So Deutsche Bank said something kind of similar as well. They're saying now you are finally, given the kind of mini correction that we saw recently, it is now in line with the earnings growth that you are actually seeing the slowdown in the earnings growth, specifically when it comes to the tech sector. If you see more of a sell-off, seasonality kicking in the back half of August or even in September, is that a buying opportunity or is that a warning?
I think it's a buying opportunity. Again, economy is not breaking, it's merely bending. Soft landing is playing out. We shouldn't get too worried about a couple of weaker prints. They are in line with economies cooling because they were overheated. So this is just soft landing playing out. I don't think there's enough evidence to call for a hard landing or a deep recession. And against that backdrop, any pullback, particularly the one that's technically driven, is something you should be interested in. And we certainly were over the last couple of weeks.
So Guy and I have this argument quite often, which is, do stocks always go up?
It's a debate.
Oh, it's an argument. He debates, I argue, that stocks always go up. And I'm curious, though, that if you do start to see I say stocks always go up. He says that they don't always go up. But if you start to see this idea that you have the Fed and there's plenty of room to cut, et cetera, how much kind of room does that leave for stocks to rally in the next, say, 3-5 years? Is that just an upward trend that we're looking at now?
Well, if the economy is doing well, if productivity is doing well, if inflation is broadly under control, if you have gains in an economy, you should have gains in earnings. Therefore, equity prices should be moving up.
But that's not where that comes from, though, right? That would entail the exact dynamic you were just laying out, which is that the economy is slowing down. That's why the Fed would need to cut rates and have that room, and that would be what drives the market. How much of that wouldn't necessarily mean economic resilience? It would mean economic weakness.
I would say as long as the economy cools down without a sharp fall, that should be perfectly fine for equities.
Are the highs in? So you don't think the highs are in right now? You think it's in the next 12 months, you think the equity markets can make gains from here?
I think so. And certainly in our portfolios, we're overweight equities because we think soft landing is playing out, and that should be.
And one of the places you're excited about still is Japan, and that's very topical because obviously we saw a lot of international investor interest in Japan, and some of that unwound quite spectacularly last week. But you've been treating that as a buying opportunity, then, from what you said moments ago. Has it been a buying opportunity in Japan?
Absolutely, absolutely. There was a technical pullback driven by light August liquidity because everyone's away, and the number of other carry unwind trades that I'm sure you've discussed with many people about that. So I won't go into too much detail on that. But at a high level, Japanese economy is encouraging. Growth, we think, is going to turn around, and we think that inflation is actually picking up, which means nominal growth is picking up, which means
Okay, that's really interesting. So you think stocks in Japan will go up and the BOJ, I assume, keeps hiking rates there, and stocks in the US will go up as the Fed is cutting rates? That raises interesting questions, doesn't it, about the link between stocks and rates and the different stories that are playing out in these different geographies?
Absolutely. Global economy, we think, is normalizing, but that means very different things to different economies. For the US, that means cooling. For Japan, that means acceleration. For US inflation, that means going down. For Japanese inflation, that means going up. So it is a very interesting dynamic that one should be very interested in, both from equity perspective and, importantly, from a currency perspective.
You've laid out a whole bunch of scenarios, which I imagine are kind of the center of the distribution. If these things happen, our central case is stocks go higher. How big are the tails in this scenario, and are those tails getting bigger, i.e. is the risk to the central scenario growing?
I would say the downside tail has increased a little bit lately because of what we've seen in the markets. The other side of the tail, which is re-acceleration in growth, re-acceleration in inflation, I think has come down. So if we had this conversation 6 months ago, I would say the upside risks to the economy are there in terms of growth and inflation. Right now, I would say the downside risks are a little bit more pertinent. So the balance has shifted, but again, central case I think is powerful enough for us to allocate on.
Just in terms of, so how do I distribute for that? Up until now, if I've wanted to outperform, I've needed to be very long equities and very long tech stocks. Has that mix changed?
Well, for us, when we do dynamic asset allocation decisions, right now we think you should be overweight equities, and actually you should be underweight bonds, driven by US Treasuries, where we think the Fed is overpriced. So that's the way we think you should be positioned to add value. In terms of actual sectors, we're excited about tech, but within equities we find more interesting opportunities in our view. Japan, real estate investment trusts, and indeed nibbling into EM equities.
Real estate investment trust in Japan. Interesting.
Real estate investment trusts globally.
Okay, understood. You talked a lot about central banks and this idea that there might be this kind of economic resilience. I keep coming back to in 2019 when Jay Powell had to kind of cut rates in response to the tariff war, at least the threat of tariff war between the U.S. and China. At what point do central banks need to start forward thinking about tariff risk, further geopolitical risk, that have more to do with elections and fiscal policy as opposed to economic policy?
When they have some more clarity on those policies.
So when is that time, though? Is that November 6th?
I think that's sort of after the election. But again, you never will know what's going to happen. So as a central banker, you want to make decisions ex ante.
But given the lag, though, I mean, when is too late to make that decision, right? Because let's say you have a new president, whoever that may be, in January, you have the new policy decisions. How long before you can be responsive to something like that?
I think the minute you see there's downside risks to activity, and the minute you see that there's downside risks to inflation, then you begin to cut rates in expectation of that. As it stands, there's none. Well, there's some risks to the downside, but as it stands, I think the central bank can be fairly comfortable that the U.S. economy is not breaking and that inflation is a problem broadly resolved. And against that backdrop, it should be gradual, and they should not be preempting cuts based on tariffs.
Julius, you say in your notes, and it's a good reminder for us all, that August is a long month, and you've set out quite a positive case for stocks. What is your place to hide if you need one in August?
Well, right now, our place to hide is actually Japanese yen. It is proven to be a slightly defensive asset lately, and that is something that we're encouraged by because we think the BOJ needs to hike rates. We think it's cheap. We think it's something that has huge room to rally. So that's something we favor from more defensive assets. But there's a number of other things we're interested in. As I said, real estate investment trusts are something that we like with medium conviction. And yeah, that's about it from the defensive front.
That's about it. Perfect place to finish it. Julius, nice to see you. Thanks very much indeed for stopping by to see us. Julius Bendikas, European Head of Macro and Dynamic Asset Allocation over at Mercer. Let's take a look at the core six, see what's happening here this morning in terms of the major stocks that we watch out for across Europe. Broadly, some green on the screen, but muted, I would say. It's interesting that tech is catching a little bit of a bid this morning. ASML is up quite nicely. Luxury, fairly flat this morning. I always include maybe Schneider in that tech story. And you're seeing basically ASML and Schneider doing quite well. Novo, another day of softness, which is interesting. That's the second day. Yesterday we were flagging that this stock was a little softer. Let's talk about some of the stocks we're watching elsewhere. HelloFresh, at one point I saw HelloFresh up by 21% this morning. I think we faded a little bit off those earlier initial moves. But as you can see, the stock is up really quite nicely, if you can read that. I just about can. Delivery Hero is up by over 2%. So the top one's HelloFresh. The bottom one is Delivery Hero. HelloFresh is up by 15% at the moment, Critty.
I have another stock on my radar here, Fort Knox, which is not a company I think I'm very familiar with, but it is a software company out of Sweden, taking a hit about 10% after their CEO, it looks like, has informed the board that he is leaving immediately. They are starting the process of appointing a new permanent CEO, but it's not something that was very telegraphed, so perhaps a little bit of panic, Anna, in those shares.
Okay, yeah, certainly something sending it down. Let's talk about Pandora, this jewellery business. The stock here down by 1.25%. So we had heard some improved guidance from the company, raising their 2024 revenue guidance yet again. And this is a market that is broadly going higher, but something has weighed on this business. You can see Pandora is down by 1%. Has certain things in common with other jewellery retailers, but certain things very much not in common, I suppose, with other jewellery retailers, worth pointing out. But they have updated their guidance. It's not sticking necessarily in where the market goes right now. The stock down by 1%, as I mentioned.
Speaking of big moves, you should bring it back to the commodity sector as well, because you are still seeing a little bit of a beating in some of these shares. When you look at the basic resources, Rio Tinto is one of your biggest index contributors to the downside, I have to say, for the stock 600. You have Anglo American, Glencore in there as well. BHP is still a little bit higher, which I think is interesting, given that the rest of the sector is not. But that's going to be something we keep an eye on as we see those negotiations over in Chile kind of pan out.
Do you want to talk about groceries?
Do you?
I can talk about groceries.
We talked about groceries a lot.
We talked about the groceries a little earlier, which are our favourite American stores. Let's talk about what's happening here in the UK. The Kantar data is out. So Asda losing market share. Aldi and Lidl, the hard discounters, I think are eating into their numbers, it looks like, coming out of these figures that Kantar are publishing at the moment. Sainsbury's, though, and you can see what's happening with the stock this morning if you've got good eyesight. Sainsbury's stock is up quite nicely, up by 1.1%. Ocado's doing very well as well. Sainsbury's market share is growing at the fastest rate since 1997. So Sainsbury's on a little bit of a roll this morning.
Okay, coming up on the programme, Wall Street's big money managers are being forced into a new way of doing business in the Middle East. According to our reporting, we'll bring you our big take story. We'll dig into it next. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Earnings season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Minutes into the equity market session. Equity markets are doing very exciting things this morning. We're up by, let's call it 0.3%. there's not a clear sense of direction. I think, to be honest, you're going to have to wait for the inflation data a little bit later on, which starts in the United States. We shift from PPI to CPI over the next 24 hours. You're also going to get Walmart, which I think is going to be a kind of quite a good guide as to what is going on in terms of the US economy and what it's going to tell us a lot about the consumer as well. So basically, things are still to happen, but this morning they're not really happening in a great sort of massive fashion. We are seeing quite good numbers in HelloFresh. That's as far as I go. Let's talk about some of the exciting stories that you can read, though, on your Bloomberg. Let's talk about the big take today. So Wall Street's big money managers, and this is a really interesting shift, are facing a big move in the way that they're doing business in the Middle East with sovereign wealth funds and other money managers in the region as well. So this is Bloomberg's big take. It basically explores how these state-controlled funds in the region are increasingly asking private equity firms, hedge funds, et cetera, what they will do for them, rather than just handing out basically big checks with no strings attached. You can see this most clearly in Saudi, where there's a huge move to make this happen, but it's pretty much across the region as well. Christine Burke joins us now from Riyadh to give us more of a take on this. Look, what is changing here? What is changing if you're Apollo, Blackstone, BlackRock in this region? And is this just being driven by this huge story that is coming out of Saudi at the moment?
Yes, well, all things do kind of lead to Saudi these days, but let me just give you the real basis of the story and what this is really about. So this is a story about the shifting of power dynamics and the relationship between sovereign wealth funds and global asset managers. So once upon a time, it used to be that asset managers, private equity firms, hedge fund titans would come here to places like Riyadh, stay in five-star hotels, be shuffled around to different offices, and ultimately leave to go back home with a suitcase full of cash that they could then take and deploy to their funds however they see fit. Fast forward to where we stand today, and what our sources are telling us is that this is no longer the case. Asset managers are now being asked what they will return to these sovereign wealth funds in order to secure investments. Essentially, sovereign wealth funds want these asset managers to do things like set up offices here in the region, to commit to moving staff here, to commit to training local staff. So really, it's about these sovereign wealth funds flexing a little bit and starting to demand more for their money. We've heard that they want to share more of the profits. They really, at the end of the day, want more of a partnership and not to just be giving outright investments to these asset managers.
Well, what does that change for the asset managers themselves? I mean, we had a visual there of Apollo, Blackstone, BlackRock. What does that response look like to the ask of some of these sovereign funds?
Well, so far it does seem like Wall Street is playing a bit of ball. One key example that I can point to is that BlackRock earlier this year agreed to take an investment from the PIF, that's Saudi Arabia's sovereign wealth fund, for as much as $5 billion. And in return for that investment, what BlackRock has agreed to do is set up a new investment firm here in Riyadh and to invest in the Middle East in particular. So I think deals are still going ahead under this new set of rules that we are seeing. But at the same time, I think we have to consider what kind of risks that brings for Wall Street. I think there's a question of whether that means that they can remain independent, but also what this means for the profits of asset managers. We have heard that these sovereign wealth funds have, for example, been asking managers to cut their fees and to even change some of their fee structures in exchange for being brought in on key deals and securing key investments. So there is a question there around, how much of a positive trade-off this will be.
Christine, thanks very much. Thanks for the update. Bloomberg's Christine Burke with the latest on that big take story. You can find, of course, the big take story on our website. You can find it on the Bloomberg terminal, of course, as well. We have talked about a lot of the things that are on the agenda for today. One of them is US PPI. We've been through some of the UK data that we've already had out. We also have a focus this week on some of the retailers out of the United States. And we talked about this a bit yesterday, Guy, but interesting to think about the macro signals we might get from some of these, Walmart in particular.
I think it's really interesting, and these companies tell us a lot about what is going on with the US consumer, and that's where the focus is right now. You saw the data out of the New York Fed yesterday indicating the consumer is getting more comfortable with the inflation picture. Does that ultimately prove a positive for the US economy, i.e. you get more of a positive consumer feel coming back into the economy, which has been struggling a little bit, and that gives us another kind of leg of forward momentum. Walmart's going to tell us a lot about that. I always think, though, Critty, that good news for Walmart is bad news for the economy. If people are trading down, that's not necessarily something you want to be seeing.
Well, it has proven to be a recession indicator, and in a lot of kind of recessions, you have seen Walmart stock actually outperform for that very reason, that people kind of switch and go into the lower, the cheaper income goods. in terms of where they're getting. It's also in the context of the energy story that we've been talking a lot about in the CPI, PPI data. Walmart has gas stations everywhere across the country. They're not only known for their, quote, everyday low prices in food, but they're everyday low prices in oil as well. And I think that's going to be a crucial take in terms of how much that feeds into the earnings story.
Yeah, and as our producers were pointing out to me yesterday, it's interesting if you look at the way that they have driven increases in revenues of late, it's been through getting more people through the door, those people who are trading down, that broadening of the appeal of Walmart, and not about increasing in the basket size of those people. So it's all about the footfall.
Yep. And does that, and going to store as well, because they're also competing with Amazon as well. They've got a big kind of omni-channel offering as well, which is really gaining in strength for Walmart too.
And have been able to execute their e-commerce business in a very surprising way, given that, I mean, again, their low prices means that you have to hit a certain basket quota to get the free delivery. I'm getting very nerdy here, but it matters because that was their initial kind of counterpoint, that they couldn't compete with Amazon because they didn't have that logistics service. And instead, they're actually able to prove that they are, even with that, and it's actually encouraged people to buy more online, which is pretty fascinating. We're going to continue the consumer story with a little bit of a different lens. We talked to the CEO of jewelry maker Pandora about what's driving their sales story and the appetite for its lab-grown diamonds. More on that next. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
This is the opening trade. We're about 30 minutes into today's session. Look, it's a little bit of a sleepy session. light volume, light liquidity. Everyone's kind of in that summer mindset, especially after what it feels like has been a very volatile 2 weeks or so in the global markets. You've seen a little bit of a catch-up trade over in Asia, specifically as Japan comes back from holiday. Nikkei closing about 3.5% or so. You're also seeing some green on screen when it comes to the European indexes as well. And I think that's crucial here. Slight outperformance in Europe. The Euro Stoxx 50 higher by 0.4%, but also about 0.3% in the FTSE 100 and the CAC 40 as well. Now, there are a couple of earnings stories out there, and we're going to dive into one of them, specifically as we talk about what's going on with the consumer. Pandora shares, however, are down this morning, pushing back against that green on screen you were just seeing, despite the Danish jeweler lifting its organic revenue guidance for the full year. Let's get a little bit more insight on what's going on underneath the hood. I'm pleased to say we're joined now by the CEO of Pandora, Alexander Lacik. Alexander, a pleasure to have you on the program. Thank you so much for joining us. Look, you've increased your revenue guidance. Things are looking fairly good in the numbers. Your stock's down just a little bit. Walk us through where you see the strength in your business.
So sometimes when I come home from these earnings calls, my wife asks me, so why did the share price go down when you posted good numbers? And my answer is always, I don't know. It's strange, but it somehow is what it is. But if we then kind of look at what we're actually doing is we are strengthening our brand everywhere. We're gaining market share everywhere. We're generating more and more traffic into the brand, which we're converting, and therefore our sales numbers are what they are, and also gives us now the strength to increase the guidance. So from my vantage point, the brand is in a really good health. We are kind of pleasing more and more customers. The new strategy that we deployed last year on trying to pivot us from being just associated with charms into being recognized as a full global jewelry brand is working really well. Our core business continues to grow at a good clip. The Moments business was up 3%, which is still the majority of our collection business. But then we're posting close to 30% like-for-like growth on kind of what's part of being this full jewelry brand is about. So strategy is working, customers like it, the brand is strong. What's not to like?
Well, Alexander, the criticism of that, as great as it is that you're leaning into that brand momentum, is that brand momentum is the only thing driving the sales. So if you see a more macroeconomic downturn, a more kind of clear slowing of the global economy, not just in the States, but in China as well, where, of course, your business perhaps hasn't seen the turnaround that other luxury makers have, that's where the Achilles heel of the business would be. What would you say to that? That if the macroeconomic turns to the downside more aggressively than we've seen, how can Pandora cope if they're really only leaning on that brand momentum?
Well, if you go back in the last few years, we've had COVID, we've had recession, or whatever we want to call it, depending on where you are in the world, inflation going up, interest rates going up, discretionary spend being under pressure. Throughout this entire period, we've just become stronger and stronger, and our growth has kept on increasing. So that would be the best. Normally, you know, a good way to predict the future is a little bit to look what's happened in the past. So with that thing, I would argue that we stand really strong, even if things get worse from here. But the reality is, in the last 2 years, there's been a lot of talk about things in the macro getting worse, and in reality, they really haven't. Now, the jewelry market, if I look at a little bit closer in, has probably not been growing in the last 2 years. But despite this, our business has been growing. So in fact, in the last 5 years, the business of Pandora has grown 50%, during what you would argue has been a quite volatile period in this economic cycle. So I think the brand stands really, really on firm ground here.
Alexander, good morning. It's Guy. You say in your note, though, the jewelry market has historically grown faster than GDP. Does that trend still work in this current environment?
No, as I said, I think based on the data we see, and you know, there's quite difficult to read the markets. There is no good one source of this information, so we have to triangulate a little bit. But if I look at the totality of it, it does suggest that the jewelry market has that 3 to 4% CAGR that we saw pre-pandemic in the last 10 years. That has not been the case so far. But what you should also remember here is our market share is less than 2% of the global market share.
Yeah.
So from a Pandora standpoint, the runway for growth is large. So there's still space. You will always have winners and losers, even in a shrinking marketplace.
You go on. That sentence continues. The jewelry market remains highly fragmented, as you say. You've only got roughly circa 2% of the market. Do you take more market share? Is that an organic strategy? Is there an M&A strategy that goes with that? Can you grow faster via other means other than simply just growing organically?
So the current strategy, which we detailed out last fall, is purely an organic growth strategy. And that's, let's say, that's a quite safe way to grow. M&A, as we know, 5 to 6 M&As typically do not drive shareholder value. Then you might have 2 that are kind of neutral and 2 that actually generate, positive shareholder value. So an M&A strand is more risky than an organic. We know what we're doing. We've currently been building market share and strengthening this brand for a while. So the type of growth rates that we've promised the market should drive a quite attractive EPS growth in the mid-teens. That sits in our current guidance. And we think that's a very interesting proposition, in particular also when you have this type of macro. What I also think people shouldn't lose sight of, if you look at the reporting from our luxury peers in the last quarter in particular, we are at the top of that pile. So there's something good happening around our business.
Alexander, good morning. Can I ask you about lab-made diamonds? I understand that these lab-grown alternatives now account for around 20% of the global market. How big do you think that percentage can be?
So, okay, we're now on speculative ground, but what I would start off by saying is a diamond is a diamond, regardless whether it comes from a mine or whether it comes from a lab. The final product is a 100% carbon product. The way we do it, of course, means that you can produce this at a vastly lower cost. It has less of a CO2 impact. So, taking up a mined diamond is probably 160 kilos of CO2 emissions. Doing it in the lab is 8 or 9 kilos. So it's less than 5%. So you have less pressure on the environment at a lower production cost, which leads to a value proposition that can be quite attractive. Those factors will drive a massive transformation in this market. So 10 years on, my prediction is that the vast majority of diamonds being sold are going to be lab-grown. So I think we're in front of a big transformation here, based on a technological revolution that's happened.
Yes. Yeah, it's really a fascinating one. And if you can grow diamonds in the lab, what else can you grow in a lab? A conversation perhaps for other guests. But thinking about the marketing of these and how they're going down with customers, Alexander, what can you tell us about consumer perceptions? I mean, you think about diamonds, you think about romance. I'm not sure the name lab grown makes me think about romance. So how does that argument go down with consumers?
Okay, so there are 2 drivers of a purchase in this category when it comes to product choice. So when you walk into a jewelry store, you'll be looking at, is there a design that appeals to me, and does this fit my wallet? Those are the 2 main criteria people use. And so therefore, we don't see that there's any different way of selling this versus other finished jewelry, let's say, in our stores. It's the same approach. The customers that come in, they've already read up on the topic of lab-grown versus mined. So there's actually not a big debate in the store. It becomes more of a traditional way of selling a piece of jewelry. Is it beautiful? Do I like the design? Does it kind of, speak to me in terms of the value I'm looking for? And is the price right? And we go from there.
Well, Alexander, so much of that pricing, though, is dependent on the capacity restraints. I'm curious what you're seeing on that front. You'll see some of the other kind of players in the diamond industry talk about those kind of issues. Can you walk us through kind of the start to finish of how that affects your pricing and what kind of time and delays and lags we're looking at?
Okay, we are not in the mined business, so you probably have to chat with the De Beers of this world for them to explain how their value chain works. What happens in my world is that, of course, I can kind of generate products that I can go to market with, which has a completely different value equation than what the mined people do. So I think that's probably the best way to answer your question. So have a chat with those fellows because their value chain is obviously more complex because of the way they produce it than ours is.
Alexander, can you generate or obtain higher-end customers while keeping your lower-end customers? Are these two things manageable? You can keep the brand perception for both of these two groups, because as if you take the market up into the mine segment, into the lab-grown segment, you're producing more diamonds, you've got a higher value proposition. Is that going to undermine your traditional customer at Pandora? How does that value proposition work all the way through the scale of people spending?
Yeah. So the first thing to say is that the mission of Pandora is to democratize the jewelry space. That's the journey this company has been on in the last, 2.5 decades. And the initial path of that was to use silver instead of gold. And therefore, you could reach a very different value equation. And that's been the basis of where Pandora is today. And everything we do is targeting the middle of the market. So, of course, we are a very inclusive brand. It doesn't matter, from where you come, of course. Yep. But my target audience is an average income household. And it's going to remain being that household. Now, if you look at that customer base, they would many of them would desire to own a piece of diamond, but a mined diamond is too expensive for them. So that's out of reach. So again, we're going back to our mission statement and saying, okay, is there a place here where we can democratize this space? And with lab-grown diamond, it offered a different value equation, and so therefore I can offer this to my audience. So my objective is, with the lab-grown diamonds, to offer diamonds for the mass market. And therefore, I'm not chasing the higher-end customer. Of course, they are more than welcome to come to Pandora as well, and some of them do. But my main focus is the mass of the market.
Alexander, great to catch up. Thanks for bringing us the numbers this morning. We greatly appreciate it. The stock is up circa 2% right now, off its earlier highs, but still up nicely, 2%. Alexander Lasik joining us, the CEO of Pandora. Thank you very much indeed. What are we going to do next? We'll get back to what is happening with the employment story out of the UK. UK unemployment dipping unexpectedly. We will keep an eye on what is happening here. Let me just have a quick look at the GIP on Pandora to make sure that I'm giving you exactly the right data. Down 2%. Sorry, I'm being corrected in my ear. It is down 2%. Anyway, we'll figure out exactly what that means a little bit later. Anyway, the Bank of England is coming up next. We'll talk about it. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
This does not leave me, let's say, cold and untouched, and we had to increase security measures here as well for our, let's say, premises and also for personal security. And I'm not fully scared. This I think is not the case. But definitely things have changed and times have changed in that regard, and it's not fun.
But to be clear, you and the company have taken additional measures to increase security as a result of these threats.
Absolutely, absolutely. This is clearly advised, and we obviously follow that.
Switching focus to the politics of the US, Suzanne, what would a Trump presidency mean, do you think, for the defense industry of Europe?
I think it might increase or accelerate the pressure even more. Trump is rather clear in his view on what Europe should do, and with respect to investments and Ukraine aid. I think we know that, but obviously Trump will make it even more clear and maybe more robust in actions. So this, I would expect that this will increase pressure on the Europeans to act even faster. We have started now to close this gap from talking to acting, and I think this will just increase the pressure even more. And that's why no harm for the industry. Europe obviously need that push.
That was the Rank CEO speaking to Tom McKenzie a little bit earlier on today. Came in with Tom asking basically about her personal security. This after we saw the Rheinmetall CEO and potentially other CEOs within the sector being targeted for assassination, which was an incredible story that was defeated by a sort of a multilateral, multinational approach to defeating some of these attacks. But her securities and others within the sector obviously prominent. It's interesting to see what is happening here. This is a sector that continues to go from strength to strength, and it's fascinating to see what is happening in terms of the sector story this morning. There is some weakness, but nevertheless, this has been a sector that's been on a really strong move over the last few days and weeks.
Yeah, for depressing reasons that we well understand. And the news on the Ukraine-Russia border perhaps adding to expectations or raising questions about where that particular battlefield goes, to which most people won't have answers, but we'll look for further detail as to what Ukraine is intending with this incursion into Russia.
Yeah, a lot that'll fade into, of course, the economic conversation on both sides of the Atlantic when it comes to things like NATO spend, which of course was a part of the conversation that they had as well, but also capacity restraints. How many times have we talked about the raw materials, et cetera, involved in the ramping up of defense in Europe? So that's one piece of the conversation.
Let's pivot to some of the UK data we've had out this morning. UK unemployment unexpectedly fell in the 3 months to June, down 0.2% to 4.2%, so down 0.2 percentage points, I should say. The jobless rate comes ahead of inflation numbers and other data key to the next Bank of England rate decision. Joining us now to discuss, Bloomberg's Anne Hansen from Bloomberg Economics, who can help us understand this data. So, much tighter labour market than expected, but it came with a host of other numbers around broader employment dynamics, Dan. So what do you take away from this?
Yeah, so with the jobs market data, there's always this flurry of information, and you've picked out the standout stat, the fall in the unemployment rate. One thing I'd just say about the unemployment rate figures in the UK is they have been quite volatile. There's a low sample size in them, so we can't be placing too much weight on one data point. If we look at things like vacancies, if we look at things like payrolls, which come in advance of the, run 1 month ahead of the official labour market data, the broad story is one of loosening. We can still sort of say that that's right. I think what the unemployment rate data does do, though, is tell us there is a risk in the second half of the year that story begins to change a little bit. The economy is growing pretty fast. And historically, if I look back over the past 15 years or so, those sort of growth rates that have seen and are likely to see on Thursday, 0.6%, 0.7%, that has been consistent with a falling unemployment rate. So, there is this story in the second half of the year where things turn, the headline inflation starts rising, the unemployment rate starts falling, and it suddenly looks like cuts from the Bank of England are off the table.
How likely is that as an outcome?
It's not our base case, but I've looking at it this morning. It's something that we've been grappling with as we put together our forecast, the idea of how far the unemployment rate will rise.
Yeah.
One of the interesting things in the monetary policy report 2 weeks ago now is the idea that the bank thinks the unemployment rate might need to rise quite a lot further to put downward pressure on wage growth. So if it's going in the wrong direction from where we were in the 3 months to May, that's obviously not a good story if you're thinking about cutting interest rates.
So that's the CPI story. We also have retail sales on Friday as well. And I'm wondering how much of that kind of changes the narrative if the data comes either in line with what we see in the CPI numbers or in the exact opposite direction.
Well, I think this is the story now for retail sales, at least. I mean, it's a small bit of the economy, but it's a leading indicator again relative to things like GDP. And if we see that strong, and it probably will be strong because of usual thing, weather.
Yeah.
But it probably will be quite strong. What we can tell is that into the second half of the year, the economy might be carrying momentum. And it comes back to what I just said to Anna and Guy, is that if the economy's holding up, there is a risk here that the jobs market doesn't continue to loosen. The Bank of England sort of base case is that we do get ongoing loosening in the labour market, ongoing moderation in wage growth. And if that doesn't happen, then I think they're going to have to reconsider how far and certainly how fast they cut interest rates.
And how much of that is a cyclical rebound, as you're describing, the potential for one, and how much of it is a structural difference in the way the labour market performs? Because last time we sat and watched a Bank of England press conference, they gave quite a lot of time to talking about, we know Catherine Mann is thinking about this, about how much the labour market has changed since the pre-pandemic.
Yeah, I mean, on the growth side, I think it is a cyclical boost in the first half of the year. I don't think it will last. As I say, that is the base case. But as I was alluding to when I was speaking to Guy there, it's quite possible that the equilibrium rate of unemployment in the economy, so the rate of unemployment that neither speeds up nor slows down wage growth, has risen for a number of different reasons, particularly the way the pandemic has changed the labour market. And that will mean that if we're in a world of the unemployment rate falling in the second half of the year, we're moving further away from that point at which the Bank of England can turn around and say, look, we're at an unemployment rate that is consistent with 2% inflation.
How big is the labour? Do we have any idea how big the labour market, the underemployed, the out of the data labour force is that could come back in? Say you were to see a significant change in the health of the country, or how big is that number?
It's going up towards 1 million now. If you look at the pre-pandemic trend and sort of where we are with the participation rate now, there is a huge gap there. Numbers vary. You can do a smaller.
How sensitive is that number?
It's very. Month to month, the participation rate is extremely volatile, and that's one of the things we've seen this morning. Is the participation rate fell again, and I think as the evidence mounts, and this goes again to the point about the equilibrium unemployment rate, the evidence is mounting that these people are permanently out of the labour market. Right. So trying to get them back, and the idea that they'll be brought back in for whatever reason, I think that's becoming increasingly difficult story to tell. And that obviously means that's a labour supply story. So weak labour supply, it means labour demand needs to be weaker to keep wages suppressed.
And what's the latest thinking, to Guy's point about the health of the nation? What's the latest thinking about it? Some of those people are off because of sickness. Some of them are caring for other people. What's the latest sort of economist's view of what makes up that million?
Well, you're absolutely right. You've got the health side of it, and you've also got workers who took early retirement. Now, if you ask me, you've got those two groups of people. It's very difficult to set out a policy agenda. I know the previous government tried, but it's very difficult to set policies that drag those individuals back into the labour market. So going to Guy's point, it doesn't feel like a cyclical thing that we're going to get this big uptick in the participation rate that sort of saves the labour market, if you like. this is a sort of story, but not just about labour demand that's staying relatively robust, but it's also a story about weak labour supply.
And then you fold in the immigration story into that as well. There's all kinds of complicating factors. Dan, great to see you. Thanks very much indeed, as ever, for stopping by to update us. What else are we watching out for the rest of this week? So 10 a.m. we get UK, Euro area, we get the 10 a.m. UK.
That's the time.
That's the time.
Yep.
You get Euro area, you get the ZEW survey coming out, which is going to be one you want to watch out for. From Germany, you get German 2-year auctions. We've got 5 billion going out the door. You've got PPI data, which I'm really looking forward to. Home Depot is going to be fascinating. We can talk about hardware stores tomorrow. Very exciting subject. 6:15 p.m. Bostic's going to be speaking at an event a little bit later on as well.
I won't be on the show tomorrow. That's not because you've promised to talk about hardware stores.
I'll come and see you. Don't worry.
Excellent. We can have our own off-record chat about all guys shopping in hardware stores. Oil prices still on the back foot. We're keeping a close eye on what's going on in commodities. We talked about it a few times during the programme. The fact that we've been up for 5 days. Geopolitics certainly a concern. A little bit of a concern around the demand story as well. Seems to have been weighing. Seems to have been keeping oil prices moving higher of late. And today we pull back.
So there is imminent action expected in terms of the Iranian response. How does the oil market respond to that? I don't know. Maybe that's the story for the next 24 hours. Certainly everybody seems to be accepting that this is becoming closer and closer in terms of when the Iranians are going to respond.
So the key ones to watch on that front, I think, is that spread that you're seeing between Brent and NYMEX. It is still just about $2. That is a historically low difference at a time when you're, in theory, should be pricing in geopolitical risk. So that's one we watch. Then, of course, plenty of that data over in the States as well. A 4% number on the 2-year yield. Does that stick in the next 24 hours? Coming up next on The Pulse, Bloomberg speaks to the IEA's head of oil markets, Toril Bossoni. She's going to break down the risks, the pricing, all that up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
European stocks gain as investors wait for U.S. price data that may give more guidance about the Fed's next moves. Oil and gas prices cooled despite increasing tensions in the Middle East and Ukraine. We discuss the energy outlook with Toro Bozzoni, head of oil markets at the International Energy Agency. Plus, despite tech delays, Elon Musk pitches a role for himself. Should Donald Trump win a second term in the White House during a lengthy interview on X? So we have you covered for all things geopolitics and politics. But first thing is first, let's take a look at the European markets map. This is a picture across the board. Now, we're seeing gains. I know the FTSE is quite tentative. We're getting some data, and that will, of course, form the thinking in what the BOE does next. The CAC 40 gained some 0.2%. Similar move for the FTSE MIB. Now, European stocks in general seem to be rising, tracking gains in Asia. Again, investors awaiting some U.S. price points, some of the price data that may provide guidance about the Fed's policy ahead. Cross-asset, I'm looking at S&P futures gaining some 0.4%. The U.S. 10-year yield at 3.9073. Sterling 128.07. We look at not only employment, but also the level at which services is accelerating, and finally Brent crude 81.85. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a lot of the focus, of course, has been on the markets over the last 10 days. There's been a lot going on in terms of volatility, so it's a good time to take stock and just to look at what some of the futures in the U.S. could tell us about what's happening ahead. So let's look at the markets. Look, if you look at European stocks for the moment, they're gaining a little bit, but again, the focus will be on what central banks will tell us with some inflation reports and, of course, with some jobs data as well. This is a picture for the S&P futures getting some 0.5%. The focus is firmly also in the UK because we've had a number of people coming on to talk to us about what the rate path ahead for the BOE is. So UK unemployment actually has dipped unexpectedly. This is another sign that we needed. Yet the economy seems to be holding pretty well. The jobless rate falling some 0.2 percentage points to 4.2% of the 3 months to June. That's according to the ONS. Economists had expected a smaller increase. Now, employment surged by 97,000, much stronger than the 3,000 increase that forecasters had expected, and then wage growth slowed in line with expectations. A couple of the other things we're watching out for. I just look at the week we've had. I know we're Tuesday. It feels like Monday 10 days ago was about 30 days ago just because of the dips. And so we're now seeing quite a lot of the big money players saying, look, is now the time to come in and come back into this volatility in the markets. After last week's turmoil, markets are focused, of course, on consumer price index from the U.S. That's tomorrow to see if the Fed will have a freer or more constrained hand in to secure a soft landing from the economy. Now, we also look at crude oil prices. Again, if you look at the recent rally that we've seen there, it's definitely put the spotlight on producer price numbers later on Tuesday. That's later today as an indicator of pipeline inflationary risks. So European stocks in the green this morning, tracking gains in Asia. This as investors wait for U.S. factory price data that may provide, as I was saying, guidance about the Fed's policy path ahead. So for more on all of this, let's bring in Beata Manthi, Citigroup's head of European equity strategy. Beata, as always, thank you so much for joining us. What a week. I mean, it was like a crazy 10 days.
Pleasure to be here. What a week, what a month, what a summer, right?
What have we learned? I mean, how much of it is a carry trade? Are you concerned that these type of events where actually everything, I don't know whether it's panic or there's fear grouping the parmex, could happen again?
There were a few issues that coincided at the same time, right? So we've had fundamental economic reasons to worry about the economic slowdown out of the US. To be fair, it started already a few months ago. The market just decided to ignore it, right? And then, of course, we had Bank of Japan and lighter volumes. And here we are, a 10% correction in the space of very few days. But going forward, so we have seen reasons to be worried about increased volatility already in July, right? And most of these reasons have not gone away. So going forward, of course, the market looks much more reasonably priced. We can talk about that. But these worries are still there. So the war's probably behind us, but I do worry that we could have a volatile month and autumn ahead of us as all these worries clarify and we'll know more about what's the path forward.
So, Beata, I mean, and there are a number of investors that said, look, this is the right time to buy the dip. I mean, would you recommend, I know you also have this narrative of actually 6, 7 great companies in Europe. Some of them have lost quite a lot in the last 10 days. Is now a good entry point?
So, starting from the top of the market, for Europe, we have this model that tries to capture what kind of EPS outlook the market is pricing in at each point in time. And it is important because, as we've discussed, core of the worries was about slowing down in the economy and therefore in the EPS. And indeed, we've been seeing some downgrades from the analysts happening for the last few months. So the analysts' forecasts have been at risk, right? So what this model was telling us for Europe a month ago was that the market was pricing in an outlook for EPS of around 15% growth, 5% above 10% of analysts' EPS growth. Right now, it's 5%. It's not a slowdown. It's not a recession pricing. Definitely not there yet, if that's what the market decides to worry about. But we've opened up a buffer now for downgrades if indeed we are facing a bit more challenging macro ahead.
Where does that challenge come from? Again, there's concerns about the U.S. economy. Are we underestimating the impact that a lower Chinese or disappointing Chinese economy could have?
So for Europe, actually, we've had lots of positive catalysts, right? Of course, the upgrades, the improvement of balance of risk globally, the rate cuts, China reflation, and bearish positioning earlier in the year. They were all telling us buy Europe, and we were buying Europe, right? But it's just striking that all these tailwinds have turned into headwinds now. So it's not just one factor that worries me about Europe ahead. One positive, as I said, is that it's much more reasonably priced. So perhaps pricing in 5% EPS growth, half of what the analysts are expecting, could be enough in the right set of scenarios.
But was Europe already cheap before this correction?
No, it wasn't. If you look at valuations relative to the US, of course, it was cheap. But I don't like to look at the markets just from the valuation perspective. So our what's pricing model have valuations in it, but it has many other factors, and rates being also one of them. So it's rates adjusted. And I think it gives you a better feel of what kind of outlook the market is envisaging.
Beata, if you look at, again, outside kind of overseas factors, I mean, we have a big U.S. election, we have the China macro, we have a number of possible trade wars and tariffs. I mean, there's a lot of things that could actually impact Europe without Europe having much of a say.
Absolutely. So geopolitics, we have this geopolitical risk premium model that tries to capture what kind of first of all, how high these risks are, and secondly, what kind of sensitivities different equity markets have to the increase in these geopolitical risks. And within developed markets, sadly, Europe is one of the most sensitive to the downsides, right? So if you think that there are going to be higher risk through geopolitics, Trump, of course, tariffs worry me, even if there are no tariffs on the broader world, even if there are only tariffs on China. This is going to have a deflationary effect on the European economy because we'll have a substitution effect, so more imports from China that could otherwise go to the US, right? So not great outlook, not a disastrous outlook, definitely. Market has just gone ahead of the bad news now, so that's a good thing. But we are really watching every data point coming out of the US and out of China, and of course how it impacts the European economic variables as well.
But I mean, it's quite, for me, it's quite surprising that we've talked about, the gravitational pull from the Fed and the US, and actually we're looking at one cut in September. I know the market got ahead of themselves in a possible cut before, actually this week or last week. That didn't happen. But how does a gravitational pull of the Fed, what does that mean for the ECB going forward?
That's a very good question. So the market is now pricing in more cuts out of the Fed than out of the ECB, right? That's an interesting setup, and let's see whether that's going to happen. Now, from City Economist's standpoint, we actually expect a bit in line with the market for the US, and for Europe, we expect another 2, perhaps 3 cuts out of the ECB. So still a lot to be seen how steady the course the ECB will hold if indeed Fed, through weakening economic data in the US, is forced to do more than we thought it would be the case beforehand.
Beata, thank you so much. Beata Manthi there from Citigroup stays with us, and we'll talk a little bit more about these pockets of growth and potential tactical playing. Coming up, talking politics, Elon Musk interviews Donald Trump and pitches himself for a potential role in a Republican White House. That's next, and this is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Next week, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments.
Vice President Kamala Harris closing the gap with Donald Trump.
And informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in all next week on Bloomberg Television.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Elon Musk has pitched himself for a role cutting U.S. federal spending in a second Donald Trump administration. The billionaire Tesla boss spoke to the Republican presidential nominee in a 2-hour conversation on X.
I think it would be great to just have a government efficiency commission that takes a look at these things and just ensures that the taxpayer money, the taxpayers' hard-earned money, is spent in a good way. And I'd be happy to help out on such a commission.
I'd love
if it were formed.
Well, you're the greatest cutter.
Well, our senior editor, Bill Ferries, now joins us from Singapore. Bill, I mean, it was meant to last 40 minutes. It was 2 hours long. There were quite a lot of glitches. At times, it was like Musk was pitching for a job. There was some, strangeness about the Time cover magazine. But what did we actually learn about, budget cuts and policy?
Yeah, and the two men at times were kind of talking over each other a little bit, trying to get their points across. But it was in general, a very friendly discussion. And as you played there, Elon Musk at least 2 or 3 times kind of kept raising this idea of a government commission to look at how U.S. federal money is spent. That's not such a new idea in Washington. Those things have come up over the years. But it did show his willingness to serve in some capacity in the Trump administration. If you were around for the first round in 2017 to 2021, you'll remember Elon Musk was part of a CEO panel that Trump convened in his first year. And that kind of broke apart by late 2017. Musk was one of the CEOs who quit that panel over his frustration about Trump quitting the Paris Climate Accord. But there were 4 or 5 other high-profile CEOs at the time who left within a span of a few weeks, and Trump ended up dissolving that commission. But he seems to be back in Trump's good graces and willing to work with him if he wins in November.
So who got more from this exchange, Trump or Musk?
Well, it was a rough start. It was almost 40 minutes of glitches that delayed the start of this. But, Musk did get to have Trump back on his on X now. Was Twitter the last time the president was really involved in it. So that is a win in terms of just traffic to the site. The conversation between those two peaked at 1.3 million. It also allows former President Trump to reach an audience that is many of whom are not members of his Truth Social website. That does not have nearly as many followers as X does at this point. So I think both won to some degree, although I think the technical glitches at the start are probably a bit of a headache for Musk and his team over there at X.
Yeah, didn't they say, Bill, that they were hacked or that there was some kind of nefarious, actor or actors in this? And do we know how many people listened to the conversation?
Well, you're right. He said Twitter or X has said that there was some kind of a hack. We don't have any details on that. You may remember when Governor Ron DeSantis of Florida announced his presidential run. It was done on X, and there were a lot of glitches associated with that. It took, I think, over an hour to really get going. So it's not clear if it's a hack or just some technical issues with X itself. According to the company, 1.3 million tuned in at the peak. So that would be a pretty good audience. Of course, that's kind of an international audience, so we don't know how many of those are American voters, and we don't know how many of those are American voters who are persuadable for the Trump camp in November.
Yeah, it's unclear whether Musk gets the job on the back of this is if Donald Trump gets elected. But, Bill, what did they touch on geopolitics-wise?
Yeah, they did touch on some of the hot spots, Ukraine, the Middle East. Former President Trump name-checked Vladimir Putin, Kim Jong-un. He said, and Xi Jinping, actually, he says he knows them all. He says things like this potential attack by Iran on Israel that the U.S. has been warning about. He said that would never have happened if he were in charge, that Iran was poor and weak when he was president. So he did try to touch on some of these things that he sees as a crisis in the world, and claims that none of this really would have happened on his watch.
Bill, thank you so much. Bill Ferry's there with the very latest on Musk and Trump. Plenty more to come. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, still with us, Beata Manthi, Citigroup's head of European equity strategy. Beata, you were basically saying that because of the rocky couple of weeks, we probably have some more realistic earnings per share outcomes. So what does it mean when you look at Europe? I mean, do you invest in certain sectors that, have had a correction, or is it really opportunities despite tariffs and trade wars?
So let's start with earnings. European earnings have been the most upgraded around the world until June, until the French election announcement happened. Since then, through all different risks emerging, it continues to be one of the most downgraded regions. And putting this together with the macroeconomic worries of at least a slowdown, right, tells me that the market should be concentrated on earnings delivery. So we like sectors where momentum is strong, where earnings continue to project higher. And for us, over compound basis, this and next year, that's how we look at it, and also at short-term earnings momentum. So our overweights right now in Europe include tech. We continue to like healthcare. And within financials, actually, we like financial services more than banks, and this is exactly where both earnings momentum and the strength of the rebound is the most pronounced. On the downside, more cyclicals. So we've downgraded everything around July. Well, some cyclicals like autos we've had as an underweight for a few months, but we've downgraded industrials mid-July, construction, basic resources from neutral to underweight. So it is pro-growth, more skewed towards defensive growth and defensive earnings, away from very cyclical earnings outlook for now.
Beata, when you look at, I guess, some of the things that have been trying to reprice, I don't know how much of European earnings come into this. I mean, it feels like if you're disappointed, you are really slammed by the markets. And so are expectations a little bit too high on how quickly these companies can grow and put revenue up?
Absolutely. So the market sell-off was quite orderly outside of Japan, where everything has gone down, right, irrespectively of what the earnings story is. So to us, and according to Citi stock analysts as well, tech was quite a standout. So, also, first of all, from the earnings perspective and the prospects for the European tech sector, but also from the bigger macro point perspective, that if you worry about growth, you do buy into growth. You buy into these fewer parts of the market that are still providing growth.
Do you buy any European, I mean, do you buy any French companies, given that actually there's still a big question mark? I mean, they had fantastic Olympics, and then we go back to kind of trying to find a viable government.
Absolutely. So these political risks in Europe filter in more into the outlook more than in the US, for example, right? So with the French, the downgrades in France has started already ahead of the announcement of the election, and then just continued. It is the most downgraded country within the major European countries. So that momentum, we haven't seen a turn in that momentum yet. For us, France in the country allocation model is a neutral. We are within the big sectors in CAC 40. We are neutral industrials, and we are neutral luxury goods, and we are underweight autos.
Beata, thank you so much for a terrific roundup of some of the things that we're seeing in the markets. Beata Manthi from Citigroup. Coming up, bouncing back, UK unemployment catches a few off guard by unexpectedly dipping in the second quarter. We'll crunch the numbers next, and this is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. These are your top stories. European stocks gain as investors wait for U.S. price data that may give more guidance about the Fed's next moves. IEA data shows global oil markets are poised to swing from a deficit to a surplus next quarter should OPEC Plus proceed with plans to boost supplies. Plus, despite tech delays Elon Musk pitches a role for himself should Donald Trump win a second term in the White House during a lengthy interview on X. Now, here in the UK, the pound rallied 0.3% after unemployment fell unexpectedly after companies went on mini hiring sprees. Now, the jobless rate fell 0.2% to 4.2% in the second quarter. Now, 97,000 new jobs were added, which was much higher than economists had forecast. So for all of the news on the UK, we're now joined by Ellie Henderson, who's an economist at Investec, and Dan Hansen from Bloomberg Economics. So again, jobless rate falling 0.2 percentage points. Ellie, when you look at, I mean, it's happy days. You know, we were kind of worried about the economy. We have the cuts, and now unemployment's a little bit stronger than expected.
Yes, it was an unexpected fall, as you said, to 4.2%. And from an individual's perspective, this is great news. As you said, the sun is shining, the unemployment rate is lower. But for the Bank of England that's worried about domestic inflationary pressures, they may be concerned by this print. But the report was mixed. We also saw a rise in the claimant count, so people claiming unemployment or unemployment-related benefits. But the ONS did note that some of that was due to changes that the government made around eligibility criteria. So I don't think we can take a clear signal from these numbers of the state of the labour market just yet.
Yeah, so what are you waiting to see, Dan, to make sure that actually it is on a path that's not just like a blip upwards, but actually a trend upwards?
In terms of the jobs market?
In terms of the jobs market.
Yeah, I mean, I think there are a few things. So the first is that the unemployment data we know is a bit sketchy. So we're going to have to see quite a bit of it to be convinced that it is a signal and not just noise. What I would sort of place it alongside is what we saw today on the vacancies data, which is continuing to fall, but it is sort of, there's a bit of a sign of a levelling off there as well. Payrolls continues to grow, but it's weak. So I think you can't yet throw out the story of a gradually loosening labour market. And as Ellie said there, we had pay growth numbers, they continue to come down, and that's a signal about the state of the labour market. But I think if you move into the second half of the year and the economy continues to hold up, we're talking about the sun being out, you know, the UK economy has been growing 0.7% a quarter, 2.8% annualised. That is really fast. And against that backdrop, over the past 15 years, the labour market has always tightened. It's never loosened because productivity growth has been so weak. The firms have had to take on more labour to produce more output. So it's going to be interesting as we move into the second half whether this loosening labour market story continues to hold or whether actually we get a move in the other direction. And obviously that will have significant implications for what the bank is able to do in terms of rate cuts.
But Dan, first of all, I mean, there's some investors that are basically looking at these figures and saying, look, it's potentially inflationary, or it's a potentially inflationary sign on the economy. But actually, is it really just at the margins? We're also waiting for that budget, which is why, you know, at the last press conference, Governor Bailey seemed very tentative in trying to manage expectations.
Yeah, absolutely. So, yeah, I mean, at the margin it is, but I think you have to place it, as I say, in the context of the volatility in the data. I mean, reading it straight off, the Bank of England said a couple of weeks ago that the medium-term unemployment rates, the rate of unemployment that neither speeds up nor slows down wage growth, has risen. So we've essentially got further from that. So, yes, straight read, it is potentially a little bit more inflationary than the Bank of England were hoping. But I think if you read it through to the inflation numbers, if you're going to get, it's not going to be more than a rounding error. So I don't think we need to sort of completely throw out our priors just yet. You're right that the budget could be a much bigger event. We know there's 16 billion, at the moment at least, 16 billion pounds coming in extra borrowing this year. We found that out just before the Bank of England's decision. So the big question really will then be, over the next couple of years, how much of that is brought back in terms of tax rises and the fiscal stance over the next 3 years? Because, yeah, it's fine to have a fiscal loosening this year, but if you take it all away in subsequent years through higher taxes, that means demand in the economy is probably not much different, and therefore the inflationary pressure in the economy is not much different. So they need to see the whole picture before they can make a judgment on that.
Yeah, it's difficult, again, passing judgment before actually seeing the budget numbers, which is what, you know, Governor Bailey said over and over and over again.
Yeah, definitely. And on the labour market report being inflationary, I think it's also worth talking about the wage numbers. Yeah. On the headline measure, the total wage growth, we did see a sharp fall there, which again, for individuals that are struggling with the cost of living, isn't great, but from an inflation perspective, is what the Bank of England wants to see. But on those total pay numbers, the headline probably overstates the story a little bit. Last year, we had big one-off bonus payments to NHS staff. This wasn't repeated this year, and that pulled down the headline number. But what the Bank of England will be looking at is private sector regular pay, which strips out the public sector, it strips out bonuses, and it has a more direct link to inflation. And that saw a moderation too, which supports the case that actually it may be appropriate to cut interest rates once more again this year, which is our base view.
So one more by what, 25 or 50?
One more 25 basis point cut in November. We think from the last meeting, it showed that there's no rush on the committee. There's still very divided thoughts. 4 members didn't want to cut in August, 5 members did. And a lot of it comes down to the fact that services inflation is still very sticky. We've got goods price disinflation doing a lot of the work at the minute. Can we rely on that going forward? Possibly not if shipping costs rise like we're seeing, or we're moving into a more protectionist world. So the Bank of England really wants to see that services number come down.
Dan, at the same time, and I know again, the Bank of England pushed back a lot against this gravitational pull on the Fed, but actually, given all the market turmoil, we were talking even about an emergency cut from the Fed last week. I mean, if the Fed were to cut a lot more than expected, or certainly if they were even to cut, as much as the markets are expecting, what does that mean for BOE?
I mean, history tells you they can disconnect. So that's, if you look at the 2 cycles, they can disconnect. I think one episode in history where you might sort of read across to today is what happened in the early 2000s. So the Fed cut aggressively because the US economy went into a relatively shallow, but it went into a recession. The Bank of England cut, essentially put in some insurance into the system. The economy didn't go into recession, but it was worried about what might happen to the UK economy, because the UK is a small open economy. What happens in the rest of the world clearly matters. So I think it's possible that the bank sort of is a little bit influenced by what's going on over at the Federal Reserve, particularly if they cut rates aggressively. But equally, inflation is, as Ellie's just said, like inflation is still very, very high, particularly in the service sector, and that is a real constraint on what the bank can do. So you might get one more. If you're thinking about the path this year, investors are looking at maybe 2. I agree with Ellie; they'll probably do 1. If the Fed goes really aggressively, you may get 1 more from the bank, but I just don't think they want to set this tone of we're going meeting by meeting. I think they want to stick quarterly, use that monetary policy report press conference every time to explain their thinking. There's just no rush, because this is about normalization. It's not about responding to a recession or whatever it might be.
And Ellie, I guess away from the Bank of England, I mean, this country needs growth. If you look at, the U.S. with the weak U.S. labor market, also this anemic euro area GDP growth, could the U.K. become the new investment destination for foreign investors?
We're certainly optimistic on the UK. We've seen renewed sentiment over the UK's outlook. And actually, our GDP numbers have been relatively healthy. We have the next update for June this week that will complete the picture for Q2 as a whole. And we see another 0.7% print on the quarter. By all means, this is quite healthy. We've got some constraints on growth in June, being the junior doctors' strikes, and also we had weak retail sales print. But overall, it is a robust pace of growth and does show off the UK as possibly a place to invest.
How much can growth, I mean, what's the best case scenario for growth in the UK? I know Keir Starmer in the campaign mode, probably because he was pushed, said 2.5%. I mean, that feels very optimistic. And they haven't actually, gone back to confirm that's what they're aiming for.
It does seem on the top side of estimates. By all means, it's not impossible. We've seen the AI boom. If that can translate into higher output, then it's not out of the question. But like I said, we think it's probably on the upper side, especially if we are, as Rachel Reeves has hinted, going to get tax hikes in terms of the October the 30th budget. So I think that's going to be a key event for the UK outlook.
Yeah, it certainly will. And so growth, what's Bloomberg Economics expecting?
So we think the trend rate of growth is about half what Keir Starmer sort of said at the 2.5. He said 2.5% during the election campaign. We think it's probably about half that. One thing I think is really interesting is that the OBR, I would argue, has a relatively optimistic outlook for growth over the next 5 years. And so the risks there, I think, in terms of the fiscal picture, so the OBR is the UK fiscal watchdog, thinking about the fiscal picture and how much of a benefit sort of the growth we've seen over the past 2 quarters will translate into a higher level of output permanently and a higher level of tax receipts permanently. I think the risks are that they've deemed that as sort of a cyclical one-off, and they're going to take a look at their views about productivity growth, because to me it looks a little bit optimistic given what we've seen over past history. And I think the risk for Rachel Reeves is that the OBR hands her some bad news on the economy as well in terms of the medium-term growth outlook. So they've had this sort of sugar rush, this honeymoon, or whatever phrase you want to use. But I think the medium-term picture still needs a lot of, it's still relatively sort of benign.
All right, thank you both for joining us. That was Ellie Henderson from Investec and Dan Hansen from Bloomberg Economics. Coming up, the U.S. warns Iran could attack Israel as soon as this week as it deploys more firepower to the region. We get the latest next, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the U.S. believes an Iranian attack against Israel has grown even more likely and may come as soon as this week. That's according to officials. This comes as the West seeks to stop an all-out war. Now, for more, let's bring in Ross Matheson, Bloomberg's EMEA news director. Ross, so we're waiting for this possible Iranian attack, and that's continuing. I mean, we've been alerted for the last 10 days as to something happening. Is the intelligence now pointing to something bigger or just imminent?
It's interesting because, as you say, we're almost 2 weeks after the death of this senior Hamas official in Tehran, which Iran blames on Israel. I mean, Israel's never formally accepted responsibility, and Iran's been saying every day since then, we are going to do something. We have to retaliate because this happened, you know, embarrassingly for Iran on its own soil. And they've been saying it, nothing's been happening. So people are starting to wonder, you know, what conversations are going on inside Tehran about this. What the US is saying publicly is their intelligence, obviously, is pointing towards something still coming from Iran. There is the intention there, obviously, to retaliate. What we don't know is what that's going to look like. I mean, the US said it could come in multiple forms. It could be a direct strike by Iran on Israel. Again, what kind of targets? Military targets, infrastructure, unclear what we're talking about. Is that accompanied by actions by Iran's proxies in the region, Hamas, Hezbollah and others? Is it simply the proxies do something? It's still very unclear what the nature of the retaliation might be. But the US is saying very publicly, at least what their intelligence is picking up, is that something is coming and soon.
Roz, I mean, of course, it's a very delicate time because then it means that this could escalate quite quickly. Is the US also putting more firepower in the region?
Well, they are. So they're expediting the movement of a carrier group. This is the Abraham Lincoln, and a strike group was already going to the region, and what they're doing is telling it to get there faster. They also took the kind of unusual step of announcing that they're sending a submarine to the area that can carry Tomahawk missiles, more than 100 of them. They usually don't publicise the movements of their submarines, and what they're doing in saying that is they're telling the world, including Israel, to keep their jets cool in all of this. They do not want this spiralling into a broader conflict, but also sending the message to Iran that they're there to help Israel defend itself. And they're putting their military firepower in the region to do so. So, publicising the movements very clearly to send that message to the region that they don't want a broader war, that they're there to defend Israel if needed, but also just the reality of having so many military assets in the region does in itself potentially raise the risk.
But Raza, again, do we understand Iran's intent? Do they want an escalation, or domestically, do they just need to be seen as doing something?
Very much they need to be seen to be doing something. It's interesting, almost every time an Iranian official has said, we need to retaliate, we will retaliate, there comes a but after that, which is, we're going to act within the bounds of international law, whatever that means, but we don't want this to escalate into a broader conflict. So there's always we need to do something, however, we also don't want this to spiral. So it's very much twin language we're getting from Iran, and it's very clear they see, for their own interests, they don't want a broader war either.
Yeah, and of course this complicates things with, a possible deal with the hostages. What about Russia? Russia and Ukraine, which is the other kind of hotspot we're watching here.
Well, it's fascinating to see that Ukraine has made this incursion into Russia, and they've actually moved into quite a bit of territory along that border area, and it's very embarrassing for the Russian President, Vladimir Putin, to have this happening. Yesterday, in fact, he cut off the regional governor who was talking on TV detailing the number of towns that Ukraine had taken, and Putin kind of cut him off mid-speech. Obviously, he's having to manage that situation at home. The real question is, what is Ukraine intending with this? What's it about? What's the tactic here? Is it simply to show that they can do something on Russian soil, is to send that message to Vladimir Putin? Is it to form a buffer around their border area to stop, masses of Russian troops still coming in? Is it for some other reason that we're not sure about? It's very unclear what the intention is here, and that might tell us where the war is going as a result. I mean, it's tactically very bold of Ukraine to do this. They're also, though, possibly burning through manpower themselves with this incursion. They're stretching their defensive line into an offensive line also. So they're also suffering some losses here. And can they sustain it? The question is, how long are they intending to do this for?
So interesting, Roz, with always the good questions. Roz Matheson there, Bloomberg's EMEA news director. Coming up, Elon Musk has a message for Trump supporters who are skeptical about EVs. We'll have the details next. And this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown. If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Earnings season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs, taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
So Elon Musk is encouraging Donald Trump supporters to embrace EVs and sustainable energy. Now, the Tesla founder made the comments during a long conversation with the Republican presidential nominee last night. Craig Trudell, Bloomberg's global automotive editor, or we like to call him our card czar, is here, and he joins us now. I mean, it was a fascinating conversation. It was meant to be 40 minutes. It went 2 hours long. I mean, I'm not sure what they each wanted from each other, whether Elon Musk just wanted to sell EVs or pitch for a job or just give him a platform.
He did both of those things, and maybe it is sort of in all of the above. I think he also very clearly wants Trump back in the White House. I think he has long been a believer that government should get out of the way, except, of course, when it is offering help to companies, and he wants in on that help. So, you know, he did absolutely pitch this idea of sort of a commission on things to get rid of, and, you know, offered, you know, to play a role in the setting up of that. And I think that's where his pitch came from. But also he was in sales mode with electric vehicles and wanting to kind of speak to Trump supporters and Trump fans of, you know, a case for, you know, you can have your electric vehicle and eat your steak too, and you know, came prepared with a pitch for buying electric vehicles without, you know, necessarily doing so on environmental merits.
But so how tough is that? Because it feels like the culture wars are real. You know, it's a divided society, and, you know, there's many question marks about EVs and climate change. It's almost like if you're a Republican, you can't really be for those.
I think it's fascinating because Trump himself has been, you know, one of the loudest voices, you know, speaking to this idea of, well, you know, electric vehicles, they're okay, I guess, but, you know, you have to plug them in, they run out of battery, you know, they're just not any good. And lately he's offered a little bit of praise with Tesla mixed in with that, but he hasn't really strayed from that messaging. So, you know, maybe Musk is trying to sort of bend that those talking points a little bit and get Trump off of that messaging and towards something more productive for Tesla.
Okay, Craig, thank you so much. We have to get you back on also to talk about Elon Musk and the UK and the riots, which was another story. Craig Trudell, our global automotive editor. Now, global oil markets are also poised to swing from a deficit to a surplus next quarter should OPEC Plus proceed with plans to boost supplies. Well, that's according to IEA data. Let's discuss with Bloomberg's Al Nightingale. Al, thank you for joining us. So we have this report. It came out. What did it tell us about supply and demand issues in the global oil markets?
Well, it's as you said, there was this kind of proposal to add a little bit of supply, which people took as a sign that maybe, I guess, OPEC was, you know, the end of these kind of supply moves had to come, and that they would have to start to add barrels back to the market. And it shows that that's still a tough thing to do. So we just need to see how this plays out, but I think it will be pretty tough for OPEC to do this, and the IEA is making that clear today.
But Al, at the same time, I mean, unusually, right, this growing demand in developed economies, such as the U.S., which is growing stronger, has really been compensated, for example, for slackness in China and other emerging nations. So is there almost a natural hedge at the moment?
Well, I mean, I think when you have concerns about China in the oil market, it's very hard to do anything in the way of adding supply. You know, China has become the engine of demand growth for many, many years. And when you've got those kinds of worries, you know, you really do need to see some kind of strength there and some kind of have some confidence that things are going to be okay in China if you want to start adding barrels. At the same time, within OPEC, there is this kind of requirement to think about how you're going to get out of keeping barrels off the market. You know, the US is going from strength to strength in supply and taking share of the supply picture. So that's something that's going to be kind of a constant watch for OPEC Plus.
Yeah, I was going to ask you, what are you expecting from OPEC Plus?
Well, I think that, you know, as the IEA is acknowledging today, it's going to be hard for them to add supply to the market, and I think that it will be tough for them to do that unless you start to see a better price picture going into the fourth quarter. So, you know, yeah, it's just going to be a tough ask to add supply back.
Al, thanks so much. Alaric Nightingale there, Bloomberg's Europe Oil Markets editor. Now, a couple of things that we're watching out for, of course, is some of the data, not only in the U.S., but we have European data a little bit later on. When you look at some of the biggest things in terms of that data, let's get the U.S. futures up. If we have those, it'd be great to show them, just to give you a sense of where we are right now. Again, Wednesday's U.S. Consumer Price Index will be the big one that may help determine whether the Fed has room to secure a soft landing for the economy. Up next, Bloomberg Brief with Manus Cranney in New York, and this is Bloomberg.
Make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that you know most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's set your agenda. Markets steady ahead of the PPI. This as the New York Fed survey flashes a drop in inflation and credit outlooks. Prepare for significant attacks. The U.S. warns as world leaders pressure Iran to refrain from striking Israel. A cozy confab. Elon Musk pitches for a role in government to Republican nominee Donald Trump in a glitchy conversation on the social media platform X. A very good morning, cozy conversation, and maybe even a warming by the former president towards electric vehicles. NASDAQ is up 0.5%. It's a kind of situation of where do you look for risk? The headwinds from the price of crude yesterday spiking by over 4% in the United States of America, as again tensions over what is the Iranian reaction function to Israel. So that spike in oil prices was a temporary headwind to some of these equities. Nvidia, just keep an eye on a couple of different things. Russell, at the moment you've got the Russell down over 8% for the month of August. Nvidia is up as Bank of America say, look, this is one of our top rebounds. There you go. Russell comes back to unchanged. Again, it comes down to the narrative of what do you get from the PPI today, from the CPI tomorrow as the New York Fed say inflation expectations on the 3-year basis are trending lower, and access to credit, and this is critically important, the access to credit, that is deteriorating as well. As I mentioned, the oil prices, OPEC cut their daily demand levels yesterday, but this rally in oil prices took place with the hedge funds being the least participative in this market since 2011. In other words, the least long since 2011. So you get a rise of over 4% without the hedge funds. That is malevolent. Taking you to the bond market again, we're counting down to PPI plus 0.2%, but the bond market is the reaction function. It is the hedge for, it is ground zero for hedging, and that's what you saw last week in the equity market sell-off, and indeed yesterday as the Iranian tensions bubbled on the price of oil. So we'll keep that in mind. Real rates are still tight. That's UBS's view this morning as we count down to the PPI for the industry of America. Real rates are at 3%. As I say, it is a big week for economic data. Callum Pickering, the chief economist at Peel Hunt, writes this. Central bank policy errors are the key downside risk facing major economies. While a moderation in the US momentum remains our base case, the risk of a hard landing has grown. Callum joins me now. Good to have you with us. Can you put some context around this call, Callum? Good morning. Good to have you. This is one of your first major pieces at Peel Hunt. You are talking about the risk of a hard landing, yet I look at the Atlanta Fed GDP, I look at the other indicators which show me a robust United States of America, a strong economy. Yes, unemployment is rising ever so slightly by 0.5%, but why have you shifted to the risk of a hard landing? Good morning.
Good morning, thank you. The US markets are uneasy. They've been uneasy for a while, but the US has been a great source of stability and confidence. We have been waiting for this slowdown in the US economy linked to tight Fed monetary policy. As you mentioned, the Atlanta Fed for Q3 still looks pretty strong, actually well above the FOMC's estimate of US potential growth. So we have this puzzle where we expect things to slow, and yet the data keep telling us, actually, not quite so fast. My worry here is the US is a highly cyclical economy. Confidence can matter a lot. We've had the tightening of financial conditions in markets as a result of the equity sell-off. And so I wonder if after this 2-year period of the US growing above its potential rate, things just moderate as a normal course of a cyclical slowdown. And then the question is, how much does it slow? Does it slow enough for the Fed to say, we can forget about inflation for a while, we can cut rates and support risk-taking? Or is it not quite slowing enough for the Fed to be eager with its monetary easing? That probably is the worst scenario for markets, and that's where that hard landing risk starts to increase.
Now, look, you make it very, very clear that you are a buyer of the Psalm rule. In other words, that propulsion higher in unemployment. You're also a proponent of observing the inverted yield curve, which disinverted ever so slightly last week. That then takes me to, we've got 3 meetings. We're pricing in 100 basis points of cut. That suggests to me a 50 basis point cut at one of them. And many people are saying, look, that's way too much. Torsten Slok is saying, again, the market is mispriced in terms of rate cuts. You're not going to get that 100 basis points of cuts before Christmas. Given the various pillars that you look at, do you think 100 is fair?
No, I think 25, 25, and 25 sounds reasonable. I thought actually the Fed may do what the Bank of England and the ECB are likely to do, which is cut and then skip, cut and then skip. But probably the balance of risk now favors just a continuous 25 basis point shift down, at least at the next 3 meetings, and then probably heading into next year. What makes me nervous, as you mentioned, are the two indicators, the yield curve inversion, the SARM rule. These historically are much better than economists at predicting US downturns. Now, we don't need to do big intellectual backflips to try and explain these away. There's lots of weird stuff going on in money markets as we adjust to a more normal, I would say emphasize more normal inflation and rate environment. And so it's possible that actually the short end and the long end just don't agree on what the underlying balance of inflation risk is in the US. Okay, we put that to one side. When it comes to the SARM rule, in a more inflationary environment, you might say, actually, the natural rate of unemployment just should be a little bit higher to balance demand and supply. And so you can make this case. That said, economies head into recession. They often head into recession after central banks have increased interest rates, and the US market is often quite sensitive to fluctuations in global risk markets. And so we have a series now of indicators which say, probably things won't go very bad, but we have to at least watch out for the slowdown and then judge as the incoming data faces whether or not that is sufficient for the Fed to go aggressive, or whether the Fed is actually the balance of risk still favors us worrying a bit here about inflation.
Well, let's just take a quick break from the US and talk about Europe and Germany. We just had a little bit of breaking news, Callum, from the ZEW. Let me just tell our viewers what that is. This is the sentiment indicator. It falls to 19.2 from 34. So this is the investor expectations certainly taking a significant thump. When it comes to current conditions, that goes deeper into the red than whence we've been. So expectations 17.9 for August. I mean, that's for the whole of Europe. But on Germany, again, Germany, the accusation is the sick man of Europe, even relative to France on the growth trajectory. Again, this goes back to policy and policy error. The accusation would be that the Fed is already in active policy error mode and really has to try and dig itself out. If I look at the pricing for Europe, it's 65 basis points of additional cuts between now and the end of the year. When the ECB see this kind of data from Germany, a slowing China, the consequence of that is bearing on Germany. Does that suggest that the pricing for the ECB is fair value?
Well, if I were at the ECB, I would be looking to turn monetary policy actively easy in order to support demand in core Europe. Germany is more exposed than any other major economy to the global shifts in supply chains and to the risks associated with trade wars. And that is now hurting confidence. And so there's a chronic loss of confidence in the German economy. You should hope that consumers can do a little bit more, so rate cuts can help. For the US, the data are still telling us that the US economy is strong, so the Fed should be taking monetary policy from tight to neutral. But when we ask this question, has the Fed made a policy error, the focus is on whether or not they should have cut at the last meeting in late July. That's wrong. If the Fed has made a policy error, it happened in January. It happened at the start of the year because of the monetary policy lags. My hunch here is that in Germany, we're going to have to wait until the next election for the fiscal rules to get changed before you see any significant improvement in momentum. Whereas in the US, actually, the downside risks can probably be contained with rate cuts and probably something on the fiscal side after the election. And so even if it's soft near term in both economies, I'd still be betting on the US to do quite well into next year, whereas I'd still be hesitant in Germany.
I like the subtle differentiation, you know, actively easy in Europe. You say tight to neutral in the United States, very briefly in 15 seconds. Your view on neutral in the United States of America?
Probably 3.5% to 4%. It's well above the Fed's estimate of 2.8.
Okay, well, that's going to be a little bit more contrarian with some of the other panicked people out there. Callum, thank you very much. Callum Pickering. Good to see you at Peel Hunt. Good to have their first edition of your Global Outlook on Bloomberg Brief. The top stories trending on your Bloomberg channel this morning. GM are laying off staff in China and will soon meet with a local partner to plan a larger structural overhaul of its operations there. The job cuts come as recognition that the Detroit automaker is unlikely to see its sales return to 2017 peak levels. The UK is reviewing the time it releases key economic statistics. The review comes after concerns from market participants that the earlier 7 a.m. release is helping spur volatility in interest rate and bond markets and hindering liquidity. Shares of COVID test kit and drug makers are in the spotlight in Asia after posting strong gains in the days of recovery amid a surge in cases. High temperatures and the Paris Olympics led to more indoor gatherings, which in turn has led to a spike in COVID cases in China, Japan, and South Korea. Coming up, Elon Musk had his own interview with Donald Trump. The Tesla CEO pitched himself for a potential role in the Republican White House. And later in the hour, we catch up with Jeffrey Kleintop of Charles Schwab on whether the unwind in the carry trade really is over and done with. Context matters on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
I think it would be great to just have a government efficiency commission that takes a look at these things and just ensures that the taxpayer money, the taxpayers' hard-earned money, is spent in a good way. And I'd be happy to help out on such a commission.
I'd love it
if it were formed.
Well, you're the greatest cutter.
You're the greatest cutter. It was a mutual admiration society. Elon Musk interviewed by Donald Trump last night. Joining us now to break down the conversation, it is our senior editor for Bloomberg, Bill Ferries. Bill, good to have you with me. I mean, you just heard Musk speaking there about pitching himself for a possible role. It's a bit like The Apprentice, isn't it? For a possible role in the Trump administration. I'd be happy to help out in such a commission. I'd love if it were formed. Of course, this was something for both parties, a presence on X, and for Donald Trump and Elon Musk, I suppose, to sort of chew the fat.
Oh, absolutely. I mean, both men had a lot at stake here. For Donald Trump, he's gone through a very bad 3 or 4 weeks of the news cycle with Kamala Harris's entry into the race and the amount of money she's been raising. He's looking to kind of change the narrative. Getting back on X, and then also just frankly reaching a lot of his core supporters who are not necessarily members of his Truth Social network, which just doesn't have the numbers that X has. So he's getting back in touch with some of those people. And Elon Musk as well, making a pitch for the relevancy of X, pitching himself for this job on a commission. He raised that 2 or 3 times in their discussion, how he thinks it would be a good idea to have this come into place. And he actually also made a pitch for his Tesla EV vehicles to presumably a Republican or more conservative-leaning crowd that doesn't normally think of themselves as buying electric vehicles. So both of them had a lot at stake. It was 2 hours of back and forth after about 30 minutes or more of technical glitches that kind of slowed things down at the start.
Yeah, I think it's interesting that the European Union actually sent a message to Elon Musk before this event even took place, which has irked Elon Musk, to say the very least, in terms of his response mechanism and putting out a tweet on that. Look, if we talk about Musk supporting Donald Trump, we know that, we've seen that. At the same time, the UK Prime Minister Keir Starmer and, as I say, Thierry Breton posting this letter. I mean, you know, I looked at some of the tweets from Elon Musk. Some of them we can't actually retweet here for various reasons. I think this goes much more to the sensibilities of what free speech is in the United States of America, to how the Europeans look at communication online.
Yeah, certainly. I mean, I think Musk has a very absolutist view of this, of free speech and what it means. And I think there's a little more nuance in the Digital Services Act, for instance, you know, the way it looks at harmful content and inciting violent behavior and things like that, that are not quite as well perhaps defined in U.S. law. So that's really where this conflict comes. But you do see Musk continually tweeting at European leaders, but Starmer in particular, over his response to the arrest following the stabbings of those girls just at the very end of July. It's not going to let up. The challenge when you're dealing with someone like Musk is it's his platform, and he does have this microphone that he'll continue to use unless there's some real disincentives to using it.
Look, absolutely, and I think part of the phraseology that Musk used was, you know, in response to this, it was the enemy of free speech in response to Breton's letter, along with a number of other posts. Bill, thank you very much. Great to have you with us. He sat through the whole conversation. Let's pivot to the Middle East. The United States is warning that an Iranian attack against Israel has grown ever more likely. Here's our White House spokesperson, John Kirby, briefing reporters.
We share the same concerns and expectations that our Israeli counterparts have with respect to potential timing here. Could be this week. We're continuing to watch it very, very closely. We have to be prepared for what could be a significant set of attacks.
Of course, it is the White House spokesman, not our spokesperson. Now, the US and the UK, France and Germany and Italy, all urging Iran to refrain from attacking Israel. The leaders of those nations issued a joint statement writing this. We called on Iran to stand down its ongoing threats of military attack against Israel and discuss the serious consequences for regional security, such as an attack take place. Joining me now is Dan Williams in Jerusalem. Dan, the preparations, you're on heightened alert in Israel for a potential attack, and the assumption, the sort of working assumption is this could be multi-pronged from multi-proxies towards Israel.
Indeed, and there's quite a bit of game theory going around, not just in the media, among commentators, among regular people, presumably among decision makers in Israel, in Iran, in Lebanon, among Hezbollah leaders, Hezbollah being the Iranian proxy there, which has also vowed major reprisals against Israel. The question is, could those reprisals be kept as a one-off without inviting from Israel retaliation for the reprisals, retaliation for the retaliation that might drag the region into an unprecedented escalation of what is already a multi-front war? And presumably that is what the Americans and other Western powers are looking to tamp down now. They're hoping that a resumption of Gaza truce talks on Thursday might indirectly contribute to calming those other fronts, because those proxies, Hezbollah, the Houthis, Iran itself, have actually openly called for Israel to enter a Gaza truce. Presumably that would be a way for them to lay down their own arms for now as well.
Well, a great deal has been made out of Keir Starmer directly spending time on the phone with the new president of Iran, refrained from attacking Israel, and various news sources saying it was a rare telephone call of up to 30 minutes. On Thursday, the Gaza truce talks are due to resume. Blinken is returning to the region, I understand, in the next 24 hours, doing a multi-country trip. Is there optimism?
Guarded optimism. It's worth noting that Hamas, which is obviously a significant partner to any Gaza truce, it's one of the warring parties, has said it is not interested in this round of talks. It has called on the mediators to compel Israel to accept what has previously been agreed. I would say it stops short of openly boycotting these talks. We understand the talks will take place in Qatar, which is a mediator country that also plays host to a Hamas office. So I think it's a worthwhile assumption that while the mood music may be discouraging for Hamas right now, they will wait and see what emerges from this round of talks. As far as the Israelis are concerned, this is a round of talks to discuss where things stand, to see whether Hamas will relent on some key points that have held up a deal so far, and thereafter Hamas will be briefed by the Qataris, by Egypt, which is another regional power that has been mediating between the sides, and of course the United States is also involved.
Well, there's certainly more deployment, isn't there, from the USS Georgia in the region to the US Abraham Lincoln. So there is an upscaling of deployment to the region. Dan, thank you very much. Dan Williams in Jerusalem. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
A Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Get you up to speed with some of the front page news from around the world. This is what we're tracking. First up, the Financial Times. The Russian Navy is trained to target sites inside Europe with nuclear-capable missiles. Maps of targets as far west on the coast of France and the UK are detailed in a presentation for officers that predates the full-scale invasion of Ukraine. Ukraine has in recent days sent troops across the border into Russia. Up next, Washington Post, lately with the FBI probing alleged Iran hack attempts targeting Trump and Biden camps. Suspected attempts on the Trump associate and advisors of Biden-Harris campaign. Investigation began in June. So far, no confirmation that any hacks were successful. And finally, Bloomberg leads with this story on China. Going to the extreme in a crackdown on the bond market frenzy, Chinese authorities are tightening their grip on the world's third largest bond market. Regulators told rural banks to renege on their market obligations. Highly unusual move. The PPI, we're counting down to it. We'll catch up with Charles Schwab on what they think of volatility in markets.
To succeed in Wall Street, what skills do you need? You need to be somebody that claws people on the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
global headquarters in New York. Welcome to Bloomberg Brief. I'm Maniskrani. Let's set your agenda. Market steady ahead of PPI as the New York Fed survey flashes a drop in inflation and credit outlooks. Prepare for significant attacks. The U.S. warns as world leaders pressure Iran to refrain from striking Israel. A cozy confab. Elon Musk pitches a role in government to the Republican nominee, Donald Trump, in a glitchy conversation on the social media platform X. Good morning to you. The headwinds were obvious yesterday in the price of oil as it pitched higher. It's giving some back this morning, but it is a new week with new headwinds and new unknowns in the form of political risk. Equities are desperately trying to stabilize themselves. UBS say take stock. Take stock of the scale of the momentum that you had to the upside. Goldman Sachs have a lovely line from Scott Rubner's team. There's a brief window to buy stocks. Tactically bullish. We'll go tactically bullish on the 30th of August. Now, there's a couple of other things to keep an eye on. The Russell 2000 at the bottom of your screen is down 1/8% this morning. I want to give you some context of real concern about the real economy. The Russell 2000 is down 8.5% in August, and we are only 10 days into this month, 13 days into this month, I should say. NVIDIA is also one to keep an eye on. Bank of America yesterday pivoted to the top rebound pick for them within the chip stock, and the stock was up over 4% yesterday. It's up another 1.7% this morning. I think the context from Goldman Sachs is excellent. There's a window for you to jump through to buy these stocks. When it comes to the oil market, we ramped by over 4% yesterday, again, on the concern about what will happen between Iran and Israel. What is interesting is oil gives ever such a small amount back this morning. This is a ramp higher on the lowest participation by the hedge fund since 2011. And bonds, they are your hedge. There's no doubt about it. Last week when the equity market sold off, they were your hedge. And on this war escalation risk between Iran and Israel, the conflict between the two of them, that risk provokes a move into bonds. Well, to the Middle East, Israel is bracing for a potential strike by Iran as the U.S. warns of an attack has grown ever more likely. Here's the White House spokesperson, John Kirby, briefing reporters.
We share the same concerns and expectations that our Israeli counterparts have with respect to potential timing here. Could be this week. We're continuing to watch it very, very closely. We have to be prepared for what could be a significant set of attacks.
Well, the US, the UK, France, Germany and Italy all urging Iran to refrain from attacking Israel. The leaders of those nations issuing a joint statement writing, "We called on Iran to stand down its ongoing threats of a military attack against Israel and discuss the serious consequences for regional security should such an attack take place." Sylvia Westall is with me. Sylvia, thank you for joining us. I think it's interesting that you get this coalescing by world leaders from Germany, the US and the UK directly communicating with Iran on this. What is the current thinking on the scale of retaliatory action that Iran will take? How do they thread this needle without full escalation to war?
Yeah, that's the real, dilemma for Iran right now. Obviously, there is a real pressure for them to act after the killing of the Hamas leader in Tehran. Iran needs to show its population. It needs to show regionally that it can retaliate to this, but it needs to do so in a way that would prevent a really big counter-reaction from Israel. And obviously, you've got all these countries showing that they stand behind Israel, that they're united in wanting the situation to calm. There's a real concern that as things continue to inch and escalate, that there could be a wider regional war, which would obviously have wider implications for the region, for Europe, for the US, for assets, for commodities. So it's a really sort of tense moment. There is sort of a line of thinking in Israel that Iran actually doesn't really want to retaliate in any significant way, and that it can actually benefit from the uncertainty over what might happen. We've already seen that some of the implications of this were underscored by Fitch. They had a ratings decision. They downgraded Israel's sovereign debt by one notch overnight from A to A plus, from A plus. And there are ways in which these ongoing tensions are affecting people in Israel and the wider region, and really putting Iran on top of the agenda once more, despite there actually having been no reaction yet.
I mean, if you look at the scaling up, you know, the scale of deployment, the USS Georgia, that's a submarine equipped with 150 Tomahawk missiles, the F-35s on the US Abraham Lincoln aircraft carriers. So the scaling up is preparing for quite an escalation. Look, Sylvia, you know better than most. The reaction function is not just from Iran, but it is also via those proxies, whether it's Hezbollah, whether it's any of the others. There is a growing thought process that this will be a multi-front reaction from Iran and its proxies. Where should we be most concerned about? Should it be the Hezbollah reaction, which is perhaps better equipped relative to the Houthi? We know that the general approach of the Houthi attacks. So what is the region preparing for?
Sure, and I think you make a really good point, Manus, in that you know, what Iran terms its axis of resistance has been much more coordinated and unified since these hostilities erupted. And I think there are two things. One would be that for Israel, it sees the biggest threat from Hezbollah over the border with Lebanon. Hezbollah is the sort of the strongest force, the most organized, and the force able to do the most damage. But perhaps the kind of more frightening scenario for Israel and for its allies is actually this idea of coordinated attacks, not just from Hezbollah, but also from proxy groups operating from Iraq, from Syria. You've got other ways in which this retaliation could happen. You've got these shipping attacks that have been happening via the Houthis in the Red Sea. So, if it is a set of attacks that seeks to overwhelm and distract at the same time, that's something that obviously the US and Israel are looking for, and why you have this real show of force in the region to show that, if that happens, then there is deterrence and there is the ability to also strike back.
We obviously have these lead stories that you've got the leadership of the United States, France, Germany, and Italy coming together. Keir Starmer in the United Kingdom spending time speaking to the new president, refrain from attacking Israel. I just wonder, from the perspective, from the geography within which you sit, the Middle East's reaction function. This is the West's reaction function. What is the impact of uncertainty in the region there from Saudi, from the UAE, and from those protagonists who have a real vested interest on non-escalation here?
Absolutely. I mean, underscoring that, Axios reported overnight that US Secretary of State Antony Blinken is scheduled to travel to the Middle East, kind of underlining the importance of these regional countries. He's apparently going to travel to Qatar, Egypt, and Israel. Qatar is one that's extremely important to watch, given its important role as a go-between between Israel and Iran. And you've got these talks on a potential Gaza ceasefire, obviously, seen as a long way off, but, they're being hosted by Qatar, those happening towards the end of the week. And that's another reason why in Israel and the US, there is this belief that potentially something could happen before that, so that Iran can essentially have more negotiating power heading into those talks.
Sylvia, thank you very much. Sylvia Wessel there with the very latest on the Middle East. Let's turn our attention back to the markets. The drumbeat to PPI is being heard around the markets, and we're going to get a read on the retail sector. We've got Home Depot reporting their numbers. That'll hit before the bell. Comparable sales are expected to decline as shoppers feel the pinch and the pressure from inflation. Our consumer reporter, Dasha Afanasieva, joins me now. Dasha, good to have you with me. I mean, when I look at Home Depot, you've got the retail average consumer like me popping in there, then you've got the builders in there that are actually really sort of buying for refurb. So just dissect what we can expect from Home Depot. It's been a tough time for them in the past number of quarters, hasn't it?
It has, and we're expecting a 7th consecutive decline in comparable sales, a decline of 2.4%, in fact. And that's driven by high interest rates. People aren't wanting to finance big bathroom renovations, big kitchen renovations. You've got economic uncertainty, a housing market slump. So it's all this perfect cocktail. And on the back of that, there's also this longer-term decline from the time of the pandemic, when people were spending a lot on goods and a lot on renovations. 2021 being the peak, and there's been this steady decline since. So that's also an effect that Home Depot has been hit by.
I'm just looking at the analysts. They still got 26 buys, 13 holds, and an average price target still 10%, 9.3% above here. The question, I suppose, would be if they're hit with another tough quarter, Dasha, what's this going to say about the capacity to price? I mean, we haven't seen price cuts and real incentives to get into the shops or into these refurb stores for a long time. So what is the company doing to push back against the slump?
So I don't think that you can really blame the slump on the company or on the CEO, Ted Decker, but they are trying to pivot and do something about it. Interestingly, in a bid to kind of cash in on a lack of housing market availability, housing market affordability, and the fact that the housing market's so strained, they're actually now selling prefab houses for $63,000 a pop to try and cash in on that. And more broadly, it's also trying to compete better in that space, in the professional space, by buying SRS Distribution, which makes roofing supplies for $18 billion. So they are trying to pivot. And in terms of pricing, yes, there's across the consumer sector, there's a highly promotional environment, and I'm sure that's affecting them as well. But of course, they've also got their targets on profitability. And just a reminder, for the year, they are expecting like-for-like sales decline of 1%. But unfortunately, the market's actually expecting a lower decline. So I think we'll be looking for signs of how the company plans to get those two aligned, whether it's by being a bit more pessimistic or trying to convince the market that it can make it a 1% decline rather than a 2% decline.
I got you. Well, all eyes on whether it is the 7th consecutive decline and what they're doing around it. Dasha, thank you very much for setting us up for the trading day. Dasha Afanasieva there on Home Depot. Well, Elon Musk pitched himself for a new role, cutting the US federal spending if there is a second Donald Trump administration. The billionaire Tesla boss spoke to the Republican presidential nominee. It was a 2-hour conversation on the platform X.
I think it would be great to just have a government efficiency commission that takes a look at these things and just ensures that the taxpayer money, the taxpayers' hard-earned money, is spent in a good way. And I'd be happy to help out on such a commission.
I'd love it
if it were formed.
Well, you're the greatest cutter.
There you go. Derek Wallbank is with me. Derek, just the end of that piece, you're the greatest cutter. I mean, this was 1.3 million of an audience. What do you think Donald Trump got from it politically? Let's start there.
Well, look, I think anytime that you have an audience with the richest guy who's endorsed you on his own social media platform, you know, that's sort of setting the stage for where we are, right? You know, Elon Musk is the richest guy in the world, and he has been a big Donald Trump supporter. He has used all of his influence to try and butter up Trump and to swing Harris down a little bit. And it's really clear which way Musk is going. And so Trump sat down with him. They had a conversation amongst friends. It was very amiable. They agreed on an awful lot. It was interesting. There were some places where they didn't quite necessarily see eye to eye. Musk was pressing Trump towards more sustainability, trying to get him, you know, more toward nuclear power. Both things that I'm not sure that Trump was all the way there for. But you know, it was an interesting sort of conversation. I do think that the thing that you highlighted at the top of this was something that came out of that, this discussion about a fiscal improvement sort of commission kind of thing, and could Musk be involved in that? I think that's really interesting because, look, Menace, I'm old enough to remember something called Simpson Bowles, which was a similar commission designed to try and cut government spending. I'll give you one clue as to how that worked out, and that's that it didn't. The thing went through the federal budget, tried to figure out places to cut, how to raise revenue, all this other stuff, came up for a final vote, and it got absolutely waxed by Congress. Nobody wanted to stand by its proposals at all, because cutting in theory is easy, cutting in practice, very, very hard.
Very, very different when it comes to government. It's interesting, of course, Musk was on the advisory council when Trump was in power before, and then he withdrew because he stepped off because of the withdrawal from the Paris Climate Agreement. And look, we've also seen Donald Trump at the same time being I suppose, if you look at the response mechanism from Europe and from the UK Prime Minister, the EU sent a letter. This is Thierry Breton, the EU Commissioner, for internal market about content that promotes hatred, disorder, incitement, violence, in certain instances of disinformation. Again, warning Musk before this event about how he should proceed. And it certainly irked Musk quite a bit.
Yeah, it really did. I don't think that his response is fully quotable in this context, but it went something like, if I were to paraphrase, I would say, I disagree with you, might be Elon Musk's response, but slightly more strenuous. I mean, my social media feeds among Republican activists have been filled with, from both this and from some of the context that he got back from the United Kingdom and criticism there, with things like the answer to all of this is 1776. The United States has a First Amendment, and, that's that. Which is, it's one of those things, Manus, we talk about this a lot. If you're operating in a lot of different places, you have to take into account the geopolitical risk that comes there with. You do have a First Amendment. You have a very large line between what you say and how far you can say it in the United States. Doesn't extend that far in other marketplaces, as Elon Musk knows well. And so there is a geopolitical risk aspect to this. On the flip side of that, though, I also think that it's important to note that this sort of thing is the kind of thing that irks Republicans particularly. And so if Donald Trump were to win, it might be something he'd take up.
Look, 100%. I think it's also a huge cultural difference as well. Derek, thank you very much. Derek Wallbank there, setting the stage of the Trump-Musk discussion. Stocks are higher this morning from a beautiful New York.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It is Bloomberg Brief. I'm Manus Cranny in New York. Jeffrey Kleintop of Charles Schwab, I should say, writes the following. Stock markets less exposed to tech, the dollar, and yen, along with those that have stable economic backdrops, below average valuations seem to be most likely to be better able to withstand any further unwinding of the yen carry trade. Jeffrey joins me now. Look, a great deal has been written and much hand-wringing has been done about the unwinding of the carry trade. But from what you've just presented to me there, it sounds as if you want to take slightly more global positions outside the United States to perhaps balance and diversify the portfolios if they are less exposed to tech, less exposed to the dollar, and less exposed to the yen.
It makes sense to me that a lot of this carry trade for more than a decade has come, of course, out of the yen, borrowing in yen, and into U.S. tech. We've seen these flows for many, many years now, and I think there's a bit more to go because I believe that there's still a medium-term and a longer-term unwinding of the carry trade to go. Borrowing in yen, not merely short yen contracts, but actually borrowing in yen from Japanese banks, and then, of course, the net investment position of Japanese investors outside of Japan suggests to me there's more to go out of U.S. tech. And so what I found was, if you take a look at the allocation of markets outside the U.S., where there's less tech exposure, and again, more of a stable economic backdrop, which is important because some of this was catalyzed by the weakening U.S. labor market, I think you find more attractive markets in Europe, where markets actually have outperformed here in August. European markets have still down, but faring better than U.S. and certainly a lot better than the U.S. tech sector.
Yeah, I mean, we've just had that ZEW from Germany, which looks a little bit under pressure. And you're right, that correlation between the NASDAQ and yen is almost in lockstep. Can we just discuss the medium and longer term implications? Because I think the nuance that you bring to bear is very important. There's the correlation between the NASDAQ, the 14-week correlation turning positive between the two. But you talk about the lending that's gone on in yen. You talk about the impact in terms of the ownership of the bond market here in the United States of America, the ownership of equity markets here in the United States of America. So your base case, Jeff, is that there are ripple effects that are yet to be felt. We've talked a lot about the spot unwind in the carry trade, but there are further reverberations that you focus on.
That's right. So in the futures market, you suddenly get a margin call and you need to immediately close out those positions when they move against you. But there are other aspects of the carry trade that may yet unwind. A proxy for the medium-term carry trade magnitude is looking at Japanese banks' foreign lending in yen. This type of lending is often to non-banks like asset managers, and it's been on the rise really since 2010. It's accelerated in the last couple of years as rates in Japan remained very low while they started to rise everywhere else thanks to the central bank actions. So according to data from the Bank of International Settlements, the loans totaled $1 trillion, or 145 trillion yen, as of March 2024. Now, it doesn't mean all of those loans might get closed out, but they certainly moved aggressively against those asset managers, and I think they may look to reduce those carry trades and pay back those loans over the medium term, and that's going to remain, I think, an overhang against those assets that they purchased, including perhaps U.S. Treasuries. We know there's $1 trillion in U.S. Treasuries from this carry trade, but there's also a lot in equities as well, and that gets to the longer-term aspects. Japan's long-term net investment position is positive. Japanese investors are the biggest non-U.S. investors in U.S. Treasuries and among the top 5 in ownership of non-Japanese stocks. And so as maybe they begin to bring capital back home again, repatriate that could lead to a sell-off, not just in treasuries, but in equities as well, that could overhang for maybe several quarters ahead of us here. So I think there are still more ripple effects, as you said, that are yet to come.
Which then makes the decision process about whether you re-enter. I mean, there's a certain amount of stability in these markets, has re-established itself Monday and Tuesday relative to where we were last week. But I was looking at some of the positioning reports. Deutsche Bank have this. Investors slashed their equity exposure by the most since COVID. And the positioning is underweight after, obviously, those peaks that we saw in July. So it seems as if there's been a wholesale retreat from these markets. I mean, are you tempted? Do you see opportunity in this underweight position as something that will put a floor in this market?
I think there's a possibility that there's probably no more net selling of equities, but I think there could be more of a rotation out of technology into those areas that have lagged in recent years, like, for example, financials, a rather unloved and lower valuation sector, but one where we could see more opportunity as the yield curves around the world begin to steepen up. We know that's traditionally good for the banking sector. We could see more opportunity there. And as I mentioned, European equities, which are trading below their longer-term price to earnings ratios, versus those in the U.S., which are quite expensive. So I think maybe a rotation within equities more so than a wholesale selling.
Look, what we had last week was a growth scare. Fed misstep, Fed policy error, as you say. We can debate either they're in it or they've been in it for months. Leave that aside. Last week, and even this morning, the German data says to me that we are incrementally moving towards a narrative which is slowdown. It's a question of the scale of the slowdown. So in a slowdown position, where do you want to be most exposed? Briefly.
Well, I think in those markets that are priced for a slowdown, and again, those below average valuations in Europe, I think are more favorable. The economy is they're certainly growing slower than average there as well, but I think there's maybe less momentum on the downside, given the embedded pessimism, I think, within those valuations. So I think those are more on a relative basis, more attractive markets.
Jeff, thank you very much. Good to see you on the show. Jeff Kleintop there of Charles Schwab. Quick snapshot of markets. As Jeff was just saying, this is about the debate that you're going to have, whether you want to diversify out of U.S. equities. Of course, that brings into the question of U.S. exceptionalism. You know, the Atlanta Fed is still indicating 2.9% growth. Dallas Fed, 2.2% growth. So you are looking at a reasonably robust outlook for the economy. Bear in mind, as you go into PPI today, the New York Fed, medium-term inflation expectations are declining. This is on the 3-year outlook. And also the perceptions of credit access have deteriorated. That's just something to bear in mind as you count down to the PPI. NASDAQ futures up 0.6%. NVIDIA was one of the stocks that flew higher yesterday, up by over 4%, as Bank of America said, look, this is our rebound choice stock in the chip sector. Here's what's on the slate today. We're chatting about Home Depot. They will be up before the bell. As I said, PPI hits the tape at 8:30 a.m. That really gives us the roll call into CPI tomorrow. Fed speak, you've got the Atlanta Fed President, Raphael Bostic. That is at 1:15 p.m. The surveillance team are up next. Danny will be there around the desk with Lisa and Anne-Marie. That's it from Brief. We'll see you tomorrow morning.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
The way that I'm describing the evolution of the economy right now is an incremental slowdown. I don't see this as actual weakness.
It's not necessarily that the economy is at a different point, but I think the balance of investors' concerns have changed.
Yes, you're going to see some weakness, but you're also going to see some areas of strength.
The odds of a soft landing are much higher, and the risks have become a little bit more balanced.
When you look at the underlying fundamentals, yes, the economy's slowing, but in a good way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This is what a week in August feels like it should be, right? It kind of is range-bound. Good morning. Welcome back. This is Bloomberg Surveillance. Anne-Marie and Danny here with me today. John is still on his week-long Disney cruise. What a difference a week makes. Honestly, last week started with fireworks on Monday. This week, Danny, not so much. Yesterday, a pretty quiet day, which was very refreshing for a lot of people.
Yeah, is it return to normalcy or is it the eye of the storm? I think a lot of concern that people have is that markets are right back where they started this morning with the huge rally in the Nikkei. Japanese stocks are back to where they were before the sell-off. So maybe we're just the same setup we were last week.
It's set up going into a slew of economic data. We're starting with PPI today, coming up at 8:30 a.m. Eastern, just in about 2.5 hours time. Then later we get Home Depot at some point this morning. A whole sort of a number of indicators, Danny, that potentially could also really disrupt where we are.
Right, because kind of thinking about what demons have we exercised over the past week, the one that still lingers all of us is where we are in this economy. And it's just been tier 2 data that's been whipsawing this market. Today, we get real robust data followed by tomorrow's CPI and retail sales.
And we did just get Home Depot numbers, and you can check that out, Danny, for us, because it is a pretty big disappointment, akin to the disappointment that already was expected. But in the meantime, really the geopolitics front and center, Anne-Marie. And this, to me, very much is the center of the focus. Right now, Home Depot, we'll get to that in 1 second, seeing full year comp sales down 3 to 4% versus the expectation around 1%. Danny, why don't you take a look at what's going on with that? Right now, I do want to set you up, though, Anne-Marie, with a sense of the oil markets and how this is sort of playing out. Yesterday, with Brent seeing the biggest one-day pop, according to some metrics, going back to November.
A lot of geopolitical risk now coming back into the price. A lot of that had waned in the prior few weeks. I think yesterday what a lot of people are really looking at is what the White House said. John Kirby came out and said Israel believes it's, quote, increasingly likely that there'll be an attack by Iran, its proxies, and then he said we share those concerns. And whether or not you're looking at words or the movements, what you see from the United States is they're sending more weapons into the Gulf. They are preparing, either whether you want to call it deterrence or defensive state, they are preparing for this potential retaliation by Iran.
Which is the reason why people are looking at this as potentially some sort of disruption. Danny, you've had a second to look at Home Depot. What do you see?
It is really weak. I'll just reiterate the headline that you read, that they see their full year comparable sales down 3 to 4%. They did see about 1%. This quarter was bad too. 3.6% decline. The estimate was for 2.6%. I just want to read the quote from the CEO, Lisa, because I think this captures all of it. Ted Decker saying, higher interest rates and greater macro uncertainty pressured consumer demand more broadly, resulting in weaker spend across home improvement projects. So it's not even just the weaker consumer, which we knew about for a lot of these home-related goods. It is higher rates that's having an issue, putting pressure on this housing market, meaning turnover is slow, meaning people aren't shopping at Home Depot. And again, these other housing-related stocks because They don't need to. They don't have new homes.
Meanwhile, people are sort of parsing through this. Is weakness good or is it bad? Right now in markets, again, with a little bit of a lift to start the day, although, again, nothing that material. What we're seeing right now in the S&P 500 is just a mild game, up about 0.3%, as we saw yesterday. That faded as the day went on. Euro actually dipping just a touch. Question of how much some of the rate cuts have been overpriced in the market. Euro 109.19 versus the dollar. 10-year yields, this is a place to watch. 392 actually dipping slightly yesterday after the New York Fed inflation expectations came out, with the 3-year metric coming in at the lowest going back since the series began in 2013, and crude just a touch softer after that huge rally that we saw yesterday. Coming up this hour, we've got Mark McCormick on TD on why the U.S. dollar looks cheap. Amrita Sen of Energy Aspects, his crude rallies on Middle East tensions, and Kathy Bostancic of Nationwide ahead of key U.S. economic data. Let us begin with the top story, counting down to U.S. PPI at 8:30 Eastern. The first in a string of key data points coming out this week. Mark McCormick of TD writing this: the U.S. dollar looks cheap to the global risk events piling up, and the steep Fed cut pricing seems excessive and overdone. The FOMC is closer to rate cuts, but not as urgently close as markets are pricing it to be, and we are cautious of a correction. Mark joins us now. Mark, you are not in consensus, which is a good and beautiful thing. It's always great to hear a counter argument. Mark, you actually see dollar strength ahead. Why?
Well, I think you put together some of the pieces. One of it is the global economy is not really that strong. And we're talking about geopolitical tensions where you can see an escalation in oil prices. Like if we take ourselves back to 2022, why was the euro weaker? Why did Asian currencies weaken? Why did the yen weaken? It was in terms of trade shock. Currencies that import energy prices and commodity prices do not like the uncertainty around that. They don't like the potential for oil prices to move higher. And I think also what's very, 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 very important, and this is something we've been highlighting for months now, is the Goldilocks scenario that we've been in is been tipped over. And again, maybe it was U.S. employment report that broke, it was a straw that broke the camel's back. But if you look at like high frequency data in China, if you look at data surprises, data trends, consensus revisions, data and the growth story is weaker in China than the U.S. And then if you look at what's happening in Europe, it has peaked from a very low level coming to a modest level. And European data and European data trends are also peaking. So there is no country here that can offset the slowdown in the U.S. And if U.S. data is slowing, this is where we move to the part of the world where the U.S. dollar rallies, the yen rallies, the Swiss franc rallies, largely, again, as a safe haven bid. So that's the thing that really worries me, is everyone's looking at the U.S. in a vacuum. But what we should be doing is looking at the whole entire global picture, which is the world is actually moving into a slower place, which reinforces more volatility and also more safe haven demand.
We see that with respect to China's demand, for example, with oil, which we're going to get to in just a second. You write, though, and this I find interesting, and this is also counter consensus, that you think market risks are asymmetric right now, that the U.S. dollar should rally on good and bad surprises here, which is exactly the opposite of the bad sort of response to good news or bad news that people were seeing and saying yesterday and last week. How do you sort of rationalize this?
Well, I think it's this way. It's like what the consensus is, especially on the inflation number. That's kind of the key number we're thinking there's asymmetries around. There's 4 Fed cuts priced in this year, and there's more than that priced in next year. So the way we're looking at it is, number one, we don't expect 4 Fed cuts. We don't expect an emergency cut. We don't think the Fed needs to cut 50. You talked about the Atlanta nowcast, which is still running over 2%. For me, in terms of like tactically come into the data, if we get a strong number, in terms of inflation, 0.3% on core inflation, the dollar's going to rally because we're going to price out a Fed cut. We're going to price out the 50 for September. We're going to move back to something that's probably in line with our expectations, which is maybe get 3 cuts this year. If you get a bad number, very low inflation, kind of at the lower end of the range, I think the market gets spooked about the uncertainties of global growth, of U.S. growth. Are we heading into a recession? We titled our weekly narrative whiplash. Like essentially that's what we're going through here is the stories keep changing, the vibes keep changing. So essentially what I would think here is both of those extreme numbers are good for the dollar. One, because it prices out the Fed and the dollar gets a recovery because U.S. 10-year will probably rise and U.S. yields start to rise a little bit. The other one is as we move into the uncertainty around a global recession, the slowdown, and the narrative changes to that. So that's where I think the most boring outcome will be on consensus, and we probably won't get much of a reaction. But any of the extremes, I think, are both bullish for the dollar, at least in terms of the data this week.
Mark, that's not necessarily what we saw after the weak jobs report, though. And obviously, a lot of that people pointed to the idea of there's too much leverage in the system, too many carry trades built up. Does your view then assume that a lot of that is washed out?
I would say tactically. So you have to, I think we think about flows, especially from the Japanese perspective and the carry trade perspective is, coming along with the unemployment report, we got a surprise hike from the BOJ. It was not a surprise to us because we were calling for the BOJ hike. We've actually been suggesting this for months, that the BOJ is going to be much more aggressive because they have to be, and that Japan is as basically as a country, the government, the pension funds, and essentially the central bank all had to move in a direction that moved into a stronger yen. And I think a lot of this had to do with where we were in the prior election cycle when before everything changed. But I think, a big piece of what happened here is you have all of these things that we don't know what the trigger is, but the conditions were that Goldilocks was unsustainable. We needed more macro volatility, whether it was equity, fixed income, or currency. All that the employment report did is it worked with the surprise move by the BOJ that the market wasn't priced for. You got a very weak number that is actually quite distorted, and the market kind of implodes. And I think this is exactly the definition of a complex system that's trying to figure out what it needs. You don't know what exactly the combination of triggers will be, but we got those triggers in a small period of time when people are away for summer. And again, I think a big piece of it is the tactical trading side is completely been washed out. Our models show that on positioning, the yen is quite long, it's quite over-owned, but I would say structurally, you have to think about the amount of money that Japanese pension funds and other institutions in Japan, the amount of money that they have leveraged the rest of the world, particularly in US technology stocks. That is something that's not going to get washed out over a quarter or a month. Like, these are positions that are set. They're set on an asset allocation mix. Those decisions are decided once a year. Those targets are met, and those are conditions that take a long time to trade. So I would say tactically, all the stuff that's been washed out, the carry trade is probably washed out from hedge funds or leverage money. But I think when we think about the capital flows, we haven't even started to see a reversal in some of the carry trades that have been on for years now.
Mark, I just wonder how that plays out, because presumably these are people who hold longer term contracts, so they probably won't even know the losses that they saw last week for some time. So what does that look like as those realizations pop up?
I think piece of it is people are going to sit around and think about the investment profile for the next year. Obviously, won't get the asset allocation targets from a lot of these. Again, there's a lot of investors that aren't worried about a shoulder tap kind of on a monthly or weekly basis. So they will sit down, strategically think about how they view the world. What is the asset allocation mix? If you think about just JGBs from a Japanese perspective, pension fund allocation about 10 years ago was about 60% of their fixed income investment. Now it's down to about 20%. So a big piece of this is like, say, the pension funds will sit around, they're going to make a decision and say, we need to have a higher allocation to JGBs. And the BOJs are going to say, we need to give the pension funds a reason to repatriate this money home. So we're going to continue to, again, do quantitative tightening. We're going to let the curve steepen, or we're going to raise interest rates. They're going to have a profile that allows that mix over time to make more sense for the pension funds. But it's not going to be ripping off of the Band-Aid. It's not going to be knee-jerk. So it's going to be much more strategically thought out. And the other big piece here is, even if you look at the balance of payments, there's probably at least $1.5 trillion outstanding in yen, just based on a 50% hedging target from some of the allocations you can see in the international investment position. You cannot capture any of that data. You don't know where it goes. A lot of it's residuals, but essentially much of it is unhedged. So unhedged repatriation of yen over thinking quarters of time will realize a much stronger yen if Japanese pension funds have a higher allocation to say, hey, we have a target. We're going to buy more domestically driven stocks, and we're going to buy more domestically driven JGBs. That will naturally lead to a stronger yen because of the lack of hedging that they've had. And we know that they are unhedged because it costs so much money over the last 4 to 5 years to hedge, given the shape of the yield curves.
Mark McCormick of TD, thank you so much for being with us. I just want to go back to Home Depot, which did come out with disappointing results. Looking at same-store sales in particular, those shares lower by almost 3%. They were expected to be negative, and yet this was worse than expected. Danny did a really good job looking at the commentary from the CEO during the quarter. High interest rates and greater macroeconomic uncertainty pressured consumer demand more broadly, resulting in weaker spend across home improvement projects. The CFO, in a separate interview, said this: pros tell us that for the first time, their customers aren't just deferring because of higher financing costs. They're deferring because of a sense of greater uncertainty in the economy. We will be talking about that coming up more throughout the morning ahead of a whole host of data, including retail sales, to get a sense of whether this is an idiosyncratic story about a company, about an industry, or something much more broad. Let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Investor confidence in Germany's economy slumped to the lowest since January, and expectations gauged by the ZEW Institute fell to 19.2 in August, far below the 34 expected in a Bloomberg survey. The recent figures have painted a gloomy picture for Europe's largest economy, with output unexpectedly shrinking in the second quarter and private sector activity providing little optimism. General Motors is struggling in China. Bloomberg reporting the U.S. automaker has been laying off staff there and will soon meet with local partner SAIC to plan a larger structural overhaul of its operations. This represents a major shift in strategy for GM, which earned billions of dollars in China as recently as 2018. But GM isn't alone. Many foreign brands are struggling to keep up with local competitors in the world's largest car market, which is now facing massive overcapacity. And the NFL is meeting with a handful of private equity groups this week. According to people familiar with the process, it's a step toward opening the league's ownership ranks to institutional money. The meetings are intended for the league to conduct more due diligence, but also to talk through potential policy preferences. The NFL is the only major U.S. league that doesn't allow institutional investors. It has spent more than a year observing results from other leagues and discussing what it might do differently. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, Israel preparing for a response.
We share the same concerns and expectations that our Israeli counterparts have, but we have to be prepared for what could be a significant set of attacks. We have increased our force posture and capabilities in the region, even in just the last few days.
That's coming up next. This is Bloomberg.
Could face bigger challenges next.
Was going to keep Raid World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
If you want to be confused, here you go. We just got Home Depot earnings, which disappointed. Some pretty dire commentary from leadership talking about consumers really withholding some of their funding simply because of geopolitical concerns and just macroeconomic concerns. And then U.S. small business optimism comes out, increasing to more than a 2-year high over in July. Put those things together. Welcome back in the markets. Put it together. A mild lift to the S&P after the pullback of last week that was quickly reversed, up about 0.3%. And you could see yields just marginally higher after a dipping, but really somnolent in markets this morning. Not somnolent in oil, and that is where we want to focus. Under surveillance this morning, Israel preparing for a response.
We share the same concerns and expectations that our Israeli counterparts have with respect to potential timing here. Could be this week, but we have to be prepared for what could be a significant set of attacks, which is why, again, we have increased our force posture and capabilities in the region, even in just the last few days.
Here's the latest. The White House warning Iran may launch an attack against Israel as soon as this week, following days of threats. Crude markets a bit softer today after yesterday in Brent seeing the biggest one-day rally since November, driven in part by tension in the Middle East. It does seem to be percolating to the surface. Amrita Sen of Energy Aspects joining us now. Amrita, I want to start there. How significant could this be for the energy market?
I actually don't think the increase in Middle Eastern tensions, even if that were to transpire into attacks, will lead prices significantly higher. Even in the past, we've seen traders actually sell the news, and unless and until there's an outright supply outage, we aren't actually going to see prices move up materially. In the short term, of course, there's a risk premium that's kind of coming back into the price. It hasn't been in there for most of last week, I would say. So yes, you could get $1 or $2 here or there, but generally speaking, the view in the market, including ours, is that we do not actually expect outright supply losses from these escalating tensions.
This is fascinating and something that we have heard from other people. Amrita, do you think that yesterday's response in crude markets was tied to what we heard with the U.S. moving nuclear capabilities to the Mediterranean to back up Israel?
I think there is definitely a part of the price move that can be attributed to that, because tensions are rising, and even recently Israel has sent warning signs by attacking oil depots in Iran, saying, look, oil facilities are not off the target. Now, again, not the base case that they're going to actually attack oil facilities, but that can't be ruled out. I will say, however, is that the underlying impact or the underlying driver of oil prices has been this continued tightness in the Atlantic basin. U.S. production growth is slower. We actually are staring at very, very low, potentially record low utilization in U.S. stocks by the end of this month. That's why the note we put out yesterday, we called it stocked out. And I think that's the bit that's underlying the strength in the market. You've seen the WTI backwardation closing in on $2. And I think that's separate from the Middle Eastern tensions.
When you look at the IEA report today, Amrita, it says that global oil markets are going to go from deficit to surplus. So where does that leave the big producers? Do you think they're going to have to ratchet back some supply?
Yeah, and our balances have been showing that for some time now, that we have a huge draw in Q3, but flips to a very small kind of flat to build next quarter as OPEC gradually starts to unwind. But what I will say in terms of OPEC policy, they always have mentioned or maintained rather that all their policy is dependent on market conditions. Should inventories build too much, and we've seen a bit of a macro scare recently as well, then they will reconsider their decision. Of course, no decision has been taken yet. It's still a couple of weeks before they have to do so. But again, I think they will remain vigilant. As of now, our balances do show that they are bringing back barrels.
But what's the floor? We do see this risk premium coming back into the price because of what's going on geopolitically in the Middle East. But what's the floor when it comes to supply and demand? Does OPEC Plus, you get the sense, want to at least be able to hold $75 for Brent?
I think, again, OPEC Plus is not targeting a price here. They are looking at fundamentals. But where we see the floor for crude is around $80 for Brent, because, yes, fundamentals in Q4 do not look bullish, but right here, right now, stocks are very low. So when you are building, but from record low stocks, you automatically provide yourself with a significant buffer or rather, like, you are able to build a lot more before the market becomes oversupplied. So I think it's a nuanced point, but I think it's an important point is where are we starting building from, because that makes a big difference. And remember, we've also got outages in Libya. Sharara, we've seen kind of through our satellite imagery that, that's been offline as well. So again, those things, if that continues, it makes it easier for OPEC, for instance, to bring barrels back and still have $80 Brent as the floor.
You mentioned the macro scare, Amrita. How much does it change things if the macro scare goes from a scare into reality?
So one of the things I found fascinating with the macro scare, like last week, is the fact that oil has actually been sending these signals for a few months now, pretty much since May. Oil's been stuck in a range. We've been kind of seeing lackluster demand numbers, about 1 million barrels per day or slightly lower. And pretty much every signal from the oil market has been global growth is slowing. It's not doing great, especially China. But suddenly now the equity markets have woken up to it. So it's just a delayed reaction. What I will say is by no means is anything suggesting that we are stepping into a deep recession. So I think the market's overshort. And I think this is exactly why oil managed to remain pretty unscathed and actually recover its losses, because it had already been pricing in this slowdown in global growth. So I think it's just that the other asset classes have woken up to the reality.
Amrita, are we going to see $100 barrel again?
Of course, at some point. I'm just not sure it's going to be this year or next year, barring an outright geopolitical event, and that could be U.S. elections and impact on Iran and so on. But right now, given where demand is with the Chinese weakness that we are seeing, it's again still growing, 1 million barrels per day global demand growth, but you don't have China firing on all cylinders, and OPEC Plus managing this market. I think you will see stable prices, but more likely in the 80s than $100 oil.
Amrita Sen of Energy Aspects, thank you so much. And we talk about China weakness. I wonder on a broader scale, whether we're also going to be worrying about U.S. weakness if Home Depot is less idiosyncratic, Danny, and more representative of what we're seeing more broadly.
Yeah, I guess in a roundabout way, though, you could say, well, maybe people are traveling less, they're in their cars more, so the oil usage kind of is up in the air maybe in that regard. But it's true. Already we know China is weak. The oil market is reflecting that, to Amrita's point. What does it mean to reflect American weakness in the oil market, too?
And whether we've actually seen that, especially if you see crude production cut back.
Well, right now we're peak driving season in the United States, but the United States is making up for that Chinese weakness. So if the U.S. has a real growth scare, that's going to be very difficult for this oil market.
Which is the reason why a lot of people are currently out there on road trips, expending a lot of fossil fuels. Coming up, stocks edging higher ahead of key U.S. economic data. That conversation coming up next with Michael O'Rourke of Jones Trading. This is Bloomberg.
many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact, a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
What a difference a week makes. Last week we were talking about turmoil and a vol shock. Today we're talking about a quiet, typical August kind of week. Right now what you're seeing in equity indexes pretty much across the board. Retracing some of the gains from earlier in the session, but still positive. 53.78, S&P futures up about 0.2%. NASDAQ up about 0.3%. But I want to sit on the Russell 2000, down about 0.3%, yet again underperforming. A reversal of the trade maybe that we saw building up. Danny, a real question about how much this is tied to true growth concerns starting to percolate into the picture.
And you get the feeling that maybe the money going into the Russell 2000 was with weaker hands, so you go away with weaker hands. A lot of the outflows came from the ETF. $2.6 billion was pulled from the ETF tracking the Russell 2000. So as soon as you get a whiff of those growth scares, what do we all do? It seems we run away from small caps and, at least over the past couple days, run to our safe and friendly big tech stocks.
You know, it's hard to really get a handle, though, Anne-Marie, on what's actually going on and how much this is real and how much it isn't. Yesterday, how many guests came on the show and said, basically, this is a technical issue, not a fundamental one. And then we hear Home Depot come out, which we'll get to in just a second, talking about how the consumer truly is showing a weakening appetite to spend.
Which is also interesting because we got the New York Fed survey yesterday, and actually inflation expectations at the 1 year are lower. And then the Cleveland Fed came out with what executives are feeling. They're also feeling a bit more optimistic where inflation's going. So you would think that we would start to see more of a pickup when these earnings come out.
You feed that through the bond market, and what you could see is yields not really doing much, basically edging just a touch higher on the longer end and a touch lower on the front end, but basically flat, especially compared to what we saw last week. Key question will be, and this is what I actually am curious to ask throughout the morning, how poised is this market for either a sell-off or a rally if we get a CPI print that shows disinflation? That, to me, Anne-Marie, is going to be one of the key questions at a time where we're looking at a 2-year yield around 4% and a 10-year yield much lower than the 4.5% people were talking about earlier.
Well, Michael O'Rourke, who we're about to speak to, calls this a double-edged sword that the Fed will be dealing with today. We've been in this bad news is bad news market consensus right now. What if there is a deceleration or if inflation accelerates so much that the FOMC aggressive easing as the labor market slows? This is what he's talking about. He said on that side of this, the other side of the sword, the Fed's greater fear that the risk that inflation decelerates too quickly that it turns into a contraction.
Well, so it's definitely a different setup because basically for the entirety of this year, it's been an asymmetric skew to CPI beating to the upside. That like we continue to price in more Fed cuts and then CPI surprises to the upside, and basically that undoes a lot of what this bond market has done. You kind of get the feeling that maybe it's that setup again. If we've priced 200 basis points worth of cuts through the next year, that maybe we aren't ready for a CPI pickup and a market is more braced for downside.
Which is really what we were hearing from Mark McCormick on some levels. And if you push that through the currency markets, a real kind of existential angst has this sort of dollar weakness trade gone too far that has really been hinged and following on the rate cut story. This morning, you're seeing a bit of an increase in the dollar, 109.24, euro lower versus the dollar, albeit pretty quiet this morning. Under surveillance, Donald Trump and Elon Musk holding a friendly but glitch-delayed interview on X, Musk blaming a 40-minute delay on cyber attacks, saying there's a lot of opposition to hearing from Trump. Tesla CEO also calling for a government commission to ensure taxpayer money is spent effectively, and pitching himself, Emery, for the role.
Yeah, I'd be happy to help out if such a commission were to be formed. This is what Elon Musk said. I struggled listening to this entire thing once I was able to get on. If this was really about Trump pitching, you know, viewers and listeners to vote for him, or Musk pitching Trump, not just about joining this commission, but also stop demonizing EVs, the electric vehicle space.
Well, this is actually, to me, one of the takeaways, and Danny, I'd love your thoughts on this from this interview. On what level will his friendship with Donald Trump potentially, should Donald Trump get elected, actually make it better for other auto manufacturers that are trying to sell electric vehicles?
Right, especially if you have a more conservative audience listening, not even just the policy, but a more conservative audience listening who's maybe more skeptical of EVs, and Musk just wholesale pitching it, wholesale talking about climate change is an issue, despite Donald Trump coming back and say all it will do is allow for more oceanfront property. So you have this weird dynamic where they were talking about the same issues, but kind of talking past each other. So again, I wonder how much was a pitch to Trump and how much was a pitch to Trump voters?
And that's the reason why people were trying to listen in. A question about some of the technologies, too, with the greatest cutter and what that potentially could mean. Meanwhile, Home Depot, and this actually is important to sort of question whether this is idiosyncratic or whether this is indicative of what we're going to see from others as well. Cutting its full-year sales outlook, the company expecting consumer spending to remain soft in the coming months as interest rates and uncertainty weigh on shoppers. Comparable sales falling for the 7th straight quarter. Idiosyncratic, Danny, or something that's deeper?
Unfortunately, it is so hard to tell. And at Morgan Stanley, I just want to say, it's done a really fantastic job of tracking all these consumer companies. So Home Depot is going to be the latest one in the negative category. They say that a near record amount of companies are talking about the consumer on their earnings call. But this is the unfortunate thing, is that they are completely split down the middle on those saying that the consumer is healthy and those that are saying it's unhealthy. Obviously, the unhealthy ones are people like Home Depot, the ones tied to the housing market. Luxury companies a little bit more healthy. But even within some of those dichotomies, it's not so straightforward. So you come out with just a very confused picture of a consumer.
Well, Home Depot is talking about these higher interest rates, which feels like it's more of an issue for Home Depot's, Lowe's, potentially on the upper end if you want to have these bigger, more reinstallments of your homes, things like that. Mohammed Alarian says this is underlying an issue for the housing market, where affordability is also being undermined by still sluggish supply, highlights yet again critical importance of labor income for continued U.S. economic growth. So Home Depot feels like it's actually highlighting what's going on underneath the surface, but I still want to see what Walmart says at the end of the week.
And this was sort of the first salvo in a week of really key data points, including PPI data, which comes out at 8:30 Eastern, followed by the CPI report tomorrow. Michael O'Rourke of Jones Trading writing this: there's a number of key economic releases this week, and the market is likely to be highly sensitive to the major ones due to the bad is bad market consensus. The CPI report has the potential to be a double-edged sword. Michael, we were talking with Mark McCormick about how things were set up sort of to the negative in terms of how many Fed rate cuts were being priced in and some of the growth concerns that have dominated and fueled potentially some of the turmoil from last week. Do you disagree with that? Do you think that actually people are not pricing in what it could mean if one of these indicators surprises significantly to the upside or downside?
Yeah, I think, you know, it's funny what you're talking about, the conference calls and whether the consumer's slowing and that mixed message out there. I think that's exactly what's going on in the market right now, where you're seeing a situation where if this was a month ago, you have those Home Depot numbers and you look through them and say, well, it's the high interest rate environment, but we're going to get rate cuts before the end of the year, and that's going to improve. But now that you're seeing some weakness out there, and it's not, you know, it's not small patches of weakness, that you're seeing some investors getting concerned. And I think people aren't fully positioned for this. And that's why you're seeing multiple contraction and obviously the correction we saw last week.
Michael, you called the trading pattern of last week, the market is reacting to noise. If last week was noise, surely this week is something more concrete with the data. Just given how it behaved last week, what does that mean for what we should brace for as PPI, CPI, and retail sales all hit the tape?
So, and that's the problem, right? The market's going to react to every one of those numbers. I would sit there and say the most important numbers are going to be the jobs report, initial jobless claims, and the CPI report. But because we're reacting to everything, it just shows the lack of confidence investors have out there. And it just shows a little bit more of a heightened risk to the environment.
Does that mean if I want to sort of divine a direction of these markets, that I can't do it, that I need to be really tactical short term and basically just watch it bounce up and down?
Well, know what you need to do is you need to figure out what positions you want and where you want to be. And that's how you need to position yourself. You actually need to take this noise and use it as an opportunity to reposition. What I'd say the biggest shift in the past month has been is we've been in this environment where everyone's looking at this Goldilocks type economy that's about to see, Fed rate cuts. And I think that's why multiples are so high. I think that's why everyone was so optimistic, coming into July. And now we're seeing it's not quite Goldilocks. And there's a little bit of a risk out there of a hard landing. So now what you have to do is reposition yourself that there should be more risk in the back half of the year. And then when you get earnings reports like Home Depot here, that just reinforces the need to reposition yourself. So I think that's what we're going to see going on here is investors, when you have a downdraft like we had the last week, it's really hard to sell individual stocks, individual positions. What a lot of guys will do is sell futures to hedge their hedge their portfolios. And then when you get bounces like we've seen, they'll start selling stocks into it and cover the futures hedges. And I think that's what we're looking at in this environment right now.
Michael, what do you look at when you get a Home Depot and you see the concerns about the overall economy weighing on consumers, but then you get the New York Fed survey, the Cleveland Fed survey, when it looks like consumers and CEOs are actually more optimistic about inflation expectations?
Yeah, well, but that's very consistent in the sense that inflation expectations are slowing down with the economy, right? So if the economy slows, inflation expectations, come down. And again, that comes back to the risk we have with the double-edged sword with the CPI report tomorrow, whereas we've spent the past several years just hoping for cooler than expected inflation. But prior to the pandemic, for 2 decades, the Fed's fear has been disinflation. So again, if you get a number that contracts too quickly, all of a sudden fears come out that the CPI report is showing us that the economy is slowing down too much. And then, the Fed really gets worried about a situation like that, because again, that's where you have to be really aggressive with easing if that were to pick up momentum.
So CPI is supposed to come in 0.2% month over month. If we get anything besides that number, what are you expecting in the market, actual markets reacting? How big does the either upside or downside surprise need to be?
If we get just standard month over month, if we get 1/10 or 2/10, we're right in target with the Fed. So those are great numbers if we can get them. I think if we get 1/10, that's fine. If we get 3/10, that's probably fine as well. I think anything beyond those numbers, I think you should see a reaction. I mean, where we've had a 3-month CPI is running at an annualized rate of just above, right below 2%. And although the 6-month rate is annualized rate's higher, January was a 0.5 reading. So when the 5-month rate is right in the Fed's wheelhouse too. So we just need to see this trend that we've been on continue. But again, you're really trying to hit the middle instead of do better or worse than, which becomes a little more challenging.
Michael, I would have to say, since 6 o'clock when Home Depot earnings have come out, S&P 500 futures have almost entirely reversed the gains from earlier this morning. You've seen the Russell 2000 fall further negative, down now about 0.4%. How skittish is this market that any one economic data point or even earnings report, no matter how big or small, can spook everyone?
I think it's very skittish. We're coming from extremely high valuations historically. Those magnificent 7 members were trading 45 times earnings. Now they're down to 40 times earnings, 35 times forward, now 30 times forward. And they're the biggest stocks in the country, in the world. Stocks that large don't grow that quickly, except for NVIDIA this year. So again, there was a lot of optimism priced into this tape, and I think there's actually a number of attractive stocks out there. If you go into small caps, if you go into this, the S&P 600 or the S&P 400 mid caps, there are attractive names. there are attractive groups out there, but everyone's so weighted to the mega caps. And obviously that drives up the multiple for the S&P 500. And again, the environment is not this Goldilocks outlook where we're going to have rate cuts. It's definitely more in doubt, and you have to price in more risk right now.
Michael O'Rourke of Jones Trading, thank you so much for being with us. And we do see a bit of a reversal from the earlier rally as people take a look, frankly, at Home Depot. I can't think of anything else, Danny.
Yeah, they look at Home Depot, and Michael O'Rourke put it great that every time you get a Home Depot, you just got to reposition. It's a market still bracing for Goldilocks. Bank of America's latest fund manager survey, I think, underlined that perfectly. 76% of respondents still think there'll be a soft landing. And even after the chaos of last week, the most crowded trade, still big cap tech.
I thought that was fascinating. I'm glad you brought that up. Right now, let's get you an update on stories elsewhere this morning. Here is Yahira Hakis.
Hi, Lisa. The Wall Street Journal is reporting that China's Huawei Technologies is close to introducing a new AI chip. The chip would allow China to overcome U.S. sanctions and challenge NVIDIA in the Chinese market. Citing sources, the report said Chinese internet companies and telecommunications operators have already been testing Huawei's latest processor, and the company told potential clients the new chip is comparable to NVIDIA's H100, which was introduced last year and isn't directly available in China. A Bloomberg analysis of government data showing U.S. retailers, including Walmart and Target, are selling generic versions of the cold medicine Mucinex that contain a cancer-causing chemical, benzene. The chemical is unlisted and found inside a cheaper version of an inactive ingredient in the store brand option. U.S. regulators have ordered the ingredient phased out, but the deadline has been pushed to 2026 after industry complaints. Staying on healthcare, Johnson & Johnson has cleared a key hurdle for advancing a $6.5 billion plan to resolve thousands of lawsuits by people who say its baby powder gave them cancer. According to people familiar, more than 75% of the group signed off on J&J's proposal through secret balloting. The settlement offer includes claims that the talc-based version of its powder caused ovarian and other gynecological cancers. Under J&J's current offer, it would make payments for current and future claims over a 25-year period. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, fighting for a soft landing.
To look at the economy in totality, yes, you're going to see some weakness, but you're also going to see some areas of strength. What we're seeing is a market of investors and speculators that are overreacting to economic weakness and ignoring economic strength in the Main Street economy.
That's coming up next. The muddled picture that really has not left with many with a clear sense of what's ahead. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Diving into a much different week than last week, this one is quiet. We're seeing the S&P basically almost flat after a disappointing earnings report seemed to temper some of the earlier optimism across the board, a sleepiness that we saw, a similar kind of action on yesterday. Under surveillance this morning, fighting for a soft landing.
To look at the economy in totality, yes, you're going to see some weakness, but you're also going to see some areas of strength. What we're seeing is a market of investors and speculators that are overreacting to economic weakness and ignoring economic strength in the Main Street economy. This data week is so incredibly important because not only will you see financial market indicators, you're going to get a sense of how Main Street is doing next to all these price data that the market is following so closely.
Here's the latest U.S. PPI data due at 8:30 Eastern, the first in a series of key data points this week, which may shed more light on a muddied picture. Meanwhile, we did get Home Depot earnings coming out, which also shed some light. And if that is Main Street, it is looking a little less rosy. Kathy Bostancic of Nationwide Mutual writing this: with economic growth slowing, the labor market cooling, and monetary policy still restrictive, we should see inflation trends moderate through the second half of this year. Kathy joins us now. Yes, inflation is going to be important. We get PPI in less than 2 hours. We get CPI tomorrow. But how much is the focus still so squarely on growth concerns?
Oh, good morning, Lisa. Happy to be with you. Well, I think the concerns are pretty high, and I think they should be. Our base case is that we have a soft landing than we thought before. But I think, recession odds are high. And a big part of the reason is because the Fed has been holding monetary policy restrictive. If you look at their own Fed Taylor rules, they're, even as of February, about 100 basis points tight. Now, that made sense when you were worried about inflation running high. And I understand, we had that inflation scare in Q1. But now when you have concerns about the labor market and that could have a follow-on impact on the consumer, that really cries for the Fed to get going and cutting rates. So they may be too slow, and that's just something that we have to watch.
Kathy, how do you understand all the muddied indicators? We were talking about Home Depot coming out. And a real question here, is it idiosyncratic when it cuts its forecast and talks about how consumers are increasingly deferring their purchases? Is this a housing-specific issue? Is this a Home Depot-specific issue? Or is this something broader that you're seeing in other metrics as well?
Yeah, it's really broader. When you look at the earnings announcements and the guidance that comes with it, the companies that, by and large, that are sensitive to the consumer or consumer related, they've really painted a picture of that the households are becoming more frugal and cautious with their spending. And that just, again, ties in with what we're seeing in the real economic data, that employment growth is moderating, wage growth is moderating, and the consumer is still facing, even though inflation's moderating, that's a growth rate. When you look at price levels, especially in the service side, they're not going down. So, and as you know, the many consumers are tapped out on credit, especially lower income households. So this is a consumer that's hitting constraints, and the tailwinds behind them are just not there.
Kathy, how should we think about the difference between a picky consumer that is stretched versus a consumer that's deteriorating rapidly, something that would eventually lead to a recession?
Yeah, what we'll be watching closely is the labor market, because I think now you have consumer spending, it's going to be in sync with incoming income. Before, consumers could tap into the pandemic-related savings. In fact, we saw that, and they could rely on credit cards. Those tailwinds have diminished. So now you're in sync with income. So that really points to labor market. And as long as we're getting job growth around 100,000, I'm not, going to be calling recession, around the corner. But if we start to get, lower than that, closer to zero, when it turns negative, then, the game is over, and it, we're very much likely, heading into recession.
Well, Fed officials, Mickey Bowman being one of them over the weekend, giving herself comfort on the labor market, saying that, sure, hiring has slowed down or even stopped, but layoffs haven't started. Kathy, should the Fed be taking comfort in that? Or is the very fact that hiring has stopped enough to damage this labor market?
Yeah, I think they have to be careful about looking at lagging indicators like layoffs and the unemployment rate. And also remember that they've got policy restrictive. If they said the risk around inflation and employment are getting more in line or more balanced, they've got policy rate that's probably 100, 125 basis points at least too tight, like not even at neutral right now. So I think they do have to be careful. Yes, things are still strong now, and I don't want to, I think what happened last week was an overreaction. But that said, it should be, motivator for the Fed to take a look and start to be, more open to larger rate cuts.
Kathy, as we've been talking about, when we're looking at the consumer, they are still spending, just not as much. You talked about the fact that some of those pandemic funds have dried up. How will we know that consumers are seriously concerned about a deterioration in the labor market?
Yeah, there are measures in some of the conference reports, like the Conference Board has measures, jobs hard to get, jobs plentiful. Those are good measures to watch. They line up pretty well with some of the employment data. And I think also initial jobless claims just takes on increased importance here, and continuing claims. It's not just the initial, but continuing claims. And what we have seen is, this steady erosion. So far, it looks like to be in line with the soft landing, and indeed, that's our own forecast. But I will feel a lot more comfortable, again, if the Fed starts to lower rates, and they have a lot of room to do that. I mean, that's the good news with rates over 5%. But these high-frequency labor market indicators, like jobless claims, they just take on increased importance right now.
Kathy, just 30 seconds. I heard you say that perhaps a bigger rate cut is warranted. Are you calling for 50 basis points of a rate cut?
We're not, because I think the Fed is going to be cautious, at least start cautious. But I would feel better about the soft landing if they actually entertained or actually went 50 basis points and maybe follow up with another 50 basis points. We look for 75 basis points by the end of the year. But again, I think they have room to cut rates over 100 basis points by year end.
Kathy Bostancic of Nationwide, thank you so much for being with us. Danny, 100 basis points of rate cuts or more than that, that's actually what's being priced into the market right now.
Correct, 100 basis points for the year, 200 for the next year. And it's just such a divide between what Fed officials and market participants think. Because Fed officials say that they do have luxury, they do have time, whereas Kathy's saying the opposite. They have room to cut. In the Fed's view, they don't yet have that room, and they need to wait for inflation to come down.
But if the Fed were to go 50 in September, would that be a tactical admission, basically, that they got it wrong and they were too slow? So now they're doubling down on how much they're going to go.
Well, this is the reason why actually inflation data is going to matter more this week than it has in many other weeks. It will show whether the inflation really still has to be the preeminent concern, akin to growth worries, which really have taken center stage. Coming up next, Troy Gajewski of FS Investments, Henrietta Treyz of Veda Partners, Alejandro Reynal of Four Seasons, and Matt Brill of Invesco. Have you seen that Four Seasons baby? Have you seen it? Talking about
it's everywhere.
Yeah, well, maybe that's a good thing for them. Anyway, this is Bloomberg Surveillance.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The way that I'm describing the evolution of the economy right now is an incremental slowdown. I don't see this as actual weakness.
It's not necessarily that the economy is at a different point, but I think the balance of investors' concerns have changed.
Yes, you're going to see some weakness, but you're also going to see some areas of strength.
The odds of a soft landing are much higher, and the risks have become a little bit more balanced.
When you look at the underlying fundamentals, yes, the economy's slowing, but in a good way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance as we see increasing clouds over the consumer. Alongside Anne-Marie Hordern, together with Danny Berger, I am Lisa Abramowitz. John is out cruising for the remainder of this week. Right now, very much looking at consumer concerns that are pulling back some of the earlier gains in the session. Danny, Home Depot kind of driving the charge in fueling those concerns.
And Home Depot, the CEO in the commentary, very clear that it is a two-pronged issue they are facing. One, it is higher rates that's keeping this housing market frozen. But the change, Lisa, and you pointed to this, that it's now a consumer under pressure, that it's not just about higher rates, but it is a pullback in their spending too.
The key question, Anne-Marie, being, is this a Home Depot problem or is this a broader problem? And the answer is about as clear as everything else is right now.
I love Home Depot, though, the CFO coming out and saying it's deferral. So basically, they're not spending right now, but we do expect consumers to come back. And Danny brought up the Bank of America fund survey, shaken, not stirred. They're talking about the fact that core investor optimism, shaken, not stirred, 76% still expect a soft landing. So maybe people are deferring for the next few months, and then we can maybe see a pickup.
From a market perspective, the key is the balance of risks. And this is a reason why people are watching PPI today in about 90 minutes time, and then CPI tomorrow so closely, because they're looking at this and saying, is inflation coming down enough to be written off as a main concern by the Federal Reserve? Right now, markets are saying yes, almost as a given, and that the Fed will have room to cut by 100 basis points later this year.
I actually wonder if it would make things worse if the Fed does something like a 50 basis point cut in September, because it's acknowledging that there is such a big risk. If they flip from saying, we're waiting for inflation to come down, to saying, you know what, we're going to do a jumbo 50 basis point cut, some market participants might have this idea, what does the Fed know that we don't? That they feel this need not to do an intermeeting emergency cut, but something that looks like an emergency cut of 50 basis points in a meeting.
Well, I think that's a great point, and something people have pointed to as to why they won't do it, because they haven't signaled. And if they haven't signaled, they might surprise markets. That said, there's really a lack of clarity in terms of what the economy really is doing in terms of how much it's slowing down. You look on one hand, small business confidence coming in at the highest level in more than 2 years, and then on the flip side, and Amory, I thought this was fascinating with the oil discussion. We're talking about geopolitical risks. We're talking about how that could lead to a potential oil surge. And what we're hearing instead is it's reflecting weakness, which is actually capping how much oil prices can rally.
Yeah, weakness in China, which really it's the fact that the U.S. is using more fossil fuels is the fact of the matter is pretty much making up for some of that slowing demand we are seeing out of China, which has been a big concern for the oil market. But Amrita said, talking about what you're seeing in the price right now, this is just geopolitical risk. The supply in the market is not being touched, which is why she thinks basically maybe 80 is the floor.
Which is the reason why people aren't necessarily using this as much as a signal about geopolitical risk. It may be a little bit more of a muddied signal even when it comes to growth. Coming up this hour, we've got Troy Gajewski of FS Investments, as well as key inflation data. Henrietta Trey's of Veda Partners following a conversation between Donald Trump and Elon Musk on X, and Matt Brill of Invesco on why he still expects a soft landing in markets. It is quiet, although we've retraced some of the gains that we had seen earlier in the S&P. Futures basically flat, and we're taking a look at yields also pretty much flat. So across the board, pretty quiet. We begin with our top story. Stocks looking for direction as traders await PPI out at 8:30 Eastern. CPI and retail sales data still to come this week. Troy Gajewski of FS Investments writing this. Significant weakness in the lower end consumer started to show up last quarter. Have we stepped down from excess consumption driven by excess savings to a new normal where consumption is completely dependent on the labor market? Or is there something more sinister going on? Troy joins us now. Troy, I will ask you your own question. What's the answer?
Yeah, we think it's a logical, rational slowdown from a period of time where the consumer just consumed like crazy, right? And when you step back, remember you had all the excess savings built up during the pandemic. We had a white hot labor market, not red hot, but white hot. And so what you've seen is a continued cooling of that to somewhere between, let's call it warm and closer to hot, which is where the labor market is today. That note in particular was referring to the earnings, and you were talking about Home Depot before. We think in this earnings season, there were two real questions. Like one, would mega cap tech continue to spend on AI aggressively and allow their margins to compress? So far, that seems to be the answer. And two, were there any signals in earnings that were incredibly disastrous like we had in 07 or early 08 that signaled the consumer was going from a period of strength to a period of acute weakness very, very rapidly? And we just don't see that in the data. We see slower growth, which is a necessity to cool inflation, and it'll allow the Fed to cut very marginally by the end of the year.
So what does this mean in terms of strategy? Because right now, it's unclear to me what the market's actually positioned for. Isn't that kind of describing the muddle that the market is kind of parsing out right now, this idea that we're not falling into recession by any means, but that we are seeing a slowdown that's going to be bumpy?
Yeah, I think it depends on the asset class. So if you think of strategies like private equity or private credit, what we've been fearful of is a hard landing at some point. We always thought those odds were low, but now they appear to be even lower now that a lot of recession indicators have gone from red light to something more normal. Because anytime you're in equity, whether it's public equity or private equity, you really fear that recession because it's much harder to grow EBITDA and earnings in a contraction than in a 1% to 2% real economic expansion. And then in terms of private credit, when you think about this, we've been able to earn excess income for quite some time. And obviously, we didn't want to give some of that income back through a recession-driven default hangover. So at this point, we're happy to concede a little bit of income from the front end coming down in order to keep those recession odds incredibly low, which we think they still are.
Troy, what indicators are you looking at that have gone from red to normal? Because most of the folks we've been speaking to are saying, quite frankly, exactly the opposite.
Yeah, so I think when you look at bank lending, for instance, right, this is one of the last indicators to flash red light, right? We had the inverted yield curve, we had money supply contracting. We technically had a recession, as you know, in 2022, but because the consumer was so strong, the consumption powered us through, no problem. So bank lending started to contract and then stagnate for several quarters coming out of the failures. And now you've started to see lending pick back up, albeit with tighter underwriting standards. And then you think of the yield curve was what we consider massively inverted, 2s, 10s by over 100 basis points plus. And that started to normalize to some extent. And then importantly, again, when you just get back to GDP contributors, there's an incredible amount of spends that are already built into the future through business fixed investment, not only mega cap tech, but also on the energy side. And then furthermore, government spending, for the most part, federal and state and local, with obviously the exception of California, which is still a wild card, continues to spend at a very healthy rate. And we know that's criticized by some, but growth is growth and jobs are jobs. And as long as labor market continues to create 100, 150,000 jobs, we should be able to avoid a recession. So some of the darker indicators are now, let's call it yellow to even flashing green, as we're expecting the Fed to cut later on this year.
What does that mean for your market call then, Troy? Because this is a bond market that is pricing in a level of cuts that looks something like a recession. So what is it? Is it short bonds, load up on risk then?
Yeah, well, let's not get carried away with loading up on risk. I mean, we're Northwest Quadrant, the efficient frontier people, so we like lower risk with, high single digit to low teens returns. We're never trying to, hit home runs or grand slams. But if you think of fixed income, look, our biggest criticism of bond permables has been this expectation that the Fed would gradually take the front end to 3%. And in that environment, the 10-year yield would continue to drop. And that would mean not only will we have the longest inverted yield curve really in a non-recessionary environment, but we'd continue to have a yield curve inverted as the Fed continued to cut. So when you think of fixed income, yes, the risk-adjusted returns are much better today than they were at the end of 21, when fixed income was the definition of return-free risk. However, it's really hard to argue you have material upside in the back end of the curve right now, but the front end should drop slowly over the next several years. Now, if you think of different strategies and alternatives, it's a great time to be a private lender if you have dry powder to lend into liquidity vacuum, partially driven by that pullback in the banking system, partially driven by just a massive growth in nominal GDP and the fact that there's a big shortfall in actual lending versus lending capacity. And then if you think of private equity, you really want to be in strategies where you don't need financial engineering, you don't need balance sheet leverage to generate returns. And that always brings us back to the middle market, where it's about organic growth as opposed to financial engineering and multiple expansion.
Troy, you say at the end of the day, the only thing that matters is mega cap tech stocks. So can these companies continue to maintain or even grow their margins?
Yeah, so I think that, again, was one of the key answers to this earnings season. The question, we had a 2 or 3 quarter period where despite massive growth in business fixed investment, AI spends, there was enough ancillary or core business growth, I should say, to drive margin expansion. What we see in this earnings season is that's over. And across the board in mega cap tech, the decision's been made to spend for growth. We'd rather overspend and not miss the boat than underspend and get left behind. So we have seen some degree of margin compression. Now, it's not a zero-sum game, but to some extent, when you think about what it means for semiconductor stocks or NVIDIA or others, it means those spends are going to be more persistent, and mega cap tech is going to look past margin compression to continue to spend aggressively. And the mystery, of course, which we certainly don't have an answer for yet, is what is going to be that key growth driver where there's a return on invested capital. But for the time being, markets are giving those companies a pass, just given their tremendous free cash flow growth.
Well, that key driver is going to be AI, is it not? Are you seeing anywhere in the space that you like what they're doing in terms of all of this massive spend on artificial intelligence?
Oh, well, again, the expectation is the key driver will. The key word is will, right? But you've yet to see in companies like Meta or Google or others a clear return on invested capital. You're starting to see growth. You're starting to see growth driven by that. But it's not like you've had this revolutionary moment quite yet. The expectation is that will come, and that would arguably be the biggest risk. If we get out 2-3 quarters and there still isn't an attractive return on invested capital, then that margin compression will probably be viewed much more dimly. And you got to take perspective evaluations here too, right? The Magnificent Seven minus Tesla plus Eli Lilly have only gone from 36 times forward earnings to 34. So yes, we've had a mini correction, but we certainly haven't had something that looks like 22 or what we used to consider a more pronounced correction in the 10 to 15% range for the broader market.
I love the substitutions, how people are trying to basically to redefine what Magnificent Seven means to them. Troy Gayeski of FS Investments, thank you so much, and have a wonderful rest of your summer. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hackens. Yahaira.
Hi, Lisa.
U.S. officials believe an Iranian attack against Israel has grown even more likely and may come as soon as this week. Allied leaders are seeking to head off all-out war, and the Pentagon deployed more forces to the region. Briefing reporters Monday, White House spokesman John Kirby said the U.S. and its allies have to be prepared for what could be a significant set of attacks. Some are surprised it has yet to happen, given Iran has threatened for days to retaliate after the assassination of a Hamas leader in Tehran. Israel has neither acknowledged nor denied responsibility for the killing. According to a global survey by Bank of America, the volatility in global financial markets hasn't derailed investor optimism around tech giants or expectations of a soft landing. The poll was conducted during the height of last week's turmoil and showed a defensive rotation into bonds and cash and out of equities. Meanwhile, long bets on the Magnificent Seven remain the most crowded trade, albeit less so after the sell-off. And Home Depot lowered its full-year sales outlook, signaling that it expects consumer spending to remain soft in the coming months. The company sees comparable sales falling 3 to 4% for the year versus the previous expectation for a 1% decline. The disappointing results come as consumers have held off buying homes or pursuing big renovations amid high interest rates and economic uncertainty. Comparable sales also came in worse than expected, falling for the 7th straight quarter. Shares are falling down 2% in the pre-market. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Pairing some of those losses, though, from earlier, down almost 5% at one point, as people really look through what the tea leaves actually are and how idiosyncratic and long-term this actually could be. Up next, trying to stop the Harris surge.
If we have her as a president, if we have a Democrat at this moment as the president, I don't think our country can survive.
I think really it's essential that you win for the good of the country.
That's coming up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Taking a look at a market that's seeking direction right now as we take a look at a host of economic data points, including earnings. Home Depot coming out weaker than expected. We get PPI in about an hour and 15 minutes, and then CPI tomorrow, with Walmart capping it all off with retail sales on Thursday. Under surveillance this morning, trying to counter the Harris surge.
She is far worse, they say, than Bernie Sanders. If we have her as a president, if we have a Democrat at this moment as the president, I don't think our country can survive.
It's essential that you win for the good of the country.
Here's the latest. Donald Trump taking aim at Vice President Kamala Harris in a wide-ranging conversation on X with Elon Musk. The conversation coming after Musk endorsed Trump last month, with Trump's campaign looking to curb a wave of momentum for Harris. Henrietta Trey's of Veda Partners joins us now. Henrietta, a lot to talk through about this particular discussion. I just want to start with, what was your main takeaway?
The main takeaway was that this was a great opportunity for X to promote Spaces. I mean, over 1 million listeners at some point, but it was sort of 2.5 hours of two guys in a room agreeing with one another. I wouldn't call it an interview, but more of a conversation that touched on all the hits that you hear from a Trump rally or other press briefings that the former president puts on. There wasn't a whole lot of new information there. The main takeaway for me was that Elon Musk is interested in getting further involved in the federal government, being part of a federal sort of task force to take on government spending and efficiency, as he calls it. But that was really the newsiest part of the interview to me.
Henrietta, what I took away is that Musk was advocating for two key things. One, to stop this demonization, which I think some would view as coming from the far right when it comes to sustainability and EVs, but also deregulation. He brought it up a number of times. Do you think he was successful, Musk, in convincing Trump and potentially some Trump acolytes on that call?
I think that there has been a history of Musk being able to move former President Trump, specifically electric vehicles, government subsidies of that industry in particular. When it comes to deregulation, I think that's already a big part of the platform. When I speak with Republican staff, that's always a refrain. So I think there's a primed audience for that conversation. They could certainly be receptive to that. What's obviously interesting about that is that you simultaneously don't have the votes to repeal the federal subsidies for all of those industries in the clean energy tech space, the manufacturing tax credits. 18 House Republicans just sent a letter to Speaker Johnson saying, hey, we need those subsidies to continue going. They promote job growth in our districts. They're promoting, research and development. They're countering China. So I think they're going to have a lot of trouble actually governing on that agenda next year if former President Trump is reelected.
So last night was pretty light on substance, but potentially from the Harris camp, we'll actually get some policies on Thursday. We have not seen a policy proposal yet from the Harris-Walz campaign, and they're going to be coming out with this economic plan. What are you expecting?
Yeah, we're expecting the plan to be rolled out around Thursday. Obviously, there are not a lot of heavy-hitting interviews happening right now, last night being an example. So I don't know that the Harris-Walz team needs to get too in the weeds. My advice to clients is to focus on the bill that the House Ways and Means Committee put out in 2021, which received widespread support from the Democratic Conference. It includes a top corporate tax rate of 26.5%. It's graduated in. And I think overarchingly, whatever Harris does put out on Thursday, take that as the high watermark. When you go into Congress next year, in the off chance it's not a Republican-controlled Senate, you're going to have to thread the needle very, very closely to get 218 votes on anything in the House and 51 or 60 in the Senate. It's going to be much more lenient than whatever a Democratic proposal comes out looking like on Thursday.
In the meantime, Henrietta, we're about a month away from early voting starting, and by all accounts, this is going to be a lot of early voting compared with historical references. Is Donald Trump more or less out of time in trying to define Kamala Harris?
I have two things to say on that. Number one, the most important thing that happened last night is that Arizona put the abortion issue on the ballot. That is something that got double the number of signatures that they need. They didn't bring abortion up once. That's the whole state of Arizona. If Democrats hold on to Arizona and pick up Nevada and keep it in the blue camp, that seriously undermines Trump's electoral college strategy. So they should be focusing on that. And I think time has run out on Trump being able to define himself in a way that's favorable to the majority of Americans on abortion, certainly with J.D. Vance's position. Secondarily, you mentioned early voting. 72% of early mail-in ballot requests in Pennsylvania came from the Democratic Party. What the Republican conference led by Trump and sort of the concerns over election fraud have really driven is a material tactical disadvantage in denigrating mail-in balloting, which allows the campaign to bank voters, get those people off your rolls once they've already voted, and focus on the people you need to turn out on election day. It's a tactical disadvantage that I think the Republicans have been screaming about for several years, but to no avail at this point.
Henrietta, but it also brings this possibility that Republicans can continue the line that they did in the last election, that it was rigged, that there were issues, if it was all mail-in ballots, that they weren't genuine. How concerned are you about a peaceful handover, not a handover, a peaceful continuation of power, I suppose, if Kamala Harris is the president?
You know, what's really interesting, and I heard this from Republican staff as long as a year ago, keep in mind why there was a delay in 2020 and why there was a delay in calling Nevada and upending the Arizona turnout or decision-making process. It was because of who was in office at the time. When Biden is in office, which he will be come this November, it's going to be a much more orderly process that adheres to what's actually happening on the ground. No one's going to be calling the governor of Georgia saying, find me the votes. So I think who is actually in office right now materially impacts whether this will be a smooth transition. I expect that it will be. You can claim that there was fraud, but it's going to be certified hopefully within the next day or two after November 5th.
Henrietta, given the fact that we haven't gotten a lot of policy proposals that people actually are taking seriously, I'm wondering how much you actually do think that the Federal Reserve is going to avoid cutting rates too much or too soon in order not to seem like a political agent. And I say this because in the absence of real policies, we have heard a lot from the Republican camp, from J.D. Vance as well as Donald Trump, about having a more political hand in the Fed, whereas the Harris camp is talking about not so much. How does that color your view of it?
Well, I think we have to focus on what's going to be happening next year. Extending the 2017 tax cuts is going to cost $4.6 trillion. I'm getting a lot of inbound questions from clients about whether there will be deficit reduction next year. There's no scenario where the deficit is reduced next year. There will be substantial federal spending. It'll happen as soon as September 30th of this year. I expect we will continue to get aid to Ukraine, albeit at smaller and lower amounts. Along with Israel, there will continue to be federal spending on par with what we've had in the past, which is about $1.7 trillion just to keep functionality. And then next year, we have to keep the tax bill extended. And I suspect that almost none of those tax cuts will expire. So the Fed is going to have to contend with some of the political stuff, but more importantly, with just the fiscal outlays that are going to be coming through, whether Democrats or Republicans win next year. So I think engaging with the Fed and trying to meddle from a political perspective, as somebody who was there when we did TARP and the auto bailout, and that's not what I want to see. You need the autonomy of the Fed. And I think that they'll fight tooth and nail for that.
Henrietta Treyz of Veda Partners, thank you so much. We're talking about the Fed and sort of the dynamic around it, as there's some real questions about growth. And we were talking about Home Depot and what's going on there. Torsten Slok, pretty much on cue, comes out with this. The media is full of anecdotes from earnings calls about the economy supposedly slowing down. But the reality is that firms on earnings call talk less and less about recession, Danny. In fact, we have never had a recession at the current low level of recession talk. See it again, chart below.
I would just raise Torsten Slok, Morgan Stanley, saying that they're talking about the consumer more than ever. So we'd be not concerned about recession, but certainly about consumer slowing down.
Or Citi as well, just publishing now. Rise in unemployment rate, plunge in ISM manufacturing suggests the U.S. economy may have already been in a recession.
Got that? All clear. Coming up, Alejandro Reynal, President and CEO of Four Seasons, as we take a look at the consumer, particularly the well-heeled consumer, and how resilient they have maintained, even as you see weakness in some of the tiers below. This is Bloomberg.
Yes, I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A week of data really kicks off today with PPI coming in about an hour time. Good morning. Welcome back. This is Bloomberg Surveillance. What we're seeing in markets is not a lot. Basically, range-bound as people parse through ahead of the economic data. S&P futures up almost 0.2%. NASDAQ outperforming once again. The big tech havens really highlighting their status as that. Meanwhile, Russell 2000 underperforming it again, down 0.2%. In the bond market, a real question here about whether people are getting over their skis with expected rate cuts and just how weak the economy is. You do see a 4% exactly on the 2-year yield, though flirting with going south of that, and 10-year yields lower as well, 389.97. But Danny, 200 basis points of rate cuts by the end of next year is basically what's being baked into the market.
And that is something that would be consistent with a recession, right? To cut by that amount. And most people aren't saying there's a recession. They're saying just that the Fed has room to cut by that amount. But what signal does it send if a Fed were to cut something like 100 basis points this year in an environment where there's not a recession? That means that going into data like CPI, perhaps the risks are skewed, that if it surprises to the upside, there's only one direction for bonds to go, that there is a clear pain trade in this market if we're pricing in so many cuts.
There have been plenty of pain trades. They've all been executed, basically. We're looking also at the potential of what that means for the dollar. Does that mean dollar strength? Mark McCormick of TD talking earlier that he sees that sort of over-exuberance about rate cuts getting priced in today. A little bit more strength in the dollar than we've seen over recent sessions. Euro falling just a touch, basically flat, 109.27, as people try to reset the balance of risks. Under surveillance this morning, U.S. officials saying they believe an Iranian attack against Israel has grown even more likely and may come as soon as this week. White House spokesman John Kirby telling reporters yesterday that the U.S. and its allies have to be prepared for what could be a significant set of attacks. And Marie, definitely really keeping high alert pretty much across the world.
Yeah, so the United States is basically saying the Israelis think it's coming. We agree with that assessment. Remember in April, Iran sent over hundreds of ballistic missiles. Most of them were intercepted, and they were able to the United States, along with Israel, able to fend this off. What is concerning now is that maybe it's not just going to be Iran, but it's going to be Iran plus Iranian-backed militias. How much harder will it be, not just to have the defense, but then to set a standard of deterrence? And I just think, besides what the White House is saying, look what the DOD is doing. The movement of forces into the Middle East, including USS Georgia, a submarine equipped with more than 150 Tomahawk missiles. So clearly, they're either getting set for two things. One, this could be an act of deterrence to tell Iran, do not go here, or this is for pure defense.
And that's the reason why a lot of people keeping a clear focus on this. We will be providing you updates throughout the day. Meanwhile, General Motors cutting jobs in China. Sources telling Bloomberg that the company will meet with local partner SAIC in the coming weeks to plan a larger structural overhaul of its operations there. Danny, a real question here about just how much U.S. companies in general, multinational companies, can continue expanding in China, or how much they've got to retrace with a lack of visibility in how business-friendly they're actually going to be to international companies.
Right, exactly. Not even just that, but how do you compete in a market that is flooding itself with not just EVs that American and other international companies are having a hard time keeping up with, but cheap ones? By all accounts, something of a price war happened in China, where you saw the likes of Tesla having to cut their prices too. So how do car makers keep up with that when you have to worry about geopolitics, local players, and the cost, and the fact that a lot of them are behind on technology, and China's quite ahead with things like over-the-air updates? It's almost an existential crisis for GM at this point.
Well, and certainly other companies are trying to parse out what they can do, what they're going to do quietly, what they can actually say on the record. Meanwhile, traders awaiting U.S. PPI due at 8:30 Eastern. Our survey expecting headline producer prices to increase 0.2%. It's basically in line with what we saw in June. Core PPI growth likely slowed to 0.2% from June's 0.4%. Key question here is just whether the inflation will come off enough to give give the Fed some room to cut rates. Turning to travel, and really this is the reason why we wanted to highlight travel this particular week. We're seeing a real discrepancy between high-end travelers and low-end travelers in terms of their position to spend. Is there a change in that? Four Seasons CEO Alejandro Reynal saying his company has seen its strongest year ever, writing this: short-term uncertainty given the current geopolitical and macroeconomic pressures are impacting traveler sentiment, but the luxury segment is more resilient. Alejandro joins us now. Alejandro, thank you so much for being with us. Pleasure to have you here in studio. I want to start there. Is it true that you're not seeing any slowdown whatsoever in the luxury element?
Good morning. Thanks for having me. It's a pleasure to be here, and I love the fact that we're talking about luxury hospitality. Yes, I mean, we had a really strong first half of the year compared to last year, much better. When I look into the booking trends for the second half of the year, even going on into 2025, they look very strong as well. You know, I think there's two things that are happening there. First and foremost is that the luxury guest or luxury consumer continues to be very resilient. They continue to spend, you know, that desire for experiences, to explore, continues to be there. But also I would say that from a Four Seasons angle and from a Four Seasons point of view, we do offer a very clear value proposition to our guests. I mean, we do have, very proud to say that we have the very best hotels in the best locations, and we provide the best service to our guests. And when you have that as the brand proposition, and that's what we do at Four Seasons, there's a demand for that. And by the way, this is not new of this year. We've been operating now for 60 years, and that has been the constant all throughout the period. So
what has changed? And I'm wondering, not just from the consumer who's able to spend, but also from the employees and who you're able to recruit. For a long time, there was this dearth of people willing to work in hospitality in the direct aftermath of the pandemic. Do you see it as being much easier now to hire people and sort of easier to also retain them without massive price increases, wage increases?
Yes. I mean, obviously for us, a key component of what we do is through our people. I mean, we are a service company, and the most important asset is the people that we have with us. So we place a lot of emphasis in making sure that we are the employer of choice in every single market that we operate. We do spend a lot of time training people, developing them. For us, we do measure employee engagement twice per year. We are at the 2% across all industries in terms of employee engagement. So it's a topic that we spend a lot of time because we do believe that we need to have the best and most engaged employees with us. We haven't had, I mean, obviously, right after the pandemic, there was a little bit of pressure from the labor point of view. We don't see that anymore. But again, it's because of the efforts that we place in making sure that we are the employer of choice in the markets in where we operate.
I want to know more about your customer, but specifically like the ultra luxury. And there I know you have a private jet service, something like $115,000 for a charter a day. Yes. How much demand is there for that?
Yes, you know, it's interesting. And just to give you the context of this is, obviously Four Seasons started as a hotel and a resorts company, and we are now the leading luxury hospitality company. And that's where our guests experience the brand. What we found over time is that because our second business is the residential, branded residential, so guests, they stay with us, they experience the brand, and then they are willing to buy a residence with us. So that's sort of the journey that they start experiencing with Four Seasons. And then the third piece is what you just said, is the journeys, experience-based travel that we promote as a third line of business. So if you think about the whole analogy, guests, they stay with us, they live with us, and they travel with us. They develop such a comfort with the brand and with the brand promise and the brand proposition that they're willing to spend that amount of money in traveling for 20 days through 10 Four Seasons in Africa or in Europe and so forth. So for us, it's been more around creating this luxury ecosystem for Four Seasons that our guests are eager to travel. By the way, we have all the itineraries for this year sold out for the rest of the year. So it's a very successful product, but again, it taps into that desire to experience, to explore that we find in our guests.
So you're saying we're too late for it then?
Yeah, 2025, we're opening
Good to keep in mind. I mean, just talking about the different mix of your businesses, You're not the only one doing it in this space, and it obviously is an exclusive space of those who can offer this. But you think of, the Amman Resorts also trying to give also experiences to. What does competition look like right now?
Well, competition, because of the attractiveness of the luxury space, there's a lot of competitors coming in. I think we have, as a Four Seasons, the advantage of the brand. I mean, we are the most, we continuously measure brand preference, brand awareness in terms of our brand, and we continue to be the #1 luxury hospitality brand. And I think that carries a lot of weight, but it's because at the end of the day, we're able to deliver that value proposition to our guests. I mean, it's interesting because I do interact with a lot of our guests, and when I ask them what do they like about the Four Seasons, the first thing they tell me is that I know what to expect. And I've been able, as a guest, to explore remote destinations. So, for example, I've been able to go to Bora Bora, but because there's a Four Seasons, I feel comfortable because I know what to expect. And to have that level of consistency and that brand power is very, very unique. So I think we're uniquely and very well positioned.
Where do you see the demand right now in terms of the hot spots, top 5 people are traveling to?
Yeah. It's interesting because, and I'm going to say something which is a little bit contrarian. When I look into the history of Four Seasons over the last years, travel patterns haven't changed much. For example, 55% of our revenues come from the Americas, the majority being the US. More than 50% of our guests, they are from the US. And where do they travel? To the US. Right now, during the summertime, they travel to our South Florida collection, they go to Hawaii. Beyond the US, they go to Mexico and then Europe. The fact is that, and this has happened for many, many years, Americans are going to go to Europe probably once a year, every summer. I mean, and we're seeing that again this summer, but it happened prior year. So, but again, America is representing 55% of revenues. For us, EMEA, Europe and the Middle East, represents 25% of the revenues. And there the dynamics are similar. Europeans, they mostly stay within Europe. They venture into the Middle East or Africa. And then we have APAC, which is 20% of our business. 3% is only China, and that's mainly regional travel.
Do you still see the Chinese consumer spending as much in luxury hotels the same way the US consumer is?
No, they have not come back. I mean, when I look into what was the spend prior to the pandemic, it's less. It's interesting because they are spending less in China, so we still don't have the same rates that we used to have prior to the pandemic in China, but they are starting to spend more internationally, but internationally within the region, meaning Japan for the most part. Because of visa issues and many other things, they still have not come back to Europe or the US, which is where we saw them prior to the pandemic.
There's a real question here about how much, and Torsten Glock of Apollo called us out for us this morning. He said, all you people in media, and I'm paraphrasing, just keep using everyone as an anecdote to try to paint a macro picture. Your company has been around for 60 years. How independent of the macro cycle is it, right? I mean, because are we talking about something that is a complete microcosm unto itself of people who have disposable wealth and are going to travel no matter what, versus a company that does have some sort of sensitivity to what's going on in the underlying consumer sentiment?
Yeah. I mean, I would be lying if I would say that we are immune to any macroeconomic geopolitical impacts, because we are. I mean, at the end of the day, that uncertainty impacts traveler sentiment, and people don't travel because of that. But obviously, we've been operating for 60 years, and we've gone through these cycles, and they go away. And at the end of the day, what we see is year over year that the market continues to grow. I mean, travel and tourism has been growing for many years now. That desire to experience, to explore continues to be there. I think it's really interesting when you look into the luxury consumer that our composition of guests, about 20% are boomers, 45% are Gen X, 35% already are millennials. So that transfer of wealth is starting to happen, but we're not losing the boomers. So it means that the market is expanding. So always, year on year, there's going to be more demand, more growth. And at the end of the day as well, we as a hotel and resort company need to be at the forefront in terms of creating amazing experiences so we can satisfy the demand. So I don't think at the end of the day that the demand just comes by itself. We need to have, like we do, a very special product, a very special service proposition to our guests. So at the end of the day, they are eager to come to a Four Seasons.
So you're doing great with the baby class. I hear that you're really, crushing it, particularly south of the U.S.
paid actor?
No, it wasn't. But that's one. It's a tremendous learning experience because sometimes you spend so much money on marketing that doesn't provide any outcomes. But then these special, authentic moments are the ones that the consumers value the most. This was a complete viral moment, but it was completely authentic. We had nothing to do with it. In the end, we had more than 300 million views through various digital platforms on the Four Seasons baby. Obviously, we got a spike on on searches on Four Seasons Orlando. So it was very good. But again, it was very authentic, which ultimately is what people like.
I love it. I wonder how many board meetings were about the Four Seasons baby. Alejandro Reynal, Four Seasons CEO, thank you so much for being with us. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Israel's sovereign debt was cut by one notch by Fitch Ratings, which kept a negative outlook on the credit as continued military conflict weighs on the country's public finances. According to a statement, the ratings firm lowered the country's score to A from A+, citing continued war and geopolitical risk as drivers. The analysts said, in their view, the conflict in Gaza could last well into 2025, and there are risks of it broadening to other fronts. The NFL is meeting with a handful of private equity groups this week. According to people familiar with the process, it's a step towards opening the league's ownership ranks to institutional money. The meetings are intended for the league to conduct more due diligence, but also to talk through potential policy preferences. The NFL is the only major U.S. league that doesn't allow institutional investors. It has spent more than a year observing results from other leagues and discussing what it might do differently. And Alphabet investors are anxiously awaiting a Google hardware event today, hoping new AI features will help stop a sell-off that's wiped out more than $360 billion in market value in just 1 month. Google is unveiling one of the biggest redesigns of its Pixel phones in their nearly decade-long history. Alphabet is also expected to reveal on-device AI offerings driven by Gemini's large language model. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, raising cash ahead of the data.
We are looking at the curve to steepen, but we have to be very mindful here about what economic scenarios we're taking into account when thinking about the yield curve, because it is very much so hard landing, soft landing, no landing dependent.
That's coming up next. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
everyone is still planning their vacations for the remaining couple weeks of the summer. Welcome back. This is Bloomberg Surveillance, taking a look at a market that is reflecting the fact that most people are on vacation, up 0.2% in the S&P, just really going nowhere. If you look at the currency markets as well as in the bond market, you're seeing a little bit of a retracement in crude after a 5-day winning streak that led to yesterday's rally, which was one of the biggest going back to November. Under surveillance this morning, raising cash ahead of the data.
We are looking at the curve to steepen, but we have to be very mindful here about what economic scenarios we're taking into account when thinking about the yield curve, because it is very much so hard landing, soft landing, no landing dependent. When we have greater conviction in the harder landing outcome, there's no absence of demand for Treasury securities.
And maybe just not Treasuries. Here's the latest. More than a dozen companies tapping the investment-grade credit market, hoping to raise over $18 billion and making the offers before key inflation data this week. Matt Brill of Invesco writing this, potentially a buyer, evidently. After major volatility, yields still look reasonably attractive for IG bonds, yet spreads no longer look rich. It's been a wild ride for rates and credit spreads, yet our expectation of a soft landing still holds. Matt joins us here. Matt, great to see you. So have you been hoovering them all up, all these bonds that are being sold by the companies?
We have. We've been very active. It's been incredibly busy last few days, really starting on Wednesday of last week. And you just saw just a continued just issuers after issuer coming to the market. And you know, we look at all-in yields, they're still north of 5% for the investment grade market, and that's attractive. But there was so many complaints for the last several months that spreads were just so tight, and that nobody wanted to buy them because spreads were so tight. But all of a sudden, you've got a little bit of a sale going on within the investment grade market.
I guess there's a key question here. We did see spreads blow out quite considerably in last week's turmoil. They haven't retraced, as you say. They don't look quite as rich. They're still about 1 percentage point. Doesn't this, though, raise the issue that if you do get more weak data, you could see that really be reflected in credit markets more than people were really saying earlier this month?
Yeah, so we're absolutely in the bad news is bad news type of market now. So maybe a year or so ago, if you got bad news, you could think, okay, maybe that means less inflation. But now it really does mean potentially fundamental problems. But we're not really seeing that. So we actually still think spreads where they are. Yes, they're not compensating you for a recession, but we don't think there's a recession that's going to come. So everybody wants to wait for the river card to get played and then say, okay, well, now I can go place my bets. But that's not how the market works, right? So we're trying to look ahead, and we do think that even with this hiccup last week, we're still on the track for the soft landing.
How much, though, does it make a difference that you have a high-yield market that is much better quality than it once was? If you're thinking about a typical sort of growth scare playbook, does it look different this time around?
You know, we think so. So if you think about what's happened within the high yield market, you have a lot of private credit that's taken away a certain portion of that market. You also have bank loans that have taken away other portions of the market. What's left is generally the highest quality double B type companies. So it's not your father's high yield market, if you will. You're also seeing that in the investment grade market, where the lowest portion of the investment grade market is only about 10% or so rated triple B minus. So on the verge of potentially going to high yield. So if there are problems, we think the market is better set up to handle that. And that's partly reflected in spreads, but just overall, we just think that tail risk is significantly less than it probably was, just 5 or 7 years ago.
Even so, the flows have had a clear divergence just the past week, where you have high-yielding funds seeing outflows for the first time in some time, and then high grade continues to get just an amazing pace of strong inflows. Do you expect, again, just because of the sentiment of this market, that divergence to continue?
So I think high yield will come back if you get a little more stability in the market. I think just given the shock that you saw, it's sort of hard to jump right into the high yield market. But overall, once you stabilize and you look at high yield, where it's trading from a yield standpoint, it's going to look pretty good if you believe that we're not heading into recession, which we still need to see a few data points, I think, to get people to believe that. But again, go back to investment grade. It's mainly been an institutional buying spree for the last several months or really several years. But within the last week or two, we're starting to see the retail market pick up. We're starting to see, we had advisors meeting with us yesterday from Miami up here in New York. They're saying, we want to get our investors out of cash and out into term debt. And we're afraid to do it in a high yield, but investment grade at 5%, that's the number, that's kind of the holy grail we were looking for so long. We got there at 5 and everybody said, we're going to 6. So I don't know if I want to buy. Now that we've gone to 6 and back, I think people are saying if the next stop is 4, I need to be owning it now.
Buying American high yield and bonds and then steering clear of anything inflation insensitive, is that the credit's version of a Trump trade?
I think it's a credit version of just not having a disruption to the overall market. So whether that's a Kamala trade or a Trump trade, I think at the end of the day, it means that, we are going to see growth in this economy. We, you know, at the end of the day, we think that, you know, regardless of the election, we're going to see growth. And so, you know, if you get a split government, that probably makes, you know, for a little bit better for the Treasury market, for credit markets in general. You know, we actually think both candidates are setting up well in that regard. So I don't think you have to really term it anyway. I think you just say, you know, it's a soft landing trade in the U.S. that won't be disrupted by politics.
But you think either candidate will be good for credit, even going to 2025, if we see higher inflation potentially?
And it's because the fundamentals are set up well. You know, from the foundation standpoint, you're seeing where balance sheets are. You know, companies have not overstretched. If we were going back to, you know, 2008, 2009, obviously, companies had a lot more leverage in their balance sheets. Companies have been preparing for this recession. It's finally to the point where people are no longer expecting the recession, maybe a little bit, but for so long, people were expecting this recession that never came, and so balance sheets were really good order in order to prepare for that.
We didn't use a word that starts with I. We didn't talk about inflation at all. Is that basically out of your picture right now as a concern?
Well, I'm concerned because it's the only thing that could really disrupt this Fed put that we think is in play. If you see a 0.3 tomorrow or even today with PPI, but if you see a 0.3 month over month CPI, I think everybody's going to pull back and say, uh-oh, like the Fed was going to have our back, but maybe they won't. If it's 0.2 or 0.1, I think you have a very clear path here.
So what's the trade if it does surprise to the upside?
So if it surprises to the upside, you know, you've got to be shorter on the curve. You got to stay in T-bills, which I think, you know, is not the trade that we have on, but that would be the trade that would do better.
Which is the reason why so many people are hooked in right now to what this data today and tomorrow's show. Matt Burrell of Invesco, wonderful to see you as always. Thank you. Have fun hoovering up all those bonds that keep getting sold ahead of that data. Coming up next hour, we've got Keith Lerner of Truist, Bloomberg's Craig Trudell, Matt Lazzetti of Deutsche Bank, and David Rubenstein of the Carlyle Group as we parse through. Right now, it looks like a pretty sleepy week, and yet it seems like there could be, Danny, some sort of catalyst, particularly when it comes to the inflation data.
Totally. Is this just calm, or is it just the eye of the storm? Is this a market that's resilient, or is it a market that's complacent? You could argue the latter if it is a scenario where we've just gone right back around with everything from bonds to equities, leaving us once again vulnerable to big market shocks should the data surprise.
Which is a reason why people are expecting more volatility ahead, even if you're not necessarily seeing it this morning. This morning, a calm, maybe ahead of the storm, or maybe just calm. Taking a look at S&P futures, up about 0.2%, going nowhere in the bond and currency space. This is Bloomberg.
In terms of how we should deal with the challenges that are, you know, facing the world and also internally, I think it's just an opportunity also, an angle. And you could see that in a lot of activities that are picking up in this region, simply because it's a region that is actually a bright spot amongst very few in the world today. And people always talk about the flavor of the month. Actually, I don't want to sound too, you know, large-headed, but actually we will be the flavor of decades. We are determined, we have long-term plans, and we are very clear and committed on our commitment to the investment community at large. I'm not talking about one individual country, but at large in the GCC, that we mean business, that we are willing to take every step possible to make it easier for investors to do business in the region, that we are willing to do a lot of structural changes, including actually making it very predictable, very consistent policies.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Market has been posting excellent returns, right? And so you're at a point now where you need to take a breather.
We are very much ready for volatility.
I wouldn't be surprised if the volatility continues for a while, even through the fall.
The market was far too excited a week ago in pricing in too many Fed interest rate cuts.
This is a harder environment than markets were, say, 3 months ago.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get the data started. 30 minutes away from U.S. PPI, kicking off a week that could potentially give a sense of how much ammunition the Fed has to cut rates. Welcome back. This is Bloomberg Surveillance. Anne-Marie Hordern, Danny Berger, myself, Lisa Abramowitz, John Ferro off this week on vacation, which is well-deserved. I'm not going to call it a sabbatical and tease him, as some other people might have done. Right now, taking a look at markets quiet ahead of 30 minutes time when we get, Danny, U.S. PPI.
And I'm also interested that the Home Depot earnings didn't dent sentiment more than it did, because initially you did see ever so slight of a pullback. We are rallying yet again. And this seems to be one of the things that the market is craving, more evidence of how bad the consumer slowdown is. If it is just the lower end, and if it is bleeding to the upper end, Home Depot serves a wide breadth of consumers. But maybe, Lisa, it goes to the point that we're assuming that this is just about housing and it's not bigger weakness.
Maybe this also is because Torsten Slok came out and said the media is full of anecdotes from earnings calls about the economy supposedly slowing down, but the reality is that firms at earnings calls talk less and less about recession. To me, the question really ultimately becomes, how do you price in a soft landing? How do you price in a weakening when that is fully priced? Is that sort of a risk that has been overweighted at a time where there clearly are some other uncertainties?
I think what Torsten's getting at is when CEOs come out and they say, we're seeing some softening, but we're not soft. And this goes back to the Bank of America survey, shaken, not stirred. Basically, 76% of respondents are saying we still maintain there's going to be a soft landing. But the second Torsten Slok published this, we got a note from Citi's Andrew Hollenhorst, who said the rise in unemployment rate and plunge in ISM manufacturing suggest the U.S. economy may already be in a recession. There is a serious debate right now about where we are in this economic cycle.
Here's the rub, and this is the reason why in 28 minutes' time, when we get PPI, it's going to be really crucial. Danny, and we heard this from Matt Brill just a second ago, essentially, he's betting on this soft landing. He's buying credit. He's buying bonds. He's seeing some optimism. Because inflation isn't a problem, should PPI come in hotter than expected, how much does that unravel some of the optimism we're seeing in markets?
And then they might need to start paying more attention to the Fed, because we could argue for the most part they're not paying attention to the Fed, with many members saying we aren't there yet, not for 50 basis points of cuts, but just for 25. So if PPI comes in hotter, if that sets us up for a hotter CPI, does it need to be, again, the pendulum swing, already having swung, I don't know, maybe 50 times in the last week, need to swing again to inflation is a concern, and the Fed can't cut yet.
Yeah, and it's hard to know what to focus on, honestly, because when you take a look at some of the headlines, really the ones that are dominating have to do with the consumer and just basically offsetting that potential risk of a much deeper slowdown. It's not necessarily the geopolitics of the moment, Emery, even though they are highly concerning to a lot of leaders across the world.
Absolutely. Geopolitics at peak. It feels like this week when you see the USS Georgia moving into the Gulf, you see Tomahawk missiles from the United States, this defensive position almost the U.S. is setting up, because what they said is that Israel is telling them that Iran will be retaliating soon, and they have those same concerns. But at the same time, Amrita has said, and what we've seen over the course of the past few months is supply hasn't actually been hidden. So then it comes down to the basic fundamentals of the oil market of supply and demand.
Which really, and if you take a look at markets, that's what you see reflected. Right now, you see a bid into stocks, as you were mentioning, Danny, retracing some of the gains that we saw earlier before Home Depot released their earnings, up about 0.3%, euro dollar going basically nowhere, flat. 10-year yields marginally lower, and crude, AMH, to your point, lower on the day, down 0.7% as the supply-demand dynamics trump some of these bigger geopolitical concerns that very much are looming. Coming up this hour, Keith Lerner of Truist, as markets await crucial U.S. data. Bloomberg's Craig Trudell as General Motors shifts its strategy in China. And Matt Lazzetti of Deutsche Bank on his continued call for 3 rate cuts through the end of the year, once thought to be too much by the market participants, now considered basically lower than what traders are pricing in. We begin with the big issue, stocks on hold, ahead of PPI out in just under 30 minutes. Data that will help confirm potentially soft landing hopes. Investors optimistic about the Fed's path forward, and despite recent volatility, enthusiasm for mega cap tech remains. Keith Lerner of Truist upgrading the sector back to overweight last Thursday, saying this: risk reward has improved for the tech sector. Moreover, in a cooling economic environment, we expect investors to come back to tech, given some of the secular tailwinds stemming from AI and its premium growth prospects. Keith joins us now. Keith, this was a dip that was buyable. Why, in your eyes?
Yeah, well, first, great to be with you. It's nice to see a little bit of calm for a change. So with tech, we would have been bullish all year long, but towards the end of June, things got a bit more speculative. We saw most of the last run-up being more valuation expansion, and we saw the greatest one-month outperformance relative to the S&P since 2002. So we said, this is not the time to get in. We think we have a better opportunity. Last Thursday, as we upgraded and moved it back to overweight, we saw the rubber band move back the other way, meaning we had the greatest one-month underperformance since 2002. At the same time, as we dissected the pullback, it was all, kind of reposition and valuation contraction. Earnings for the sector continue to make new highs. And as we move into the fall, we think the narrative will shift back to, Apple's new iPhone and potentially a new PC upcycle as well. So all in all, especially in a cooling economy, we think investors will come back to tech.
This is really a compelling debate right now, because we've talked to some market participants who actually are arguing the opposite, that equal weight has just started to rally and really catch up to big tech, and yourself saying maybe the opposite in the way of, big tech will continue to lead. What is the economic backdrop that has you calling for tech outperformance?
Well, we do think the economy is still growing, but it's certainly slowing or cooling. And I think in that environment, we're thinking about more like trend growth around, 2%. We think the Fed is, by almost all measures, still restrictive. So we think they need to get going. And I think in that environment, whether there's a lot of debate whether we have a slowdown or recession. We're in the slowdown camp. But either way, it feels different than the last few years. So I think investors will look for kind of like these secular tailwinds that will persist. And we're still seeing that spending happening, in tech on AI. And then if you look more recently, even on doing the balance, look at, small caps we still have a position in equal weight, but I think we're going to start moving from broadening back to narrowing again is our view, because you're seeing those relative price trends actually start to move down again in these other areas outside of tech. So we think tech is going to be a good place to be for the remainder of the year.
Keith, how much, though, of these hyperscalers spend, of, Amazon talking about spending $600 billion in the year in CapEx, Meta as much as $40 billion, how much of that is acyclical or depends on a growing economy that can generate cash in other parts of these tech giants' businesses?
Yeah, well, I think there's a bit of an arms race that some of these companies, they're going to have to continue to spend money even if the economy slows down because it is an arms race. So I think that will continue. And then I think as you kind of go down beyond the hyperscalers, you're going to probably see these kind of add-ons to other, the software or like software players where like, companies will tack on 3 or 4% to use their AI features as well. So I think that will be a slower move, but I think in general, you'll see that. And of course, we'll be proven probably right or wrong by the end of the month because we have the biggest report of this month, I think, was NVIDIA at the end of the month.
How are you thinking preparing for that? If you look at a corollary, Supermicro Computer, who is a big customer of NVIDIA, strong revenues, weak profit, and the shares were just destroyed, Keith. How sensitive will we be around a much bigger company, NVIDIA, at the end of the month?
No, I think it will be a big report for all of tech and for the overall market because we know tech is such a big part of the S&P 500. I think at least, one of the reasons, again, why we had downgraded in June tech is that expectations were too high. I think at least the good news is semiconductors as a whole are down about 20% off their highs from June. The tech sector is down double digits. So at least the bar for positive surprises is somewhat lower. Of course, we'll have to see what happens between now and then. But also, as you look at the other hyperscalers, how much they're still spending in CapEx, our expectation is that the overall report will come in, reasonable. Of course, I can't give individual recommendations on stocks, but if you look at the other reports, it suggests that CapEx cycle has further to go.
When you look at NVIDIA specifically, and I guess big tech overall, you said that you're overweight for the rest of this year. How concerned are you about 2025? I think of antitrust issues, given what J.D. Vance said even just over the weekend. I think of a story this morning from the Wall Street Journal about how Huawei is looking at a new chip because of sanctions with the United States, and potentially that new chip is going to mean less of a NVIDIA sale in China. How do you think about all these concerns on big tech specifically for 2025?
Yeah, it's certainly a risk, and I should probably provide a caveat. I mean, that's our base case as far as what we think now, but we're going to follow the data. We're very weight of the evidence oriented, and one of the reasons why we, had somewhat of confidence to upgrade the overall sector is that we saw the earning trends continue to make all-time highs the last few weeks. So what would get us more negative, even into 2025, if we saw those earning revisions start to turn negative? Right now, they're positive, and as I mentioned, and even if we slow down, I think investors are going to look for some, where there's secular growth, and where things can hold up on a relative basis. But obviously, there's a lot of different parts of the industry, trying to bring in more competition as well. So we'll look at the data and have that, lead us. But at this time, we're not seeing any signs of cracking in the earnings picture.
Keith Lerner of Truist, thank you so much for being with us. Some breaking news, actually. Starbucks is replacing its CEO effective immediately, looking at naming Brian Niccol as chairman and CEO. He is currently the head of Chipotle. He's talking about Starbucks naming CFO Rachel Ruggeri to serve as interim CEO. Meanwhile, you're seeing CEO Laxman Narasimhan stepping down effective immediately. You're seeing Chipotle shares down 8.7% on this news, given the surprise departure. And you're seeing Starbucks shares up more than 10.7% on what we're hearing. Meanwhile, this is coming as activist investors have been pushing for changes. And we're talking about the potential for rejiggering a company that has really struggled in the face of geopolitical pushback, as well as just people not buying maybe vanilla lattes. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes.
Hi, Lisa. Johnson & Johnson has cleared a key hurdle for advancing a $6.5 billion plan to resolve thousands of lawsuits by people who say its baby powder gave them cancer. According to people familiar with the matter, more than 75% of the group signed off on J&J's proposal through secret balloting. The settlement offer includes claims that the talc-based version of its powder caused ovarian and other gynecological cancers. Under J&J's current offer, it would make payments for current and future claims over a 25-year period. According to a global survey by Bank of America, the volatility in global financial markets hasn't derailed investor optimism around tech giants or expectations of a soft landing. The poll was conducted during the height of last week's turmoil and showed a defensive rotation into bonds and cash and out of equities. But long bets on the Magnificent Seven remain the most crowded trade, albeit less so after the sell-off. And Home Depot lowered its full-year sales outlook, signaling that it expects consumer spending to remain soft in the coming months. The company sees comparable sales falling 3 to 4% for the year versus the previous expectation for a 1% decline. The disappointing results come as consumers have held off buying homes or pursuing big renovations amid high interest rates and macroeconomic uncertainty. Comparable sales also came in worse than expected, falling for the 7th straight quarter. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Just going back to this breaking news that Starbucks is replacing its CEO following activist investors pushing for changes. It also comes after the shares of Starbucks have been down some 19% so far this year. Danny, you're looking at Chipotle shares up more than 22%.
I think it's really telling that they went to Chipotle to get their next CEO. The former CEO of Chipotle, to your point, going to be serving as the next Starbucks one, because this is about a consumer that is getting more picky. What are they picking? They're not picking Starbucks, they are picking Chipotle. So potentially internally at Starbucks, they say this isn't a consumer problem, this is a strategy problem, and we need to change something.
How do you convince people you're giving them value in the same way that can give them small luxuries without breaking the bank? We'll discuss that more coming up. But also up next, the morning calls, plus Bloomberg's Craig Trudell as General Motors overhauls its operations in China. That's coming up next. This is Bloomberg.
Could face bigger challenges next.
It was going to keep Great World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Still parsing through this story about the Starbucks-Chipotle nexus, given the fact that Starbucks is just replaced its CEO with the former CEO, evidently, of Chipotle, looking to reprise some of that. Danny, you're making this point. It's sort of a similar customer base in terms of who they're trying to appeal to.
Right, exactly, but it's a customer that's become more picky. And I think you said it really well. What can you appeal to them to give them the small luxuries? It's, at Chipotle, apparently, it's filling your burrito bowl literally as high as possible. So what sort of value proposition will Starbucks now offer to get those people to keep coming back? Because they've been trying a lot of stuff and a lot of different strange flavored drinks.
Well, the value proposition of the new CEO is a pop in the shares this morning. Time now for the morning calls as we look beyond just simply Starbucks and Chipotle. First up, Bernstein downgrading Warner Brothers to market perform. The analyst pointing to disappointing Q2 results and frustrated investors. Next up, Citi upgrading Hormel Foods to buy. The analyst seeing upside to earnings estimates due to strengthening retail trends. And finally, Stifel raising its price target on Walmart $73. The firm citing positive consumer spending intentions and Walmart's increasing share of grocery purchases since 2019. Turning now to the auto space, we've got GM struggling in China like many other international companies. Bloomberg reporting that the U.S. automaker has been laying off staff in China and will soon meet with local partner SAIC to plan a larger structural overhaul to its operations. Joining us now is Craig Trudell of our Bloomberg Bureau. Craig, just want to start with how idiosyncratic is GM versus this broader retracement of international companies that make cars in China?
I think this is really a broad story here where if you're not a Chinese manufacturer, you're not doing well in China. It's as simple as that. I think, you know, when you look at General Motors and Volkswagen in particular, these are two companies that have been in China a really long time and you know, managed to really gain traction in that market for decades. It's very quickly, you know, gone sideways for these companies. And, you know, manufacturers that have had smaller presence in China, you know, they too are not doing well, but, you know, they had less to lose. And so, you know, GM and Volkswagen in particular, I think, have, you know, really significant presence in that market, a lot of employees and a lot of plants. And they're going to have to answer some hard questions in the coming months and you know, maybe years, you know, kind of undoing their presence in this market. Assuming, of course, the trends hold, which, you know, when you take a step back and look at what's happened to these companies' sales just the last few years, it certainly is not inspiring a whole lot of confidence.
Well, for so many of these companies, realizing that they couldn't go at it alone in the Chinese market, they did these JVs. And of course, GM being an example of them, starting this JV in 1997 with a 30-year contract set to expire in just 3 years' time. Craig, is it a matter of even a JV can't save you, that you can't really be in this market alone or with a partner?
I think it's a really great question, and I do think it's a case where, you know, you had local companies, you know, in the case of SAIC, this is a state-owned company that you know, we're starting from scratch and you know, really could use the expertise of, you know, a company like GM or Volkswagen, which, by the way, SAIC is partners actually with both of these manufacturers. They don't necessarily need that expertise anymore. They've been around long enough. They've learned quite a bit from the companies they've partnered with. And they also, by the way, have, you know, sort of internationally recognized brands. SAIC owns MG, which is a British brand that collapsed, you know, decades ago and was kind of scooped up by SAIC and has really, you know, they've really, to their credit, done a heck of a job, you know, building that brand back up. Not only in China, but, you know, here in the UK and in Europe, it's, you know, one of the more successful brands owned by a Chinese company in Europe. So it is the case that, you know, these Chinese companies have really, over time, developed their own, you know, expertise and ability to manufacture. And it really feels like they've sort of surpassed, you know, the domestic or the international companies that they've partnered with for years.
Do you think this is the floor for laying off some of the staff? I mean, it's a huge reversal for GM in terms of their strategy in China. Or do you think we can see even more layoffs?
I think the way that Mary Barra has been talking about this, she's said that this is, you know, unsustainable. The state of the market in China is unsustainable. And, you know, I guess the question really is how much longer can this, you know, price competition that she's referring to there can continue if GM is just counting on the idea that this, you know, pain is going to last and people leave until people leave the market. I think, you know, looking at what they've been saying, they want to really recalibrate, get much smaller in that market and sort of wait and see until, you know, this shakes out because, you know, they're looking at, you know, the way that companies are performing in that market. As much as a lot of Chinese companies are growing, not all of them are doing so profitably. And so, you know, do you see some consolidation and, you know, find a path while some of these companies that maybe can't play this game forever fall by the wayside? That seems to be the play here.
Craig Trudell of Bloomberg, thank you so much for being with us, as always, and for the insights. Meanwhile, we are about 8 minutes away from U.S. PPI. Joining us now, Michael McKee, Bloomberg economics editor and policy correspondent. Mike, I do want to start with just how the market is currently poised. It seems like everyone we're talking to is almost discounting inflation and thinking that a hot PPI or CPI print is merely an inconvenience but doesn't shake the trend?
I think if we get a hot CPI, it might change some investors' minds or views about how soon the Fed goes or how far they go. But at this point, we're not expecting that. The PPI always a wild card because it has a lot of different moving parts mostly people think about it in terms of inputs into the PCE indicator because it doesn't directly reflect what's going on with CPI. Interesting thing about last month's PPI is that the whole rise was in services, and almost the whole rise in services was in trade services, which is wholesaler and retailer margins. They went up almost 2%, which gives you some clue about what we're seeing in the earnings this quarter is that companies are reporting margins that are okay, even if their sales aren't good. And that's going to be an interesting thing to watch going forward.
And that is one of those things that feeds into PCE, right? Financial services. For those various metrics that do feed into PCE, what are the expectations for them?
Well, we don't know about financial services. We had a fairly quiet period during the month of July. It was August where we saw the ructions. So we'll see if there's a big change in that. Airline fares went down a little bit during the month, so that could show up as a decline. And then there's always automobiles. That's going to be a funny category because we had the problems in June with the hack of the auto sales computer system, and they couldn't sell as many cars, so did they discount in July? That'll be interesting to look at. Medical care services, that's one that everybody wants to look at. Everybody, economists want to look at, so we see what goes into PCE.
But for PPI, you say the main takeaway bottom line is this matters because of PCE. So really tomorrow, it's CPI that everyone is focused on. How much do you buy into this that if we get, say, hotter than expected, even 0.1% higher than the 0.2% that the survey is expecting, that would be very difficult for the Fed to potentially cut in September?
It might make it more difficult. We heard people like Mickey Bowman the other day, the Fed governor, saying that she's not convinced yet that inflation is durably coming down, and that would feed into that narrative, and anybody else who's sort of in that path might agree with her and might put us behind. We're also getting into a time of year when base effects are going to start affecting the year-over-year numbers, and so a small move in the month-over-month could mean that CPI goes up on a year-over-year basis, which the Fed, as economists, would look past, but would be very hard to sell to the public or to Congress.
Mike McKee, please stay close because we are going to be digging into those medical expenses really closely coming up next, as well as the other components of PPI. Expectation of the Bloomberg survey is for a 0.2% gain in PPI. That is in line with what we saw in the prior month. This comes ahead of CPI with also a 0.2% gain expected for the month. We're getting that tomorrow. Coming up next, we'll be breaking that down with Matt Lazzetti of Deutsche Bank, who will be here to react. This is Bloomberg.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
25 seconds until we get the first round of the key economic data of the week. U.S. PPI. Heading into that, we see markets very quiet, although building on the gains from earlier in S&P futures, up 0.4%. You could see bond markets also just starting to get basically complacent with the idea that inflation is coming off the hilt. Two-year yields now solidly below 4%. With that economic data, here in the studio is Michael McKee. Mike, what do we see?
Well, producer prices are up less than anticipated, just 0.1% on the headline final demand number, and the core is flat. Now, we had expected a 0.2 rise for both of those categories, so overall, that is good news and certainly a turnaround in the core number, which was up 0.4 in the month of June. Now, on a year-over-year basis, that puts us at 2.2% for the headline, a big drop from 2.6%, and the core is at 2.4%. Now, the professional economist category likes to get rid of the trade services, which is based on margins for retailers and wholesalers. And if you do that, that actually went up because it went up 0.3 instead of 0.1 last month, and more than anticipated. So that pushes the core to 3.3% from 3.1%. But we'll have to take a look at what it was that pushed that up, because last time it was basically the retailer margins that pushed it up, and that wasn't considered a significant inflation issue compared with some of the other things in here.
Well, why don't you take a look, take a minute to really look through some of the numbers so you can break out some of the specifics. In the meantime, what you can see in markets is a pretty significant response. S&P futures up now 0.6%, almost 0.7%. NASDAQ up almost a full percent on the heels of this report. Even the Russell 2000, and this actually highlights just how interest rate sensitive it is, up about 0.8%. In the bond market, yields markedly lower across the curve. You can really see a bit more of a bid into the bond market led by the 2-year, because essentially this seems to be giving a green light to the Federal Reserve to come out and really cut rates potentially even more aggressively this year. When you bleed that through the currency market, you could see dollar weakness. It reverses some of the earlier sense of dollar strength, 109.36 on the euro. Mike, you've had a couple minutes. What are you looking for?
Well, the interesting thing here is there's a complete flip-flop, 180 degrees from previous PPIs, in that it was prices for final demand goods that went up 0.6 during the month, while final demand services fell 0.2%. Usually it's been the other way around. And the reason that we saw a big rise in final demand goods was gasoline prices went up. That's the major issue there, a 2.8% rise in gasoline prices. And final demand trade services, which we talked about, fell 1.3%. So that's a contraction in margins, and that is has some implications, I guess, for equities as we go forward. But it is a big change from what we saw in the prior month.
Well, this market tends to like to use PPI as a way to position into CPI. Whether that's successful or not is a different story. Is there anything you see from this that would give you any sort of indication for data to come?
Well, I haven't gone deep into it, but obviously we have to take into account the idea that gasoline prices may have gone up. The wholesale and the retail prices don't match up on a regular basis, so that may not be the case. I'll take a look and see whether we get whether we have anything in terms of things like airfares or cars that sometimes match up. You can't really take PPI as a precursor to CPI. Basically, the easy way to say that is middlemen. Because people from the producer side sell it to the middlemen who mark up prices and then they send it on, and so we don't know exactly what we're going to get from CPI. But this is only the second time this year that we've had PPI before CPI. So what most people are doing is just looking at PPI as an input into PCE.
Well, one thing that I love about you, Mike, is that you always parse deeper and deeper into the data after it comes out. And there are many, many lines, and he has them all open in the huge PDF document. You will continue to do that. Please stay close so we can come back to you afterwards to figure out what you've gleaned. Joining us now, I'm so pleased to say, is Matt Lazzetti of Deutsche Bank. And I want to start, thank you so much for being here, Matt. I want to start with your impression of how predictive, to Danny's point, this PPI print is for tomorrow's CPI.
Yeah, I would agree with Mike that not very. Usually what we look at are the few components that go into PCE that inform the inflation gauge that the Fed focuses on. So they're portfolio management, healthcare, a few of the other airfares or used car prices are most important. I would downplay, what we're seeing in the headline or the core just for that reason. I think there's, we'll have to go through some of the details. There is some reasons to think that some of those components could have been stronger. So portfolio management, inflation, one, tends to lag the market. So the strength we had in markets in prior months should actually lift that inflation component. But I think ultimately it has little feed through into how we think about the CPI beyond those components that matter for the PCE. I wouldn't change too much of how we're thinking about the CPI tomorrow, but the market is lean in a very dovish direction from a CPI perspective. The market pricing is around a 0.1% core CPI print, below what consensus is expecting. So the market is kind of anticipating soft inflation numbers, which allow the Fed to begin to cut rates.
And this really is basically feeding into that kind of coiled spring that we've got coming into tomorrow in terms of that dovish positioning. Is there anything that you're seeing in the data that should push back against that? Because at one point you were more dovish than the market in terms of rate cut calls. Now you're actually more hawkish than the market with 3 rate cuts for the remainder of this year. So is there anything in this data that would give you pause before throwing your hat in the ring and saying, you know what, market, you're right?
Yeah, things change quickly. As you mentioned, about a month ago, we shifted to 3 25 basis point back-to-back-to-back cuts, and it was viewed as aggressive at that point in time. I think from the Fed, what we've heard from them is wanting to kind of take a step back, be able to see the data. I think my read on the data is you have a clear slowing, including in the labor market, but it's not recessionary at this point in time. You still do have inflation that's above target, but I think inflation risks have really dissipated. And so I think the Fed should be very comfortable cutting rates. Should they go by 50 basis points? The market has been priced kind of 50-50 for that at this point in time. I think the data will determine it. So if we get confirmation in the next jobs report that the latest weakness was real, then I think it could be quite likely that the Fed cuts by 50 basis points. If you see a reversal of some of that weakness, which is my baseline expectation, if you have the consumer continue to come in resilient, then I think that the Fed can have a path here of going by 25 basis points at each meeting.
Can you just break down what the difference of going 25 and 50 is on impact? Is it signaling, or is there actual economic legs up that they give the economy by going by 50 instead of 25?
Yeah, so at the moment, a lot of this is already priced into the market, right? So 2-year yields are reflecting an aggressive rate cutting cycle, a little bit more aggressive than we're anticipating. I think markets are reflecting that at this point in time. So if the Fed were to go by 25 basis point increments rather than that, yields would rise. Maybe you see equities come down a little bit. But I'm skeptical that the Fed, being a little bit more hawkish, is going to tighten financial conditions aggressively. And the reason is the only way that they would do that is if the economy is looking resilient. And I think the market is highly leveraged to negative news on the economy, as we saw with the jobs report, anything that looks like it's a downside risk. So I think if we get resilient news on the labor market and consumer, financial conditions can remain easy, even if the Fed only goes by 25 basis point clips.
Are you surprised or even maybe concerned the Fed hasn't given themselves that optionality, announced that optionality of doing 50 basis points, that at the moment they're still discussing whether or not to do even just 25?
Yeah, I think, what we will often hear, they make decisions at a meeting and it's only for that meeting. I think what we've heard from Fed officials since the jobs report and since market volatility has been entirely appropriate, which has been, yes, there was some weakness in the labor market data, but they are not overly worried about it. They're not worried that it was signaling recession. I think what they were seeing in markets they thought was being driven by technicals and positioning and an unwind of positioning. And so far, I think that's played out. And the market went from pricing over 125 basis points this year down to less than 100. And if you get good data, I think it'll give them the optionality. So I think they're in a fine place at this point in time. And Chair Powell at Jackson Hole can help guide us on how they're thinking.
Matt, you say the consumer's resilient. What do you make of what Home Depot said this morning, which is that they're in this deferral mindset, that they're waiting to make big purchases?
Yeah, I think resilience is definitely different than kind of robustness or strength. And so I think we're coming from a consumer environment where you just had a very robust consumer over the course of 2023, and it was across the income distribution. It was kind of hard to find pockets of weakness. You now do have some pockets of weakness. You do have some pockets of softness. I think it's more reflecting of a normal type of an environment. That said, the labor market data does have some risks to it. Job gains did slow. We think some of it was due to hurricane effects, but they have. The unemployment rate has risen up to 4.3%. And job gains remain resilient only because layoffs remain low. So if there are risks that I am looking at, it is that layoff picture changes, and that would clearly undermine the consumer in a way that turns it into kind of a more negative dynamic.
If we are now at 4.3% of the unemployment rate, it's basically what the Fed wants to be at the end of the year. Does that in itself signal that they are behind the curve?
I don't think it signals that they're behind the curve. I think it signals that their dot plot in June is not appropriate at this point in time. So when they set that forecast with that unemployment rate, they had one rate cut this year. I think that no longer is a reasonable view at this point. I think it's more likely that the debate is between going 25 or 50 basis points. And I think that will be a real debate. And I think it'll be dictated by the data. I honestly think that there's compelling arguments on both sides. They are restrictive. The inflation data is telling them that there's not as much upside inflation risks. And then it depends on whether or not the economy is actually as resilient as we think. If it is, then I think that they should go by 25 basis points, and I think they probably will. But if we get kind of confirming evidence on the labor market front, that gives them scope to go more aggressively.
Giving some credence to that 50 basis point rate cut thesis. If you are just joining us, we did just get that PPI number, and it did come in softer than expected. Inflation, then not necessarily the concern, and opening the door really to the Fed to cut rates perhaps even more aggressively. 0.1% was PPI final demand versus the expectation of 0.2%. That leaves the year-over-year final demand at 2.2%. versus the expected 2.3%, pretty much across the board. It seems softer. What you see in markets is pretty much a collective cheer. You see across the board, stocks rally much more aggressively, led by the NASDAQ 100. You also have bonds rallying as you see two-year yields fall below 4%, solidly so, although we're tracing some of the earlier rally that we saw, 396.68. It's pretty much across the board. The biggest bit, though, into the two-year. And if you bleed that through foreign exchange, you see the dollar softer as you expect some sort of rate cutting cycle to commence, certainly in September. Question now the depth of it. The euro gaining versus the dollar, 109.45. Michael McKee still with us here, our economics correspondent. What are you seeing in the details of this report?
Well, the big change, as I mentioned earlier, was that services prices went down while goods prices went up, largely because of gasoline. But we also saw passenger car prices fall 0.2. Healthcare prices were basically flat. Insurance prices basically flat. The big increase in the numbers came from portfolio management. Matt Lizzetti's colleagues are causing inflation at this point. Portfolio management prices rose 2.3%. One of the biggest moves in the whole PPI. So the fact that you get paid either way works out.
Well, Matt Lizzetti is still with us and can respond. What do you make of the details?
Yeah, so portfolio management rose as I kind of signaled, I think. Actually, I think maybe the most important thing was healthcare being flat. So healthcare in the PCE is 20% of the core PCE index. It's basically as important as rent and OER. We've been signaling some upside risks to that because it tends to be leveraged on healthcare wage growth, and that's been very strong. You got a soft print there. So that is, as a read-through to core PCE, it's a very good indicator for the Fed.
Matt, just while you've been talking, I've been looking at the interest rate probability tick lower and lower. I mean, not a dramatic move, but you were saying it's about 50-50. It's now more than 50% chance that they go 50 basis points the next meeting. Are we putting too much weight on each individual data point as this market rolls on?
Yeah, the market is highly sensitive to each data point. I think you're seeing some big moves. It doesn't take much to move, by 10% for a cut. It's only 2 bips on in terms of the pricing. But it makes sense. We're in an uncertain environment at this point in time, and the Fed is providing little forward guidance, I think appropriately. If the Fed is providing little forward guidance, then it means the Fed is data dependent, and we should be sensitive to those moves. I do think the healthcare component here is important. That being flat rather than strong is a dovish signal for the core PCE. We'll have to wait what we get from the CPI tomorrow.
Matt Lazzetti, really, really smart. Thank you so much, as always. Matt Lazzetti of Deutsche Bank here with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Shares of Starbucks are surging in the pre-market after the company announced it's replacing its CEO effective immediately. The coffee giant naming current Chipotle CEO Brian Niccol as its next leader. This coming as the company is working to turn around its business as consumers pull back, plus as it faces growing pressure from activist investors. The Seattle-based company said Niccol will start as CEO and executive chairman of its board on September 9th. The Wall Street Journal is reporting that China's Huawei Technologies is close to introducing a new AI chip. The chip would allow China to overcome U.S. sanctions and challenge NVIDIA in the Chinese market. According to the report, Chinese internet companies and telecommunications operators have already been testing Huawei's latest processor. The company told potential clients, according to the Wall Street Journal, that the new chip is comparable to NVIDIA's H100, which was introduced last year and isn't directly available in China. And the NFL is meeting with a handful of private equity groups this week. According to people familiar with the process, it's a step toward opening the league's ownership ranks to institutional money. The meetings are intended for the league to conduct more due diligence, but also to talk through potential policy preferences. The NFL is the only major U.S. league that doesn't allow institutional investors. It has spent more than a year observing results from other leagues and discussing what it might do differently. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, heading up for the day ahead, also a discussion with David Rubenstein, the co-founder of Carlyle. This is Bloomberg.
Many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We are about 17 minutes away from, or after what we got from PPI, and it did come in lighter than expected. Markets are responding pretty much as you would expected. They are flying, although you're tracing some of the earlier gains. S&P futures up about 0.5%. You can see dollar weakness now as people price in a greater than 50% chance, as Danny was talking about, of a 50 basis point rate cut by the Federal Reserve, and yields are markedly lower across the curve as people gauge just how much room the Fed has to cut rates. Right now, I want to turn to somebody who typically joins us to talk about his various properties. He has many of them in all different aspects of the world, but particularly with his Bloomberg shows. David Rubenstein, who is host of Peer-to-Peer Conversations and the co-founder of the Carlyle Group, and who also hosts Bloomberg Wealth, and who also owns a massive baseball franchise. Before we get into all of that, I do want to talk about your upcoming conversation with David Solomon of Goldman Sachs, who you spoke to amid some of the market turmoil that we saw last week. What was his take on it, and potentially how much was stemming from uncertainty around the Fed and around what we're seeing in the U.S. economy?
Well, he obviously recognizes there's going to be some turmoil in the market for a while. He said that in the interview, which will air tomorrow night. David's been the CEO for about 5 years. I've known him for a long time. I tried to recruit him to come to Carlyle about 3 or 4 different times. I failed every time. Very talented person. He obviously had some turmoil early on in some of the parts of what he was doing, but he's now seemed to be in really strong shape. The Goldman stock is doing quite well. The performance is very, I'd say, strong. And he is worried about the debt around the world, the amount of debt the U.S. government has, the amount of debt consumers have, the amount of debt that a lot of countries have. So that's one of his concerns. But generally, he doesn't see a recession or a depression coming anytime soon.
You didn't get him, but you did get Harvey Schwartz, so you didn't do too badly in terms of recruitment. I am concerned, though, about just the divergence that we're seeing with respect to what CEOs are saying, and then some of the data that's coming out that just seems kind of messy. From your perspective, from your vantage point as an interviewer of David Solomon and all of these other behemoths in the finance industry, but also overseeing and really understanding consumer dynamics, where are we in this pendulum of weakening but not yet weak?
I don't think most people think we're heading into a recession. Now, obviously, we have recessions typically every 7 years in the U.S. economy. We haven't had one for a while, a real recession. So it wouldn't be a shock if there was a recession, but I don't see it happening anytime soon. The economic data is still pretty good. Most people expect the interest rates to be lowered, probably, I suspect, in September. And I think when that happens, I think the market will respond favorably.
Do you think that it would be prudent for the Fed to cut by 50 basis points?
I would think it's prudent for them to cut back interest rates, whether it's 25 or 50, I will leave to the Fed. But I think it's unlikely that the Fed will say, because of the election season, we won't do it. In other words, I used to think that the Fed would not do any cutting before the election. But I now think the signs are so strong that they should do so, that I think that they will do a cut of 25 or 50 basis points in September. And that's what David Solomon thought as well.
And in the meantime, as the market tries to figure that out, it's been whipsawed back and forth, and probably a good example of who to talk to in one of those moments is the legendary energy trader John Arnold, who you speak with for an upcoming episode of Bloomberg Wealth. And you talked about this idea of his trading strategy. I just wonder if any of that is kind of applicable to today, as people try to trade these markets and really grasp for what the direction may be.
Well, John Arnold, for those who don't know, was a legendary trader at Enron, then later started his own company, and he had rates of return that were over 100% a year. And he did what most people don't do. He retired. He just retired to give away his money and work with his wife on a philanthropy. A very impressive person. He's now on the Meta board, and he's helping Meta decide what to do with the energy needs for artificial intelligence, because his expertise is energy trading. A very impressive person. I would say that the volatility in the energy markets will probably abate a bit sometime soon. But he's not in energy trading right now for third parties. He may trade for his own account. We don't know what he's really doing. But he's mostly spending time on philanthropy. I would say he's a very impressive young man. He became a multi-billionaire well before the age of 40.
What's the advice on the energy infrastructure to power these massive data centers because of AI?
There's no doubt that AI requires a lot of energy, and there's a lot of concern about whether that's going to be good for the environment or not. And most of the big tech companies are now focused on that, and I think rightly so. But I think that's a problem that will be solved in time, and clearly alternative energy will help mitigate the problem. Who's going to be the next president of the United States? So, as you know, most people thought that there's a pretty good chance that Donald Trump would win because running against Joe Biden looked like he was going to win. Many people thought that. Now it's a jump ball. Nobody really knows who's going to win. And I think we're going to see a lot of turmoil in the markets till the markets really say, yes, X or Y is going to be president of the United States.
You just sat down with David Solomon. You just sat down with John Arnold. What are they thinking about U.S. politics right now?
Well, they try to avoid it, just like I try to avoid it, too. But they may be more involved in politics than I am. I don't get involved in giving money to any of the politicians, but I do.
You don't give money, but you talk to everyone.
I talk to them all. In fact, I have a book coming out in a couple of weeks on the presidency. I interviewed Donald Trump for the book, and I interviewed Joe Biden for the book. And it's about the presidency and the importance of it. It's called The Highest Calling. Now, I used to say that private equity was the highest calling of mankind, but I had to admit that the presidency is probably a higher calling than private equity. But it's it's very close.
I love that you say that you try to stay away from it, but you were the one who brought it up, and so we have to go there. There is a real question here about how much turmoil there actually will be, and some people are saying, I'm not going to get into it, and it's not going to be that significant. Where do you see the balance of risks? I mean, what is the Harris trade?
Well, I think right now the markets are uncertain as to who's likely to be president. It's clear to me that she's gotten much more support than people thought she would have gotten because, remember, as vice president, she wasn't as visible figure as some other vice presidents have been, and the Biden people thought that only Biden could get elected. Now they recognize that she can probably get elected. I think President Trump has not yet figured out exactly how to attack her, and I think the campaign is a little uncertain, but he's a smart man. He's gotten elected before, and I think it's going to be a pretty close election either way.
Do you sleep, David?
I'm sorry?
Do you sleep?
About 5 hours a night, but that's enough.
David Rubenstein, always impressive of the Carlyle Group in terms of just the quality and scope of everything that you do. Thank you so much for being here. You can watch David's conversation with Goldman Sachs CEO David Solomon on Peer-to-Peer tomorrow at 9 p.m. And, of course, coming up as well on another of his properties, Bloomberg Wealth tonight, David's interview with John Arnold, Arnold Ventures co-founder and co-chair. Counting down to the opening bell, here is the trading diary for the week ahead. Today at 1:15 p.m. Eastern, we'll hear from Atlanta Fed President Raphael Bostic. Will he weigh in on PPI? Tomorrow, U.S. CPI. On Thursday, we'll get retail sales plus another round of jobless claims, as well as this, Walmart reporting earnings after the bell. Friday, we'll round out the week with UMich sentiment plus more Fed speak from Chicago Fed President Austin Goolsbee. Coming up tomorrow, Stuart Kaiser of Citi, Marriott CEO Tony Capuano, former Chicago Fed President Charles Evans, and Gargi Chowdhury of BlackRock as we parse through what we got today with PPI and look ahead to CPI. This was Bloomberg Surveillance.
Next week, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments.
Vice President Kamala Harris closing the gap with Donald Trump.
And informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in all next week on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
To succeed in Wall Street, what skills do you need? You need to be somebody who claws people in the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out. Which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Futures are higher, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Shanali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, an abrupt shakeup at Starbucks. The coffee chain surging after naming Chipotle CEO Brian Niccol as the new CEO and chairman.
We also got U.S. producer prices in July. They rose by less than forecast, underscoring an ongoing moderation in inflationary pressures.
And Morgan Stanley's Mike Wilson warns of a challenging road ahead for stocks. He joins us later this hour to survey the investing landscape. Let's take a look right now, though, at where markets are trading. 30 minutes to go until the bells ring. You can see there is green on the screen behind me. The S&P 500 currently up about 0.6% before markets actually opened. We were absolutely flat yesterday, so this is exciting. A bigger rally if you take a look at big tech. The Nasdaq 100 up about 1%. Of course, we got softer than expected PPI that's working its way through the stock market and also through the bond market right now. 10-year yields currently down about 3 basis points, Matt.
I want to take a look at the ECAN chart on the Bloomberg terminal. This is a picture of PPI going over the last 12 months. You can see that it was being brought down by lower energy prices at the end of last year, beginning of this year. It has crept up over the last few months, but it is now coming down again, and the blue square here is services. So it's really a shrinkage in services prices that's helped PPI to moderate a little bit today.
And more on that Starbucks story here. Some pre-market movers on our side. Starbucks just surging, up more than 14% pre-market on that CEO shakeup. Chipotle CEO taking over. They're buckling to activist pressure here, pushing for change at the coffee chain. Remember, Brian Niccol coming from Chipotle over to Starbucks. Chipotle now down more than 7.6% pre-market, Katie.
Yeah, it is pretty amazing, of course, to see the one-day pre-market moves on that news. But, Matt, I actually want to talk about the long-term performance of these two chains. You take a look at Chipotle. You had Brian Niccol take over on March 3rd, 2020. Since that time, Chipotle shares are up 280%. You compare that to what Starbucks has done over that run, down about 2%. So you think about sort of that black and white picture right here. It kind of makes sense that Starbucks called up Brian Niccol.
Yeah, Starbucks has been absolutely stagnant. That's why we get activist pressure. That's why Howard Schultz, who used to run the chain and is now the biggest shareholder, is angry with, or let's say, dissatisfied with the operators. Maybe Brian Niccol comes in and changes that and gets the stock moving back in an upward trajectory.
Brian really did a good job at navigating a lot of those pressures that Starbucks is already feeling, that consumer pressure at a premium chain. Let's see if he could take it home with a coffee.
You also think about him taking over March 3rd, 2020, just really an incredible time. We have the perfect guest to unpack this news. Here with us for more is Nancy Tengler. She is Laffer Tengler Investments CEO. She owns both Starbucks and Chipotle stock, and that's such a great setup, Nancy. When you think about the news today, what's your reaction as a shareholder in both companies?
Well, as I've told you before, Katie, investing is like being in a perpetual state of dissatisfaction. So I cheered at the Starbucks news and on the Starbucks side because the stock has been a colossal disappointment, as has Laxman. I'm sorry to say that. And so it was great to see the board take action, though they had to be prodded, of course, by activist investors. But Brian Niccol just worked magic at Chipotle. It's a member of our 12 Best Ideas portfolio, so now we're going to have to think a little bit about what we do there. But he did all the right things and really drove the company through the use of Chipotle lanes, through the use of digitization, where they now get over $1 million per store in digital orders. So he will fix Starbucks. I think that's the very good news, and we'll have to see what happens at Chipotle.
Okay, this is a man, Brian Niccol, that has had a lot of experience in the restaurant industry. Pizza Hut, Taco Bell, Yum Brands, and then Chipotle. Starbucks is a different animal here, and there's a lot of, let's say, stakeholders here that he has to please. That is unions, that is activist investors. What do you want to see him do on day one?
Well, I think the first thing he has to do is lay out his plan. And, you know, there are just, you can make minor changes and have a profound impact on margins and growth. And so that is what he did at Chipotle. So while Shonali, I agree with you, you're absolutely right. This is a little bit more complex, but really when he took over at Chipotle, there were a lot of problems there too. And he knew what to do. We've talked to some insiders at Starbucks that said Laxman just didn't understand retailing, restaurant retailing, and he did not understand the Starbucks culture. I don't think Brian Niccol's going to make that mistake.
Nancy, how much of the problem here is the consumer? I'm just thinking about the different products that these two companies offer, right? And most employers offer free coffee. You don't have to go and pay $5 for a cup of coffee at Starbucks. On the other hand, I can't get a burrito upstairs even here. So I do have to go to Chipotle, and let's be honest, they're delicious. So isn't there a difference in the product that he's trying to sell?
Yeah, you can get free everything at Bloomberg. That's why I like to come in the studio. Yeah, I think, yes. So when we were making the decision as to which stock to put into the 12 Best Ideas portfolio, we basically said what you said, Matt, which is I will pay $9 for a burrito. I'm not sure I'm going to pay $9 for a cup of Venti, shaken espresso. but that the whole idea of the brand and how you change consumer behavior. And that's what Starbucks did initially under Howard Schultz. And so I think what you'll see is Brian Niccol will develop a plan. I don't know what it is, but he'll develop a plan that will draw the consumer back in. And he'll also make it more convenient. I mean, the problem you have, like in New York City, for example, is the wait time, and then, you know, the mobile orders taking precedence over the in-store orders. He's going to have to flip that somehow to get people to spend more time and more money in the stores.
Well, I spend $5.72 on basically a small cold brew every single morning. I'm not sure I could handle much more, but it'll be interesting, of course, to see what Brian Niccol does over at Starbucks. But on the flip side of that, I mean, you started the interview by saying that being an investor, perpetual state of dissatisfaction. Are you thinking about trimming your Chipotle position here? I mean, you think about what Brian Niccol has done at the company. We were taking a look at the share price. It's just been a fantastic run over the past 4.5 years or so.
Yeah, well, Katie, we already trimmed it, and that's sort of the good news, but we still own a large position in the stock. I don't know yet. I think we're going to have to dig in, see who the replacement is. I mean, really, the thesis around investing, of course, is earnings drives share prices, but managements drive earnings. And so you need to have quality management teams, which is why we jumped out of Intel 3 years ago. And that's what Starbucks felt. I was just talking to the team last night and I said, when are they going to get rid of this guy? And they did it today. So at Starbucks, sorry. So I do think it's going to matter who takes over the helm. And so far, I don't know if that news is out yet, but I have not yet seen it.
So this is what we know now, Nancy. We know that the Chief Operating Officer, Scott Boatwright, is going to be the interim CEO. We also know that Jack Hartung, who had announced his retirement from Chipotle in 2025, agreed to stay on indefinitely as the president of strategy. So there is a lot in flux here at Chipotle. Do you think they need to bring in an outsider just to get the caliber of leadership you got from Brian?
I do, Shonali. I think, you know, it'll be somebody, it needs to be somebody that can carry that gravitas that Brian Niccol had and has. And so, you know, good that the team is staying intact, but the CEO matters, and it's going to be a headline issue that matters a great deal to investors. So, you know, we'll be talking today about whether or not the name is still a member of our 12 Best Ideas portfolio. That's how important Brian is and was to the stock and to the company. But yeah, it's going to matter a great deal, and it's going to take some time. So the stock is likely to just trade sideways or down some.
All right, Nancy, great to get you on today. Thanks so much for joining us last minute. Obviously, this breaking news is pretty exciting, especially if you're an owner of Starbucks shares and you are also an owner of Chipotle shares, and interesting to get your take on how they need to replace Brian. Let's turn now to the economy. U.S. producer prices rose less than expected in July, reflecting the first decline in services costs this year. Joining us now with more is Michael McKee, Bloomberg's chief international economics and policy correspondent. Mike, this is the first of a couple of inflation data points that we're going to get this week.
Yeah, and I'm just going to segue from your last segment and tell Katie I have bad news for you. No. In the PPI, roasted coffee went up 3.3%. That's a big increase. So
I'm going to have to switch to tea.
You're the victim here. Overall, though, the numbers are really good, as Matt was saying. We saw flat to basically just barely up final demand and core, and that has pushed the year-over-year numbers down to 2.4% for core and 2.2% for the headline number. That's significantly lower than the 3% and 2.6% we saw the prior months, and they had been on an uptrend, and you can see this last month they have broken that trend, which is going to be good news for the Fed. Now, what happened inside the numbers besides coffee? It was, as Matt told you at the top of the show, goods prices. They rose 0.6% as gasoline prices pushed those up 2.8%. But services prices fell by 0.2. Trade services, which is basically wholesaler and retailer margins, fell 1.3%. They had risen 1.9% in June. So margins, you may look for that in earnings reports for retailers and wholesalers. Portfolio management prices went up by 2.3%. It is you guys on Wall Street who are the inflation problem at the moment, because of course you get paid either way. Airfares down 0.2%. Passenger car prices fell 0.2. Now let's take a look at ECAN. This is our service on the Bloomberg. Breaks everything down, and people love this. This basically shows you what happened with those trade services prices. That's the blue numbers there. Final demand trade services had been going up, pushing PPI higher. Now it falls. That is a significant change in what we see in inflation, and that, if it continues, could be good news for the Fed.
All right, Mike McKee, appreciate the breakdown as always. We'll see you in 24 hours, of course, less than 24 hours until we get that CPI print. Let's take a check on futures right now, because we have a rally on our hands. You take a look at the S&P 500 up 0.6%, even more so if you take a look at big tech with the NASDAQ 100 there. Of course, the idea is that you had that softer than expected PPI, sort of sets the stage for CPI. Of course, investors hoping to get some good news tomorrow on the inflation front. Small caps joining in as well. The Russell 2000 currently up about 0.8% pre-market, Matt.
All right, up next, we're going to talk to Kevin Holt. He's the CIO of U.S. Value Equities at Invesco. He says near-term volatility is creating long-term opportunities. This is Bloomberg.
names in global leadership are on Bloomberg.
China has started to provide Russia with different types of aid, not direct military aid, but issues linked to energy, sometimes even dual use of goods. I argue that Russia is so dependent on China right now that one phone call from President Xi Jinping would solve this crisis. If he were to say, time to start negotiating peace, Russia would be forced to do that. They would have no other choice.
I would like China to play a serious role. Russia really depends on it because they don't have another place to export many of their goods because of the sanctions. The president of Finland, he is right. China could play a tremendous role without weapons.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Now to high interest, to look at what's making headlines around the world. Moscow is hiking recruitment bonuses to avoid a repeat of the deeply unpopular policy of mobilizing citizens into its army, drafting them into its army. Ukraine continues to penetrate into Russian territory. The military in Russia isn't getting enough new soldiers to keep pace with frontline losses, which are at their highest since the invasion of Ukraine began. Meanwhile, Elon Musk talked with former President Donald Trump last night, or let him talk, basically. The Tesla CEO did take the opportunity to pitch himself for a role in a second Trump administration.
I think it would be great to just have a government efficiency commission that takes a look at these things and just ensures that the taxpayer money, the taxpayers' hard-earned money is spent in a good way. And I'd be happy to help out on such a commission.
I'd love
if it were formed.
Well, you're the greatest cutter.
Home Depot falling pre-market after cutting its full-year sales outlook. The company's CFO says consumers with money to spend have a deferral mindset, putting off purchases until interest rates decline. Katie?
All right, let's keep the conversation going now with Kevin Holt. He is Invesco's CIO of U.S. Value Equities. And I do want to get to some existential questions about what is value. But before we get there, if you just think about the performance that we've seen over the past couple weeks, it feels like we've actually seen a bit of a revival in the value trade. You think about some of those smaller companies getting love, some of those unloved sectors getting a second look, and then it fizzles. When are we going to see a sustainable pickup in value interest?
So I kind of think we're there. So what we're seeing right now is some dislocation to markets and volatility, some earnings weakness. So I think as we move forward, some of these unloved stocks, particularly with an interest rate cut in cyclical areas of the economy, are going to start to move.
So when you think about the potential to broaden as well, there was a broadening for a while into small and mid caps. You've seen that pretty much erased, Kevin. Do you think you could take on more risk into places where perhaps the multiples have not caught up with where you've seen kind of the most love flow to in the market?
So the small and mid caps we think are very attractively valued. There was some dislocation during the earnings season. I think volatility, people sold small cap, but we think this is a kind of a transitory phase we're on. So again, I think when you cut the interest rates, typically when you stimulate economic growth, those small and mid-cap stocks will start to do better. And it's like anything, idiosyncratic stories. You have to, choose stories that are what we think are undervalued, unloved, where there could potentially be some changes or things that are misunderstood within that story.
In terms of the carry trade, do you see that as, the unwinding of the carry trade as the reason for the almost correction that we saw, or was it a growth scare?
I think it was both those together. So I think you had some currency dislocation, which we've seen in the past. You can go back to 2015 with China. So as you have these currency movements that surprise people, there are some unwinding trades. So that caused part of the problem. Then you showed some weak economic data, and I think that kind of further exacerbated the sell-off. And let's face it, we were due for a correction. So I think it's healthy. I think it's normal. It happens usually once or twice a year where we get these 5% corrections. So I think it's a good time to go now.
Kevin, how do you avoid value traps in this market? I mean, you think about the traditional measurements, what people have classically used, and it seems like that is probably going to lead you to some of those value traps that people get worried about. How are you thinking about that?
Well, I think your earlier conversation regarding Starbucks is important. Management, capital allocation. Those are the two most important things investing in any company, I think, whether it's growth or value. So I think it starts there. And then, secondarily, you have to think about these businesses, and particularly in today's age where technology, services was 30% of the market. It's now 60% of the market. So it's grown so immensely over the last 30, 40 years. So I think you need to think about business and say, where are they going to be in 5 years? What role do they play? Some of the consumer services names that we see, that we own, Meta and Google, they, 19, 20 times earnings, not that expensive. And they're taking share in digital advertising. As we look out over the future, that trend is going to continue. So I think as a value person, you can't get, what worked yesterday isn't necessarily what's going to work in the future, particularly in the AI and some of the technology areas.
Well, to that point, what worked previously maybe doesn't work right now. How do you measure value? I mean, this is a conversation I've had with Sean O'Hara over at Pacer as well. They like to look at free cash flow yields, for example. What is your preferred metric for determining what's a good value right now?
Yeah, so if you go back, we're students of history. So there are different metrics that work in different sectors when you go back 80 years. I do think at the end of the day, free cash flow is the ultimately probably most important metric. But you can look at the free cash flow today, and if a firm is under earning, that means their cash flow will be depressed. So it's coming upon us to say, okay, their operating margin's down. So the state of free cash flow today isn't really what the free cash flow will be in a normalized environment. So, in financial stocks, it's price to tangible book. Then we're looking at the return on tangible common equity to kind of get to a PE that we think is fair for those companies. And then, as you said, in consumer discretionary and in healthcare, free cash flow yield is it. And the return on invested capital. So if your return on invested capital is quite high, we want you reinvesting in your business, which may depress that free cash flow a bit.
You think about cash flow and you think about CapEx. At the end of the day, how do you want to see companies using their funds on hand? Would you rather them be holding it for a rainy day at this point, given the concerns about the economy? Would you be watching them rather plow it into some of these more moonshot projects like artificial intelligence?
Yeah, so I think it depends on the company and what your core competency is. So, I think banks at this point, we want them to be conservative. We don't know how bad the credit cycle will be. We think it's actually going to be manageable. And when you lower rates, some of the regional banks will start to outperform. But I do think AI is real. So you have to, and it's kind of your judgment on what the return on invested capital is going to be of these projects. But if you just go into your Meta Messenger app now, you have the AI at the bottom of it. And I think it's going to change behavior. It's going to change how we do things. So I think it's important to invest in those areas that are going to make your business more efficient over time and, lower a lot of your other costs.
As a student of history, I wonder what your take is on investing in an election year. I have heard that value stocks outperform usually the first 6 months after a vote, at least in the last 11 elections. What's your take?
Yeah, I mean, I think it really is going to come down to, is there a sweep by one party? I don't think that's likely. I think that, but generally, I think we're going to, as long as there's gridlock, there's not too much either way. I personally would like to see some more fiscal conservatism, but that doesn't appear to be on the plate with either party at this point in time, because I do think our national debt's getting a little too high.
Elon Musk wants a job in that area.
Maybe he'll keep spending too, who knows. Kevin, we thank you so much. That is Kevin Holt, CIO of U.S. Value Equities at Invesco. Now coming up, we are watching shares of Home Depot. They're struggling after the company reports a 7th straight quarterly drop in comparable sales. And now it's also lowering its outlook. Home Depot now down about 1.6%. We're going to give you the details next. Stick with us. This is Bloomberg.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Home Depot shares falling after second quarter sales disappointed, and the company lowered its outlook for sales and profit. Let's discuss with Bloomberg consumer goods reporter Dasha Afanasieva. Dasha, thanks so much for joining us. What's the problem at Home Depot? Is this just the weaker consumer that we see, across earnings season?
It's the weaker consumer, but they're saying something slightly different here, which is that the consumer is so nervous that even the consumer that has the money to spend on a new bathroom, a new kitchen, etc., is actually deferring the spending, waiting for that crucial interest rate cut. And that's what's led to this pretty chunky cut in outlook. The upside, I guess, as you could see, is what they're hinting at, is that eventually there will be a boom, that eventually there'll be pent-up demand and people will eventually start renovating their homes. But up until then, it seems like they've said they've taken the first half of the year, and looking at how poorly that's gone has led them to this big cut, which is much worse than what analysts expected.
Dasha, we have to leave it there. That is Bloomberg's Dasha Afanasieva, of course, on a highly watched story this morning. Now, coming up, we're going to talk to Morgan Stanley CIO Mike Wilson, joining us to share his outlook, as well as 3 stocks he's suggesting investors take a look at right now, all as the NASDAQ 100 futures extend their pre-market gain to more than 1%. It's a bullish day with some bearish feelings underneath. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker, or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Futures are rallying. We are moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. Take a look at what we see on futures right now. Just about 0.7% of 1%, 0.2% on S&P futures. NASDAQ 100 futures, the Q's up 1% right now, and even the small caps are up about 0.7%. In terms of the bells this morning on the New York Stock Exchange, ADT ringing the opening bell with looks like a tugboat captain there. And then over here on the NASDAQ, we see BYMA, Bolsas y Mercados Argentinos. That's pretty exciting, ringing the bell. In terms of the rally, let's get over to Katie Greifeld right now. She can tell us what the indexes are doing the first few seconds of trading.
Pretty exciting as well if you take a look at the screen behind me. Like you said, Matt, currently the S&P 500 up 0.6% just seconds into the trading day. Even more so if you take a look at big tech, up 1%. Even small caps getting in on the action. The Russell 2000 up 0.7%. Of course, we got better than expected, meaning softer than expected, producer price index numbers this morning at 8:30, really raising hopes that we'll get good news when it comes to the consumer price index coming tomorrow. But before we get there, let's take a look at Starbucks, absolutely surging on news of a shakeup right now with Chipotle CEO taking over. The move, of course, comes as activist investors push for change at the coffee chain. That's what they got. Starbucks shares up 17.5%. On the other side, Shonali, you have Chipotle down over 8% right now.
What an absolutely massive week for the consumer sector. Katie, we're also going to keep an eye here on Home Depot. It cut its sales guidance on expectations that consumers will continue to hold back spending in the coming months, citing both high interest rates and inflation. Home Depot at the open now down about 1.5%, Matt.
All right, I'm taking a look at the big picture here. On the S&P 500, over the past 3 months, we saw, in terms of closing prices, a drop from peak to trough of 8.5%. Now, we had Mike Wilson of Morgan Stanley on the program July 8th. He said we'd see a 10% correction, and if you look at the intraday drop from, I think it was 5,669 down to 51.17 or so, you see actually a 9.7% drop. So he was near as damn it to correct. We're pleased to say he's back here. Mike Wilson, Morgan Stanley, Chief U.S. Equity Strategist and Chief Investment Officer. There you have it. Basically, the 10% correction that you called, we're wondering, is that it?
Well, you never know, right? I mean, but we thought it would happen in the third quarter, so it just happened immediately, and there's always different reasons for why it happens. Look, our general take on the correction that we've seen is that we're probably going to be stuck in this range now. I mean, we had a pretty big shock. It wasn't just the correction we saw in the equity markets, but then we had the carry trade kind of unwind, and I don't know how people can sit back and feel comfortable with that. The main thing, though, is what you guys have been talking about this morning, right? The consumer is slowing, right? All the consumer services companies in particular, it's not just the goods companies, and that has to be resolved here. So the way we think about it is, in order for markets to kind of make a new high, I mean, you need multiples to expand, and that's going to be very challenging in a world where growth is slowing, okay? Earnings expectations probably are still too high for the second half of this year, and a Fed that's reluctant to be proactive, okay? And I don't disagree. People are criticizing the Fed. I'm like, well, look, they're just being data dependent. I mean, and so they're doing their job. They're going to react if they need to. If they overreact, then that probably exacerbates the carry trade problem.
So they're not going to overreact.
Whether you think you're going to get that 25 or 50 basis point cut over in September, it's still more than a month away.
Right.
So as rates remain elevated, how much more pain does the consumer see? Do you think investors are perhaps underappreciating how much more pain there's left in the
Plus
consumer?
they're lagged, right? It's not like the Fed cuts at September 18th and the consumer goes to Home Depot and buys a new washing machine on September 19th, right?
Well, that's generally been our view, right? I mean, we've been underweight consumer discretionary and sort of overweight the later cycle groups and then defensives on that premise, meaning, you know, we think being defensive right here makes a lot of sense for all the reasons you mentioned. All these things work with a big lag. And I completely agree. In fact, our note this week, we discussed this in detail, particularly housing. Right, 25, 50 basis points isn't going to do anything, mainly because most people's mortgage rates are sub 4, if not sub 3%. So you need 200 to 300 basis points of cuts to really get some of these interest rate sensitive areas moving, and that's just going to continue to weigh on consumer sentiment. It's going to weigh on consumer stocks, and so that's how we're set up. We're set up to be sort of underweight that space.
And Mike, I want to get your thoughts on some of the technicals here, specifically when it comes to positioning in the big tech sector, because there's a note out from Citigroup this morning saying that there's still $22.5 billion worth of long positioning on the NASDAQ 100. And in their view, that makes the index still pretty vulnerable here to any sort of sentiment shock, maybe at 8:30 a.m. tomorrow morning. What are your thoughts on positioning right now after the few weeks that we've seen?
Yeah, I mean, the faster money crowd has adjusted significantly, even the systematic strategies and some of the long-short community. But the asset owners, right, retail, long-onlys, that crowd is still very exposed. And so there is length in the marketplace. It's not just NASDAQ 100, it's kind of equities writ large. So the way we think about it right now is the valuation is just inappropriate, right? Valuation doesn't matter until it matters, and then that's all that matters. And we've been very adamant that 19 times is kind of a fair market multiple in a soft landing, okay? So today we're north of 20 times still. So it's very hard for me to get excited about the index, which is why we're really focused at the stock level and the sector level to try and make money.
A little more on the carry trade here, because the carry trade is not really isolated to the yen. I think that's an important dynamic of this. The other important dynamic, I think, is how much investors didn't realize how much leverage was under the system. If you think about kind of what has left to unwind, these kind of exogenous shocks, do you still worry that there could be another one this year?
Well, there's still a lot of leverage in the system. I mean, so that I just sort of spoke about equity length is high, okay? Bond length is low. So, I mean, people are skewed to having more risk on. Then you take into account the leverage in the system through products like triple levered ETFs or, you know, daily expiration options, just the leverage in the system as people are doing carry trades of all sorts. Yeah, there's more leverage in the system than there should be, given the uncertainty still of the eventual outcome of the economic, events that are still in front of us.
Speaking of those, you said you expect earnings to be weaker in the second half. We've had an excellent earnings season in the second quarter. Right. I think 11% is what we've seen in terms of profit growth year over year. Why is the second half going to be harder? Do you think tough comps from last year? Do you think we're not going to see a continued broadening out of earnings growth?
So one part of it's expectation. So there's a big hockey stick in the fourth quarter, and there's been a lot of discussion around a pickup in orders in the second half of the year that continues to be elusive. So as we come into September, we wrote about this week too, the key data for us is going to be what are companies saying in September about order books? If we don't see order books pick up in September, your year is kind of shot in terms of seeing a reacceleration that's now in the numbers. So we're open-minded. It could change. But I don't think it's going to be because the Fed's cutting rates. It's going to be perhaps maybe people hunkered down a bit, and now we can see a reacceleration. But the comparisons are difficult, as you mentioned, particularly in the fourth quarter for the Mag 7, and that's part of the story too. And so look, the key thing that we look at is forward next 12-month earnings growth. That is now peaking. And when that peaks, that means multiples come down. And that's as simple as I can make it. So 20 times to 19 times, that's our baseline. That would be kind of at the low end of that range we wrote about this weekend. And that would be a place where I would get interested at the index. That's still 4, 5, 6% away. And then if it gets worse than that and it gets cheap, then we'd get really interested. But that's like 17, 18 times.
And so tying this into some of the economic data that we've gotten in the past 24 hours, of course, we had the NFIB Optimism Index come out. That was good news. An interesting detail within it, though, if you take a look at the report, it showed that the share of firms planning price increases dropped to a net 24%. That's probably good news for the inflation picture, but I read that as basically these firms are out of pricing power.
Yeah. It's a really good point. And I think this is, be careful what you wish for on inflation. We've been talking about this for a while. You know, the market did sort of make its top. Okay, part of that was on a good, lower CPI number. And we wrote about that in early July. You know, weaker inflation data now is potentially bad news for stocks. It's good news for bonds, okay? Bad news for stocks. Why? Because that's pricing power, to your point. And the PPI in particular is more aligned to revenue growth than even the CPI. So I'll be interested tomorrow to see if we get the same data point. You know, I'm not excited for stocks because inflation is surprising on the downside. I'm excited that maybe my trade in bonds looks better, and that's why we like defensive stocks. And I think that all kind of syncs nicely.
Well, Mike Wilson, sit tight. We're going to take a quick commercial break. Mike Wilson of Morgan Stanley sticking with us. Let's take a quick check on this market right now. Of course, 9 minutes after the bells rang. You can see this rally building on the momentum that we saw in the pre-market. The S&P 500 up about 0.8%. The NASDAQ 100, big tech, extending the rally up 1.2%. Small caps, too, getting in on the action, of course, after that softer than expected PPI reading. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back to Bloomberg Open Interest. Let's get a quick check on what's going on in stocks right now. We have, in terms of the indexes, rallies. You can see the S&P 500 up 0.8% at 5387. The NASDAQ 100 gaining more than 1%. And even the small caps, the Russell 2000 up 0.8%. So across the board gains on, I guess, optimism that the Fed has more room to cut now that PPI producer prices didn't rise quite as quickly as we had been anticipating. Katie?
Yeah, and we'll see, of course, if CPI can keep the party going tomorrow. But for now, it's time for top calls. Some of the analyst action in focus this morning. And first up, Citi says Hormel is a buy. The analyst sees upside earnings potential for the deli meat maker thanks to improving sales trends and lower feed costs. Next up, Bernstein says that Warner Brothers Discovery no longer a buy, cutting its recommendation to market perform. The media company, of course, is still reeling from last week's quarterly earnings report, in which it reported a $9 billion write-down stemming from the losses at its TV networks. And finally, Wedbush initiating coverage of Artiva Biotherapeutics with a buy. The biotech company focuses on autoimmune diseases and cancers. Also initiated at a buy over at TD Cowen, Needham, and Jefferies. Shanali.
And Katie, we're back here with Mike Wilson, Chief U.S. Equity Strategist and Chief Investment Officer at Morgan Stanley. And Morgan Stanley adding 3 stocks to their fresh money buy list. Can you explain kind of what the thinking was behind adding these 3? It was AbbVie, Northrop Grumman, and Public Service Enterprise Group. You guys are hunting for value, it feels like.
Well, we're hunting for defensive-ness, right? So obviously one's a defense company, one's a utility, and one's a pharmaceutical company, and they're all in a pretty good uptrend right now. The technicals look pretty good. And we think this is what you should be gravitating towards. You know, we've had some of a defensive posture really since May when we felt growth was peaking. That has worked. We're just sort of doubling down on that same view. And as you know, we tend to go sort of against the grain. We don't necessarily go with momentum. This would be definitely an out of consensus sort of view at the moment. It's starting. We think there's more to go in the defensive rotation.
Do we not? If we see Fed cuts, you know, I always think about how long it's going to take for them to work their way into the economy, but the market is instantly going to start to buy maybe mid caps, small caps, maybe the Russell 2000?
No. I mean, we've been very consistent. I mean, it could, yes, of course, but our view is that's not what you should be doing. We saw, once again, people tried to do that trade in July. It didn't work out so well. Now, we think that was more about a degrossing, okay? So as people rotated out of the winners, they were probably covering some of their shorts in these areas that they were underweight, and that really is what drove that. And now we have a very kind of negative technical pattern where it looks like that was a one-hit wonder. And historically, when the Fed cuts interest rates, small cap, mid caps do not outperform. Now, the market can go up, but typically small mid caps still underperform, even if it's a mid-cycle slowdown. That's what the data shows. So I just think people either don't understand that history, they're just eager to do something different. That's not the trade. We think the trade is to stay up the quality curve and skew more defensive than growth-oriented, because rates coming down will be most beneficial for that cohort.
And the point has been made that you take a look at some of the small cap indexes, such as the Russell 2000, it's a bit junkier than it has been in the past. I have to imagine some of that is that you aren't seeing those smaller companies IPO, those high-quality small companies actually tap the public markets.
It's a very good point. I mean, the thing that's really been missing is we haven't seen a lot of equity issuance, and we know there's supply out there. There are companies that probably want to go public. There's probably companies that want to raise equity capital because their balance sheets are a little sloppy, and it just hasn't happened. And I think the reason why is there's not a strong bid for that. I mean, we've seen that all year. Once again, the Russell 2000 is basically flat on the year. The equal-weighted Russell's down on the year. The equal-weighted S&P is still underperforming the overall S&P. So the breadth of the market continues to be soft, and that just continues to speak to this idea that we're late cycle, it's not mid-cycle. Fed cutting usually makes the market narrower, not broader.
Well, just to follow up quickly on that point, like you said, there hasn't been that consistent bid. Does the logic then follow, if we did see a consistent bid for some of those smaller companies, that IPOs actually would pick up here?
It could, absolutely. I mean, we're open-minded, as always, to anything. If we were to see in September, for example, a very broad rally like in July that looked a little healthier, meaning in an up market, not a down market, not a degrossing, then we would have to revisit our view on that. Something else would be going on that would suggest that, hey, maybe the Fed is not only going to cut rates, but it's going to have a meaningful impact, and it's going to help these companies. The other thing you brought up a good point is the Russell 2000 is really a lower quality version of small cap. So I want to make it clear, like, we don't hate all small cap companies. I mean, that's silly. The S&P 600 is a higher quality version of that. And so as you hunt for small mid-cap stocks, and I would advise doing that, just, once again, stay up the quality curve. You don't have to go down to the junk pile.
I really feel the need to go back to something we were talking about before. You sat down, we said, okay, Mike Wilson can take his victory lap. We saw that 10% correction, nearly 10% that you were thinking of. You saw it earlier than we expected. what does this mean? Does this correction have further to go?
Well, it's still the third quarter, okay? And once again, the seasonals right now are just not particularly great. So as I said at the beginning, I think we're going to stay in this range. I find it hard to believe we're going to break out back towards the highs. I also don't think we're going to completely break down in a way that would argue that we're entering a new, bear market, okay? But the lower end of the range is, to me, the magnet now, because that's where the valuation support really lies. 19 times is closer to the low end of that range.
You said you're focused on jobless claims. I talked to Ed Hyman on Sunday from ISI. He said the same thing. If we get a labor market that really weakens, and the SOM rule's already been triggered, but if we get, for example, I think September 6th, we get non-farm payrolls, and if we get another jump up in unemployment to 4.6%, do you think we see more mayhem in the markets?
Yes, I mean, a 4.6 would be pretty definitive. Now, just to be clear, our economics house call is still we're in a soft landing outcome. What I would suggest, though, is that the market is priced for that, right? The market is priced for a soft, actually even better than a soft landing outcome. It's priced for a reacceleration. So just kind of putting a little risk back into the market that maybe the hard landing is no longer 0, but it's 20 or 30% again, that once again just argues that multiples will probably bleed lower into September, even if the jobs data is kind of stable. Because at the end of the day, the jobs market is weakening. And so how could you sit here and say that the risk of a recession is 0, which is kind of what's priced in the equity market? And one last thing, the bond market is definitely pricing a higher risk of a hard landing. I mean, that's what the yield curve's telling you. That's what the 2-year yield versus the Fed funds is telling you.
Does that divergence worry you as an equity?
Well, I'm just saying as an equity person, you should pay attention. I mean, the bond market has probably a better look at, okay, what is the risk here? The bond market is not saying recession, to be clear. It's saying the risk of a recession has gone up in the last 2 months, which makes sense given what you just said.
All right, Mike Wilson, we have to leave it there. Great point to leave on, though, that you can't look at any asset class in a vacuum. Mike Wilson, come back soon. That, of course, is Mike Wilson of Morgan Stanley. Now, we need to go back to what's going on with Starbucks because it is a monumental move that we're looking at. Starbucks up 21%, Shonali, biggest move ever.
Chipotle also is steepening its losses, down more than 12%. Elliott is out now with a statement. Of course, this is the big activist hedge fund firm that took a stake in Starbucks. They say that they have been engaged with the board for the past 2 months regarding their perspective, and they view today's announcement as a transformational step forward for the company. They welcome Brian Niccol. They look forward to continuing their engagement with the board, so it's not over yet, and they work toward the realization of the full potential, according to a statement.
I think everybody has to be careful. I mean, this is like key man risk, right? Yeah. Just because one guy moves from a chain that makes delicious burritos that you can't get at the office to a chain that makes expensive coffees that are free upstairs.
Starbucks shares up on a day by $18 billion in market cap. He's an $18 billion man, Katie.
There you go. Of course, we'll see if that momentum actually continues, of course. But speaking of activism, up next, we're going to tell you about an activist fund that's had an impressive run-up so far this year. That's next in our Wall Street Beat. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's time now for the Wall Street Beat, and today we're looking at the success of an activist fund run by Boaz Weinstein. The Saba Capital CEF Special Opportunities Fund jumped over 20% this year so far. It invests exclusively in a handful of closed-end fund products from BlackRock. Bloomberg hedge fund correspondent Kathy Burton now here with us to talk about exactly how he has made so much money, because the reality is when he's attacked a lot of these funds, he didn't really win those board seats.
No, he didn't, but the BlackRock has agreed to buy back shares in a lot of the funds, and that's helped the price rise. So he has had a victory there.
But you also think about the closed-end fund universe. Of course, a lot of these closed-end funds have been trading at pretty big discounts, historically significant discounts to their net asset value. It feels like also just the market is in his favor right now, because we have started to see those discounts narrow at large.
Yes, that's true. And so it's hard to say that it's what part is luck and what part is him pushing the companies to do something, but it has worked this year for him.
So, I mean, I can only think about Bill Ackman when I think of giant closed-end funds, although his, in this case with PSUS, didn't come to fruition. Do we know any more about that? Are they just rethinking it and going to launch a different kind of product?
That's what we've been told, but we have no details about what that is. There's been a lot of chatter about what it could be, but we're really just waiting to see at this time.
One more on Boaz here, because realistically, when things get hard is when he used to make a lot of money. Volatility, which we saw last week. So has he changed his identity here? Is he more of a closed-end fund activist now than he is a tail fund manager?
Well, it really depends on the market, I think. When things when there's not a lot of volatility, then he's made a lot of money historically on these closed-end fund products and bets. And when there's a lot of volatility, like there was in 2020, for example, he made a ton of money in his more traditional way. So I think last week he did well, but I think before that, there hasn't been that much volatility this year.
All right, Catherine, thanks very much. Catherine Burton there reporting on, in this case, Boaz, but I recommend you go to the Bloomberg and check her byline for deep reporting in the Wall Street Beat. Let's get to the trading diary. This is what you need to be watching this week. We got PPI today. Tomorrow we get CPI, so more inflation. On Thursday we get retail sales, which Sonali's watching very closely, plus earnings from retail giant Walmart, as well as farm equipment maker Deere. On Friday, U.S. housing start to release, plus UMich consumer sentiment data. This is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Brokers Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to that internet thing. Go youtube.com and search Bloomberg Podcast, and that's where you'll find us. Starbucks, story of the day, stock up 20%. Got a new CEO from Chipotle. That stock down 9%. So go figure. I can't remember the last time that's happened. Jody Lurie's going to join us, Bloomberg Intelligence. She covers all the restaurants. Anna Rathbun, CIO at CBiz Investment Management. We'll get her thoughts on these markets. And Red Brown, Bloomberg News earnings reporter on Home Depot. Stock up? I don't know. I thought Home Depot, their outlook was a little bit weaker than expected. Consumer pulling back a little bit. I guess all the folks that are going to build their decks have done so. So we'll get the latest there. But let's kick everything off with the home do-it-yourself person himself, John Tucker.
Oh, I'll get to Home Depot. Don't you worry. And all their warped 2x4s. It's worth noting that in the S&P 500 right now, best performing stock, Starbucks, as you said, 21% higher, and then Chipotle Mexican Grill, the worst performing stock, down 12% on that management shakeup, abrupt management shakeup. And you mentioned Home Depot. Norma Linda's going to take a deeper dive, but more homeowners putting off repairs and renovations, apparently. Home Depot shares, though, they're up just fractionally, $346.10 a share. I did get economic data today. More evidence inflation is slowing producer prices, rising in July by less than forecast, reflecting the first decline in service costs this year. Still, Andrew Sheets at Morgan Stanley, he was on the program earlier today. He says inflation has taken a back seat to growth.
A lot of the volatility we've seen over the last 2 weeks is really focused and been linked to fears that the Fed and maybe other central banks have kept policy too tight for too long, and now growth is slowing faster than expected, and that policy will struggle to keep up.
And, well, somebody's optimistic. Small business optimism increasing to a more than 2-year high. This is from the National Federation of Independent Business. Their optimism index rose for the 4th straight monthly advance. This is the longest streak since before the pandemic. S&P 500 right now up 43 points, a rise of 0.8%, 53.87 on the index. The Dow Jones Industrial Average up 100 points. That's up 0.25%. The NASDAQ 100 is up 264 points. That is a rise of 1.4%. And after that eco data and ahead of the CPI for tomorrow, two-year yields, 6 basis points lower, 396 in the two-year. The 10-year yield is down 4 basis points. That is at 386. And we're brought to you by IBKR. With Interactive Brokers Forecast Trader, you can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
Hello, John Tucker. Thank you very much. Alex Steele here alongside Paul Sweeney. And just to be clear, you don't do the Home Depot thing because you are a 2x4 snob?
Yeah, no, I can't find straight lumber.
I didn't know that was a thing.
So the lumber
yes, it's
warped?
a thing.
But
How are you going to do your building
But
stuff?
it looks,
I feel like he made this up.
I assume it's all straight.
No. Lumber, yeah, it's a commodity, but it's not all
The
cut
same.
and dried the same.
So where do you get your lumber?
I go to the local lumber yard, which is more expensive, but in the end, if you pay more and you're not messing with the lumber, it saves you in the long run, saves you a lot of time. And we know time is money.
Okay, that's fair enough. I feel like it's an important indicator for a Home Depot of some sort. It's like the do-it-yourself
Yes,
professionals.
I'll
John's
tell
taking
you,
it to
if
the
I
whole other
see
level.
a contractor outside Home Depot, going to Home Depot, it'll stick in my, I will never use that contractor. Sorry, Home Depot.
Wow, that's hard. This is like how I feel
And we
about
had Barry Ritholtz on just earlier trashing Starbucks. So there's
Really?
2 in a row.
Wow, so much pessimism. Although I
know.
have to respect that. That's kind of how I'd feel about Deadpool. But anyway, Norma Linda is joining us from Bloomberg to go over Home Depot. So we were saying, oh my goodness, Home Depot stock is up a little bit. Why is that? What's your take on it?
So now we're back in the red ever since we spoke
Oh,
a
just
couple
kidding.
seconds
Uh-huh.
ago. But what's interesting here is that the cut to its outlook was expected. So this wasn't something that was a surprise. It's really the extent that exceeded expectations of the cut to its outlook. And of course, this is coming after it expects customers to hold back on spending in the coming months. But some of the positive read-through that I've seen from analysts has said that the back half of the year is likely to be a bit de-risked, especially with rate cuts on the table. So while this may be a bit of a sour read-through coming out of this earnings report, many people are thinking about the future and what that could mean down the line.
So I used the COMP function on the Bloomberg terminal that gives you the last 5 years stock price performance. Home Depot, on an annualized basis, up about 13% per year, pretty strong, right in line with the S&P, which is up 14.8. But Lowe's is up 21%. So aren't they kind of the same thing?
I mean, apparently not. One of them's DIY, right? This is where you come in,
hold on
John.
a second. John Tucker, how are Lowe's 2x4s?
Please.
I don't know. I don't buy either one of them. But
What's
I
the between
find that
Lowe's
Lowe's is sort of more, how do I say this, female-friendly?
Nice.
Really?
Yeah.
Pick up.
Huh,
the more you
Pick
know.
up women. All right.
I don't know if that's how we meant it, but sure.
Okay.
No, well, didn't think of that.
I mean, there you go. You don't get that at the lumberyard all the time.
Yep.
And it's a
That's
little
the
more
other.
organized.
Little
Home
more
Depot
organized,
is just,
okay.
in my experience, kind of a mess.
Huh. Okay. This is interesting. But I also wonder for Home Depot, I mean, I wonder if these are like lost sales forever, or is this pent up sales, right? Because we know that rates are going to fall. So if mortgage rates are really the issue with the big ticket items and the financing and all of that, does that wind up changing once we get lower rates?
I think that's what many analysts are really saying here. Exactly your point is that when rates drop, we should see a bit of an influx of people rushing back to stores like Home Depot. So they could be a beneficiary coming out of this.
All right, Baxter's. You're looking at Baxter's next. Ticker BAX. What's going on there?
Exactly. So those shares are down as much as more than 6.5% today. Now, this is a health products company, and the news coming out of this is that its kidney care unit, it's known as Vantiv, is getting bought out by a private equity firm, Carlyle Group. Now, this deal is worth
Said David Rubenstein right in here moments ago.
Perfect timing. This deal is worth $3.8 billion, and we are seeing a lot of different health companies hoping to streamline their operations and focus more on specific drugs. So that's what we're seeing happening here with Baxter's. It's planning to pay down its debt. It's planning to use about $3 billion after tax to pay off some of those debts. But when we do look at Vantiv, it did account for about a third of Baxter's revenue last year.
All right.
All right, and the big story of the morning?
Yeah.
Starbucks. Wait, so Barry Ritholtz was trashing Starbucks? Why?
Yes, because during the pandemic, apparently Starbucks voided your points.
Did they?
And I didn't know that, being a points person, but whereas Delta, said, don't worry, your points are fine. When you want to fly again, your points will still be here, blah, blah, blah. Wow. That was his big thing. So it was an unvarnished takedown of Starbucks, which, of course, I came to the defense of Starbucks in my double short mocha.
Oh, my goodness.
Yeah, double short mocha.
Yeah, because I like the little...
Oh, see,
I can't drink
I like the big ones.
And so you get conjugate the fat
venti Americano, half calf, almond milk, 2 stevia.
There's a lot going on here at this table.
That's like nothing. That's like nothing. All right, so just to round out the combo here on Starbucks and Chipotle.
I mean, so this is really an inverse percentage move. We're seeing Starbucks as the biggest gainer in the S&P 500, Chipotle as the worst performer right now. Now, Starbucks shares are jumping as much as 22%. That's the biggest intraday jump that they've seen on a record, while Chipotle is plunging for its worst days since the pandemic slowdown back in March of 2020. And of course, we know this is coming after the news of a CEO change. This was, of course, very abrupt. So we have Starbucks naming Chipotle's Brian Niccol as chairman and CEO. That'll be effective September 9th. Now, of course, we know that Starbucks has really been a trouble company, especially if you look through yesterday's close. We had shares down as much as 20% year to date. So we did see one upgrade coming out of this, but as we remember, Starbucks has really had negative sentiment surrounding it. So my team was really watching to see if they get any more upgrades on the news. But this is really great news for Starbucks, not the best news as we're seeing here for Chipotle.
Great news for the activist investors.
Definitely.
This is a win-win.
Elliott is welcoming this. They said that this is a transformational step.
I'm also really impressed that there was no leaking on this.
Yes.
Like, this seemed to catch everyone off guard.
It did.
This is pretty impressive.
It is.
All right, Nora, thanks a lot. We appreciate it. Thanks very much. Norma Linda joining us. Bloomberg Equities reporter. Let's get more on Starbucks here. Jody Laurie is Bloomberg Intelligence credit analyst, and she joins us now on that. Hey, Jody, just talk us through your reaction to this.
I think as a credit analyst, we're always sort of hesitant when there's these full-scale changes that happen overnight and when you've had a CEO that's only been there since March of last year. So we have just only gotten comfortable with the concept that they're giving back $20 billion, and now you have 2 activist investors very heavily involved, one getting a board seat and pushing out the CEO with a new CEO. That could be a positive for the company long-term in terms of performance, but I do also think that shareholders might make it better than bondholders at this point.
Why do you say that? You think they're just going to maybe start returning cash to shareholders?
I think they'll get a little bit more aggressive with that, Paul. I mean, I think, it could end up being the type of thing that they look at the company and they sort of think about ways to sort of boost the value, whether it be spin off some entity or what have you. I'm not sure what entity they could spin off at a Starbucks because so much of the non-core business has already been peeled away. That said, I mean, I think that when you're dealing with activists, you're always sort of hesitant because you say, okay, how much are they going to risk the balance sheet? How much are they going to lever to get the company into a different spot? Now, that might be a short-term pain for a long-term gain, but for bondholders, when you think about that short-term pain, that's not always necessarily the best thing. We have a long history of Yum, for example, which the new CEO was part of. When they spun off their entity, Yum China, they ended up giving back so much of their money to shareholders.
Which then, to the point, begs the question, like, how is Starbucks actually doing from a bondholder perspective?
From a bondholder perspective, over the past year, they've been a little bit more volatile. We were looking at some of the recent bonds, the 2029s, for example, which are 5-year bonds, have actually tightened modestly on the news, but I think it's hard to tell. I mean, I think it's more of a question of what this means longer term from a performance standpoint. It's going to take a little while for bondholders to sort of digest this news. Something that's very clear that we've been tracking is the ALT-D, the Bloomberg Second Measure data.
Yeah, okay, so wait, first of all, what is this? Because I got to be honest, I've never heard of this before, and you mentioned it, I knew you were going to talk about it, and now I'm a little obsessed with it.
It is pretty amazing, Alex, particularly when it comes to Starbucks, because the R-squared or the sort of predictive value of it is pretty great when it comes to Starbucks in particular. So what it is credit card and debit card swipes only in the United States, and Bloomberg aggregates the data. You can see it. You can see it both on a year-over-year basis. You can see it on an actual value basis. If you look at the year-over-year where it's trending, it's actually very much down when it comes to sales and transactions, which is not surprising because they've had a couple of sort sort of disappointing points, one of them being geopolitics, so the AstroTurf effort related to the Middle East. The other portion is obviously China and the fact that they really went all in on China, and it's been a little bit of a disappointment. And then you've also just had consumers pulling back in terms of their spending on things like Starbucks, McDonald's, what have you. And so companies have been trying to just get people in the door. Now, if you look at it for, transaction value, or if you look at, the placer data, which we also have embedded on the terminal, even the placer data is down. So that's estimated visits. So people physically going into stores has been down recently. And so how does the new CEO get these people back? How does he get them comfortable with the Starbucks that we used to know and love? I'm not sure.
So talk to us about China, because I know you've flagged that before. Talk to us about China and what it means for Starbucks.
I think China means a lot of things for a lot of the companies in our space. I think it's been a very common word, more so than normal, when it comes to across the consumer and leisure space. So if you listen to earning calls this quarter, anyone from Hilton to Hyatt to, even the cruise lines have been mentioning China either as an avenue for growth or as a disappointment for an avenue for growth. I mean, we haven't seen the value of China. We've seen sort of this sluggish, slow growth of late. And for someone like Starbucks, that last year they mapped out their plan and they said, we're going to be building out more stores in China, and that's our international growth plan, and that's how we're getting the company back on track. All of a sudden, you don't necessarily have that. I mean, that's kind of a big problem.
Yeah, and when they talk about like strategic options for that or partnerships, what does that wind up looking like? They're not going to spin it off, right? So it's not going to be a Yum and Yum Brands, Yum China kind of situation. So how do you digest that?
I mean, it could be a Yum and Yum China situation. Who knows what's on the table at this point? I mean, we could fathom any sort of measures. I mean, most of Starbucks stores are owned, but then when it comes to international, it's a little less so. And even places like, I mentioned the cruise lines. We were on a Royal Caribbean ship a couple months ago, and they had a licensed
Starbucks. She always rubs that in
Starbucks.
our face, isn't she? She's always like, oh, remember that time I was on that cruise and it was really awesome? Sorry, continue.
They did actually have a collector mug for Icon of the Seas that I did buy, which was a Starbucks mug, but it was Starbucks with a bunch of Icon of the Seas stuff. I had to get it. I mean, it was two companies I cover. I was like, I can't.
In one shot. Well, how about on the flip side of this transaction, Chipotle? What's the outlook there? What's the feeling there in the street?
So Chipotle is an interesting one because they don't really have that much debt outstanding. So it's one that, Mike Hallen really deeply covers. We a little less so. We cover it from the standpoint that obviously it's a very important player in the space. It's that fast casual. We love talking about Yum, and obviously Chipotle sort of lines in perfectly with Yum, and it's sort of that intersection between Yum and Darden, which we like talking about. And so, I mean, I think, Chipotle obviously had a lot of negative headlines. We're talking 5 years ago, in terms of safety for their food, which is obviously never a good thing. Since then, they've turned around the company quite substantially. Now, I don't know what this means when you have a darling CEO jump ship and go to another company. I'm not quite sure what we'd expect there. As of now, from a bondholder's perspective, we don't really care at the moment.
Yeah, exactly.
But I do sort of wonder what shareholders are thinking right now.
All right, very good. Jody Laurie, Senior Credit Analyst for Bloomberg Intelligence, joining us from the Princeton office via Zoom here. Chipotle for you? No?
No.
Really? All right.
But it's the same, like, okay, no matter what you get, doesn't it all taste the same? And isn't that weird?
No, it's very good. John, help me out here. Are you a Chipotle person?
Yeah, I mean, I like it. I don't go there. There's not one near me. It's not convenient.
I haven't eaten
Even Lisa
Chipotle.
Mateo said she liked it.
I know, she loved it.
Yeah, and that's hard because usually if, it's not like super granola-y, healthy thing,
I don't think I've literally had one in 12 years.
My problem is there are just too many people involved in the front. Too many pimply-faced teenagers.
Wow.
Loading up my bowl.
Well, that's because it's
Wait,
fresh.
and you say that I make you look like a curmudgeon? Come on now.
You mean I do it myself?
Paul, what is your Chipotle of choice?
2 hard tacos.
2 hard tacos.
Chicken.
Okay.
Yeah, peppers and onions, pico de gallo, and some cheese, and we're good to go.
No guac, no sour cream.
No guac, no sour cream.
Okay, no
Yep.
chips.
Nah, don't need chips.
Oh, so you're just...
And you know what? Now they fill them so full because the social media was saying how they were underfilling them. Now they fill them so full that I only get 2 tacos versus 3 before.
And you pay by the taco.
I pay by the taco. So
Ah.
I'm a huge winner here based upon the social media pressure they've had. So big move in the restaurant biz, the fast food biz. This is Bloomberg.